lower for a lot of these oil marketing companies, IOC, HPCL, BPCL, all of them down between 4 to 5%. Then you have Apollo Tyres, which is down 4% as well. Crude is an important input for tyre makers as well. And the IT sell-off continues with some of these mid-cap IT names seeing a bit of sell-off. And then from the exporter names, we do have, some of these logistics players, all cargo logistics and the likes, who do have some exposure to West Asia, are all lower. So by and large, it's just one way, and that is down. 2,100 stocks which are in the red, for about 95 stocks which are in the green on the NSE.
Well, that's right, Mangalam. A few stocks that are gaining because of the spike in crude oil prices. As you mentioned, ONGC, Oil India, HOEC, all three of them, in fact, have opened up in the green. And there are very, very few stocks in the green. So, just highlighting those three names, all of them have moved up close to around 3%. Silver ETFs, if you pull up some of them, all of them, in fact, have gapped up because silver has seen a surge of more than 7% over the weekend. Silver ETFs move up. The only listed play, it will be Hindustan Zinc, in terms of the move in silver prices. So I think Hindustan Zinc as well has opened up with some green or more or less flattish. It's up actually 2% in an otherwise wobbly market. Vedanta, that's more or less flattish. That's down close to around 0.5%. But I'll tell you what, it has a double engine playing out there. One is on crude oil prices moving up. They'll gain out there. And besides that, they hold stake in Hindustan Zinc. And Hindustan Zinc itself is up close to around 2%. Muthoot Finance, that's the other name. That's a play on gold prices. Stock has seen a sharp correction from the recent peak. So I think Muthoot Finance as well has opened up with a gain of close to 100%. Had highlighted a couple of these stocks in the morning chart. Let's pull up the defense index because that one should see some traction in today's trading session, given the kind of news flow that we've seen all across the globe. So that's one of the lone indices that are up close to around 0.5%. The Nifty panic low at the start of trade was close to around 24,500. We're holding around 24,900. The Nifty Bank is down 500 points or thereabouts, and the number of stocks advancing just around 200 stocks or thereabouts. So guys, just one quick point. The first half of March is seasonally a weak, period for the markets. So you'll have a lot of mid and small caps that will get, as it is, see some selling. And now this will be amplified because of geopolitical risk as well. And from a longer term perspective, this period could actually be providing a very good opportunity on individual stocks because of the dual factor that's playing out. One is the seasonal factor. Second part is the geopolitical issue as well. And both of them have a temporary phenomena in nature. So I think that's why we should keep an eye out on that. By the way, RR Cabell, one of those stocks that have a good amount of exposure to the Middle East, it's started off with a sharp downtick, and that dip has quickly got bought into. Only 41,000 shares traded, but that intraday chart should come up for you. Good recovery from the lows.
All right, we take that point. Nigel, the defense stocks now, they are picking pace. We have Paras Defense, which is up higher. Bharat Dynamics is up 2.5% higher. Solar Industry is a word that, a company that Samir did speak about as well. That's about 1.2% higher. Mazagon Dock Ship higher. Hindustan Aeronautics, one which hasn't participated in the recent rally that we saw in the defense names as well, has seen a mild green uptick as well. So that's the one that should come up for you. Barring that, we do have some decline that we're seeing, further decline that we're seeing in a lot of these, infra names as well. So IRB Infra is down about 4.5%. We've seen some decline in Suzlon Energy. That's down about 4% as well. Adani Total Gas, that's the other one, which is down about 4% too. Kalyan Jewellers has some exposure to the Middle East, West Asia as we know it. That's one which is lower by about 3% as well. So we will monitor the market as we move forward. A lot of these stocks which are under pressure. Now the number of stocks which are declining has actually moved higher to 2,400, even though the number of stocks which are advancing has moved slightly higher. So it all depends on whether we go ahead and defend that 24,850 sort of mark. The early trades are telling you that yes, maybe that could be in defense because we've swiftly jumped about 75 points from those lows, and we are closer to 25,000 than we were at the open. The India VIX 2 has spiked to around 16%.
All right, just to run through what's happening across the Asian markets. Well, the fall that we're seeing is largely in line with Asia. The Japanese index, Nikkei, is down 1.4%. The Taiwanese market is down about 0.4%. Kospi today is shut for a public holiday, but Hang Seng, that's down about 1.7%. So the fall that we're seeing, 1%, is largely in line with the slide across the Asian markets. Sectorally, the only index which is up in the green is defense, and that's holding strong, picking up pace, 1.5% now. The defense index opened up with a gain of about 0.5%, but now it's adding on some more steam. The Nifty tourism index is the hardest hit. That's got a cut of 2.3%. 1.4%. Small cap index down 1.8%. Realty continues to be the hardest hit, 1.7% lower for the day, 12%, 12.5%, 13% lower since the start of the year. And IT should come up for you on your screen. On Thursday and Friday, we saw a little bit of resilience coming through in the IT stocks. But this morning, in line with the pressure, we've seen the IT index open with a cut of 1.1%. But let's get you a special conversation with veteran investor Christopher Wood. He says US President Donald Trump will back off his tariff agenda as the country is approaching midterm elections. My colleague Nimesh caught up with him and began his discussion by asking him about the geopolitical risks and the rising tension right now. Listen into a slice of that conversation.
Geopolitical risks have been there, as you rightly say, for at least 4 years.
Yeah.
So it's extremely hard for markets to discount geopolitical risk. In fact, they can't. So the only way you can discount it in a portfolio is via gold, and I would say this year via energy stocks. So there's probably a bit of a Iran risk premium in the oil price today.
Chris, you've been a big-time bull on gold, and it's proved right in the last at least 2 years. Gold has been the best-performing asset class, so to speak. With the kind of rally we've seen in the gold and the commodity stocks per se, what's your call now? Do you see further upside on gold from here, or it's a time to book profits into gold?
No, in the medium term, I see big further upside in gold, but I wouldn't be surprised to have a period of extended consolidation.
Okay.
Sideways consolidation to maybe sideways to down, but I'm talking tactically.
But you're not expecting.
If I had a leverage position in gold, I would have taken profits.
Okay, but what's a long-term goal? What's a long-term target on gold? Say maybe 2 years, 3 years down the line.
Formally, my long-term target is now 6,500, but I mean, gold can easily go to 10,000.
Oh wow!
Because if you look at I'm talking US dollar terms. So in US dollar terms, the growth of M2, you can easily get $10,000 on gold. But my formal target, based on is currently 6,600.
Sure. Apart from gold, anything in the hard commodities that you like and you're looking to add into it, the silver, copper, aluminium?
No, I have copper stocks in my portfolio and oil energy stocks, but if I only own one, it would be gold.
Okay.
Silver is high beta gold.
Sure.
But it's not, if you're a purist, you will only own gold.
What is the best case as far as the US equities are concerned for this year? How much?
My view on US market, I've got a stronger view on the relative story in the absolute. So my view has been since the end of last 24 that the US has made an all-time peak as a percentage of world stock market capitalization. So to be precise, the US peaked at 67% of MSCI All Country World Index.
Okay.
And I think that's an all-time peak, and that's consistent with my view that you're going to get a derating on the hyperscaler stocks, which dominate the US market.
Sure.
Because of the huge capex, which is making these companies generate less free cash flow.
Sure.
So I believe we've begun a period where markets ex-US will outperform. That happened last year, and I expect that to continue.
Okay. Now coming to India, Chris, because you travel to India so much, and there's a lot of fan following in India as well to read to what Chris believes on India. I saw a tweet, you recently met Piyush Goyal as well, the Commerce Minister. You think from a trade point of view with the US or with Europe or with the other countries, it's largely been settled now?
I think
no downside risk in terms of tariffs?
Well, I think it's good news that obviously the European-India trade deal has finally happened. And it looks like Donald Trump was a spur for that to happen.
Sure.
So that's a sort of indirect positive. On the tariff thing, I personally think there's a chance that Donald Trump backs off the whole tariff agenda, although he's not going to admit it in public.
Okay.
The reason I say that is the polls show, we've got the midterm elections this year, and the polls show that the tariffs are not popular amongst ordinary Americans, because despite the inflation data in the US, which looks relatively benign, it's quite clear from the opinion polls that ordinary Americans feel the cost of living. And I just don't think the tariffs are popular.
Okay.
So I think there's a good chance he sort of quietly backs off the whole agenda without admitting it.
Okay. Well, that will be a great news, right, for countries like India.
Yeah.
But even if he doesn't back off...
Because it's not popular. Right now, he's losing the midterm elections.
Sure. even though if it doesn't back off, still at the current rates what we are with the US and with the European nations, you think it's pretty okay for India to do well from here?
But I don't. Hopefully, the experience with the US prompted the Indian exporters to look for other markets. I think one unfortunate consequence of the tariffs, though, is that I think the central bank allowed the currency to weaken more last year to support the export industry. But personally, I think that was a mistake because the rupee going through the 90 level is a key psychological level. And I think a lot of Indian corporates were not positioned for that because I've met many Indian corporates in the last few years who basically have been of the view that depreciation is going to be less going forward. So I think that's been a negative. It's also negative from the point of view of foreign investors.
Yes.
Because it made the rupee India underperformance worse last year. And again, it wasn't expected.
Sure. From a flow perspective, Chris, because you spoke about rupee being a bit negative for the FIs, we've seen first signs of FI money coming back into the Indian markets. This month, we saw nearly $2.5 billion of inflows from the FIs. The FI holding in India is the lowest in the last, say, 10 to 15 years. You talk to a lot of global investors as well. Look at India. What's the sense you get? Is it that you're going to see a lot of FIs coming back to India now?
No, you're only for real flows into India to happen. One or two things have to happen. One, the Indian market has to fall a lot so it becomes very cheap.
Okay.
So that, in my view, will only happen if we suddenly see these SIP flows stop.
Breaking off. Okay.
Which is not my base case.
Sure.
My base case, the flows keep coming. So in that case, the only way we're going to get big foreign money into India is if this whole semiconductor trade peaks.
Okay.
And we get a sharp sell-off in the semiconductor stocks in markets like Taiwan and Korea.
Yeah.
And you know that the more the market questions the capex, the more the chances of that grow. Happening grows. So if I had to guess on it, it's more likely to be the second than the first.
Okay. One from a sector point of view, the one sector which everybody's been talking about of late is a sharp sell-off in the Indian IT names. Sitting out of India, looking at all global markets in terms of tech stocks, what's your view on Indian stocks now? I know your analyst has downgraded recently all the Indian names. But
the IT services.
Yeah, IT services. But what's your thought on the IT services?
No, I haven't got the IT services in my portfolio, but frankly, I never have. I never had that because I've always had a Indian green venture portfolio more focused on the domestic side. But at some point, there's going to be a counter-trend rally in these software stocks because it's not like these businesses are disappearing tomorrow. So I think the role of Indian IT services will be to help corporates migrate to small business models, the small language models designed for their own purposes. So there's a role for the IT services, but you know their long-term growth, revenue growth, is going to be less than people were hoping for probably, and they're going to be, I think, importantly for the economy, the risk is they're employing fewer people. So while there can be a counter-trend move, I don't think they're a structural hold. No.
But do you foresee or do you see a risk of a second-level impact on, say, consumption and the real estate stocks in India on the back of sharp sell-off in the IT names?
That risk exists, definitely, but I think that risk in the first instance is greatest in the developed world. So these predictions of all these white-collar job losses, which are potentially very bearish, if that's going to happen, it's going to happen first, in my view, in the developed world.
But
and then it's going to happen first in America. And then you will have a risk on the consumer lending portfolios.
No, the reason I asked you is because, in your India model portfolio, you have exposure to a lot of the real estate names.
Well, not a lot, but
some of those real estate names you have an exposure to.
Yeah, I'm quite comfortable. Now, the foreigners tended to own those stocks, not the domestics. So I think they've been hit by foreign outflows. But the way I see some of the prominent Indian real estate companies is that they've taken market share. These stocks are not expensive, so I'm comfortable. I'd rather own them than the IT services.
Okay, interesting conversation with Chris there, but let's get straight to the markets. The markets are still under pressure, the Nifty as well as the Nifty Bank. However, we have come off a little bit from the lows. The Nifty has come off close to around 250 points from the lows, and the Nifty Bank close to around 300 points as well. But the more important number is going to be the advanced decline ratio. There were very, very few stocks that were advancing in the first few minutes. At least now you've got close to around 300 stocks. And I'll tell you what, by the end of today, you'll want that number to maybe double from here on. That's what will make portfolios feel a little bit good, because a lot of stocks actually have bounced off the lows. The problem is the spike that we've seen in crude oil, and for a country like India, it hurts, right? Because we're importers, it'll hurt our surpluses that we have, the deficit numbers as well, and put some pressure on the rupee as well. So macro indicators get a little bit hit when the crude oil prices spike up. But there are a few stocks, in fact, that do gain. So ONGC, Oil India, and HOEC. All three of those names, they are beneficiaries of the spike that we've seen in crude oil prices, and that's why all three of them are doing pretty well in trade. But the OMCs, they get hit because, their margins come under pressure. So that's why you're seeing the OMCs, HPCL, BPCL, as well as IOC, all three of them are under pressure. Precious metals as well did spike up, whether you're looking at gold or even silver. So you have a few of those ETFs that are traded. Well, they are seeing a bit of a gap up. And you have Hindustan Zinc as well that's holding up, because that has this is the only stock that you can place silver from the listed universe. And Muthoot Finance, after the kind of correction that you've seen, more than a 20% correction, that stock has popped up close to 2% because it's a gold financer. Travel plays are hit. Interglobe is down. SpiceJet from bombed out levels. Well, that stock as well is under pressure. And, Indian hotels, that's down marginally close to around 2%. So all those travel related names, they are under pressure. And for Interglobe and SpiceJet, the other problem is ATF prices as well will perk up. As is, they were higher on a sequential basis. Now you'll have cancellations, and added to that, the input cost will spike up. A few more losers should come up for you on the screen, and those that are falling on rather large volumes, Suzlon, Voltas, as well as Inox Wind, all those three stocks under some pressure. So net, we're down. We're popped up a little bit from the lows of the day, and by the end of today, you'll want those lows to get defended, which coincide with the budget day lows and the number of stocks advancing at around 300 stocks. Hopefully, by the time we end up, it'll be a little bit better. Back to you guys.
That point, Nigel. So there has been some recovery from the lows. The question is whether that sustains or not from here on. The second half of trade will be extremely crucial ahead of the holiday tomorrow and the weekly expiry. But let's welcome our market master for the day, Manish Donthalia, CIO, MK Investment Managers. Manish, there is a fair amount of geopolitical uncertainty, but this comes at a time when some of the domestic, cues are looking a lot better than what they were, say, 6 months ago. Would you, look at deploying more capital in the same old names, or are there any other fresh themes that have opened up for you after the correction that we've seen?
So now we are in an AI environment, and I think natural resources is one area which is likely to benefit in an AI environment, and anything to do with, let's say, critical minerals, energy, power, power transmission. These are some of the areas where incremental capital would be looked into for deployment.
Okay. Anything else? Manish, we were just chatting with Samir, and he was also saying that, there's no point looking at day to day in the times of these skirmishes. He will actually use this opportunity today as a buying opportunity, the dip today. So would you be looking at deploying the cash that you'll have on the books on a day like today?
Yeah, 100%. So incrementally, whatever flows we are getting, we are buying, and even today we are buying. So, we have seen that in the past also, whenever there's geopolitical skirmishes and market gives a knee-jerk thumbs down, in the next 6 to 9 months, all of that is probably recovered. The base case scenario currently is that this is not going to last too long, whatever escalation has happened, because that would be reflected in the oil prices. And of course, we don't know whether it's going to last. But today, the consensus opinion is that, this is going to end sooner than later. We have got to keep an eye on oil, and we have 74 days of reserves, petroleum reserves. So incrementally, markets have been reeling under negative news flows for quite some time. And, fundamentals warrant that any level between 24 and 24,500 is par the course as far as the bottom in the markets are concerned. Today, we are in a risk off, and I would probably believe that that gives a golden opportunity to buy stocks.
Okay.
All right. Hi, Manish. Good morning. Good to see you in. Golden opportunity to buy. But what to buy? Manish, name a couple of stocks, something that y'all are interested on. A few sectors are getting pummeled right now, whether you're looking at aviation stocks, some of the travel and leisure related names, paint stocks are getting hit. But, hopefully things ease out from here on. Any of these are finding, those interest from you, or maybe the defense names. They've bounced up in the last 1 month or so, but they're still far cry away from the 52-week highs.
So auto components, tire companies, which have also got hit today, these are within the buy list because, auto space as a whole is looking quite bullish from the next 4 quarters point of view. So that is one area. any correction would warrant an increase in exposure out there. The financial names, insurance included, would be on our buy list. The pharma, healthcare names would be on our buy list. Select consumer discretionary, example, durables, commercial vehicles, power transmission, select defense, of course, would be on the radar now that valuations would look more palatable. So see, these are some of the areas which look interesting. Of course, in an AI environment, what do you do with IT stocks, wanting to keep an underweight stance? Not that we have made it zero, but clearly an underweight stance because multiples are getting corrected. So this is how we are placed currently.
What about financials? Everyone's overweight on them. It's not necessarily an international exposure, purely domestic. Do you think there is still an opportunity out there? And in that, PSUs, private sector banks, how do you go about it?
See, I think the PSUs are better placed because valuations are lower than private sector banks and they have a decent exposure both to the retail credit as well as corporate credit. Corporate private capex is looking up. And I think if you see the numbers, the NPAs, the credit cost, the operating leverage, all of that seems to be pointing slightly on the better side vis-a-vis private sector banks. We have an exposure to both private and public, but I think I'm leaning more towards more positive return from the public sector space as opposed to the private sector space.
Manish, just do you think there will, you said the base case is that it's status quo, there is no long-lasting disruption, things get resolved. But do you think as the situation resolves, there could be some more long-lasting damage which influences investment opportunity? Maybe it's a low probability event, but do you think there could be any, major changes in the economic landscape because of what's happened?
I don't think so. In the current setup of things, if things were to get normalized, emerging market as a basket would be positive looked upon, and in that bracket, since India has not performed over the last 15, 18 months, I think incremental flows would be looking to come to India. Valuations are conducive, domestic macros are okay, earnings growth is the course, outlook looks okay. So from that point of view, emerging market as a basket looks okay. Things get normalized, news flows tend to be normalized. We should see inflows rather than.
Manish, what about central bank support? The RBI has been infusing liquidity and done a very good job, actually. What are you all penciling in with regard to central bank action from here on? This crude spike, it puts it into a little bit of a tizzy, and the rupee as well as weakened a little bit. Do you all expect further rate cuts in this year? Because in the near term, that'll put pressure on some of these banking names. But in the longer term, things should recover. As we are seeing, credit growth has picked up now. For the NBFCs, the cost of borrowing as well, the benefit is likely to flow through in the coming months.
Yeah, interest rates would have a bearing not only in India, but globally. And of course, if this war was to last longer, it would pressurize oil prices. Would lift interest rates because, there's going to be inflationary pressure. Right now, inflation is under control. As for now, we are building in status quo, no cuts in rates, given that we've already seen front loading of rate cuts, and it would be a wait and watch situation. I think this would basically apply globally and not only pertaining to India, but even without that, I think liquidity is okay, and that's not too much of a concern. So all in all, not too positive or negative about rates at the moment. As the situation evolves, we'll pencil it, but as of now, status quo.
You spoke about how critical minerals, etc., on account of AI. Can you give some more color on the way to approach it from an investment point of view? What should we look at?
All the metal companies, these are basically plays on critical minerals. You have the established names. Copper is going to be in demand long term. Aluminium, silver, obviously, and a few others where rare earths, where we don't have too much of a direct play. But these are some of the areas where these are natural resources which will be required. Energy amongst them will also be required. So these are some of the areas in critical minerals, which would be, according to me, a direct play on AI into the medium to long term, as opposed to GPUs and RAMs, where India doesn't have a play, and we are catering to only the infra builder from the point of view of HVAC and gensets and generators, wires and cables. Apart from them, critical minerals, according to me, would be a direct play on AI.
All right, take that point. Thanks a lot, Manish, for joining in. Wish you good luck for the current uncertainty and obviously for all the investment bets that you make. We take a short break now. Come back on the other side. The management of Supreme Industries joins in to talk about the outlook going ahead. Welcome back. The recovery from lows is underway. The Nifty is still down about 200 points, but well over 100 points off the lows of today's trading session, moving towards that 25,000 mark. The management on our show right now is Supreme Industries. The stock is up 15% in 2026 so far. In fact, Motilal Oswal is bullish on the sector. Supreme Industries, the brokerage house, believes that the PVC and pipe industry are now entering a structural upcycle. We have with us MP Taparia, who is the MD of the company, who joins in. Thanks a lot, Mr. Taparia, for joining in. You had earlier pointed out that, the worst of prices is behind you, and from January, you had started to see a bit of a price increase. Could you give us a sense of the quantum of the price increase that you've seen so far, and what could your exit quarter margins look like?
The local raw material producer increased the price of PVC by 10.5 rupees a kilo. On our company margin, I will convey to you on 27th April.
All right, on 27th April for your company. No, because you had revised the margin guidance lower to, to around 13.5 to 14%. Okay, could you give us a sense then on what you're targeting for FY27 in terms of volume growth and margins, given the sort of price increase that we've seen in PVC now?
No, you see, PVC price crashed during the year 2025 from $700 in the beginning of April 2025. And December, the interim booking is correct to inventory loss PVC producer. And now the prices of PVC import is gone up to 710. But this happened before this US-Iran tension. Now the market will open up today only, then we will know what is going to be the reaction on the internal booking. I cannot say today anything. Today only we know that most of the booking has been withdrawn.
The booking has been withdrawn on account of tension, sir?
in account of this, there is too much increase in the freight rate because the Strait of Hormuz was closed. Suez Canal was already in trouble. So people want to watch what is the freight rate going to be, and going to take longer voyage time. So new freight rate once they announce, then the new booking will come. There's temporary reaction. The booking has been withdrawn.
Okay. And how much, sir, do you depend on, this kind of a booking? Will it impact the financials of a company like Supreme Industries, or do you already have inventory and therefore Q4 should be unaffected by what happens in the near term?
I can, as I told you, the price is crashed from $700 to $580. At $700, it was all affordable. And the prices before the booking was closed was $710. So there was no.
Okay, all right. I think we seem to have snapped that line, but we'll just try to get Mr. Taparia back. The good news is that he's saying that there is a price increase that's come about, not commenting too much in terms of margins, but it'll be interesting to hear about the uptick that they've seen in volumes and the reason that we're seeing something like that. So just waiting by, and he was making some valid points with regard to uncertainty on the movement globally, which in turn could impact some part of their business as well. But we'll try to understand. Mr. Taparia, I think, is he back with us? All right, not that. Let's do a quick market check then. When we started off trade, there were only, I think, around 50 stocks that were advancing. When I just went across to the wall and I did a quick market check again, we had close to around 300 stocks that were advancing. Now that number has moved to close to around 500 stocks. So clearly, various stocks are getting bought into. Those initial margin calls, they have been gradually moving out. I think that will continue for the next half hour to around an hour or thereabouts. And then, in fact, we could see a more sustained recovery, if at all. A few stocks, Tejas Networks, the stock had a big run in the last week itself. And this morning it opened up with a cut of around 5%. From those lows, Tejas Networks has seen a big spike up. I think in the last 1 month, it's up close to around 40%. But keep in mind, this is a stock that came down by, to a third of what it was at its peak. It was a 1,000 rupee stock, came down to around 300 rupees. And from there, it's seen a big spike up. But I think the most heartening aspect today is the recovery that we see in the broader markets and defense stocks. They're really the ones that are bucking the trend today. So defense, whether you look at BEL, that one's the big mover. And a couple of these metal names as well, Hindalco as well as Tata Steel, both of them are opening up strong trading in the green. Yeah, Manglam.
Yeah, you spoke about a couple of these defense names. Look at Solar Industries. That's recovered about 6.5% from the lows. That's about 3% higher as well. Bharat Dynamics is the other one, which is up 6% from the lows as well. And one of the stocks which has actually seen a big cut from its peak, it's Bluestone Jewelry. Over the last few trading sessions, it found some funk. And currently as well, while it opened about, 4 or 5% lower from those lows, it has seen some buying. So from 417 all the way up to 455 as we speak right now. So it's a recovery of almost 10% from the lows. This month has been one of the few positive months that we've seen for the stock in an otherwise decline of almost 45% from the peak. But let's get you an exclusive conversation. Tuhin Kantapante completes his first year in the office as the SEBI chairman. He says they have been concerned about short-term weekly options. Spoke about making cash market more liquid and FPI registration timeline as well. Listen in. He had a conversation with Prashant.
It's basically, I think we have to zero down on the problem area, which is short-term options. Because F&O is a very wide space and using it just very casually is not appropriate.
Yeah. So weekly options.
Futures are very important.
Yeah.
Options are important. We would like a longer-term framework, longer-term derivative framework, the necessarily place where people can hedge and people can short. We have stock futures. So the market is quite big. And here, I think we are concerned more about short-term dated options, weekly options, where we said that the activity was high, there was a hyperactivity,
yes,
not necessarily serving a very great economic purpose. But there, in consultation with industry, in consultation with various others, our own thoughts, we put out a framework in terms of market regulation, bringing in different risk metrics, position limits, upfront payments, expiry day margins, and so on and so forth. And they rolled out in different on different dates. The last of it was in December. We will continue to monitor this and have the data put it out before suggesting any measures. So therefore, I think we need also a stability, policy stability, in the sense that there are certain things that we do, and then we also wait that, how that market is panning out.
So you wait for that to take effect, show up in numbers, etc. The statistics, you will assess that and then put it out in terms of, so that is a process that is underway?
That's right. I mean, it will take some time,
okay.
But
okay.
that will indeed be the process.
And if required, after you put that out, after more discussion, I mean, as is appropriate, you will decide what to do. If
Yes.
there's anything more which needs to be done.
Yes, so therefore I think we have become more database, one, and secondly we are also looking at the measures that will help, because it's not really, I mean, we can actually be very reactive and try and put in some measures which may not be effective. So therefore we need to really actually deliberate what are the more effective measures, if at all, if the data suggests otherwise.
So as you said, the last of these measures was put in place December, right? How long will you wait before you start to, I mean, before you can take stock in a serious way?
I think this is your 1 year thing, should not be really concentrating on forward.
I have a long list of questions, sir, but I thought I will start with, it's something which is of great interest to you.
So you'll come to know when such a thing is there.
So on the cash side, right, we're talking about equity derivatives. Will you also kind of look to increase market depth and those kind of things? I mean, making cash a more attractive.
I think it's indeed our endeavor that the cash markets must further become more liquid. And whatever we need to do, we do have a working group looking into it to review the short selling and the SLBM framework under the cash market, which is there, but it's somehow there are some barriers where it's not really taken off. So therefore, the industry and the SEBI officials and other experts will look into it and suggest measures, and we will move forward.
One thing I've heard, and this is my last part, sorry, you will forgive me for this, but STT on delivery, for example, I've heard it from every day when we speak with, and we don't talk about this every day, but whenever we have these discussions, it always comes up. Why can't the government, if the idea is to curb short-term options in the F&O space and encourage cash, do away with STT on delivery? Is that something you would, SEBI is the expert, and SEBI will of course advise and tell the government, and of course it's for them to decide, but is something that is on the agenda?
No, I'm not going to discuss on TV what inputs we'll give to government and not give to the government.
But cash market development is very much, as you said,
yes.
There's a group which is.
I think whatever needs to be done, we should be doing this.
Fair enough. Now, just on the taxation front, sir, there was a lot of expectation. Maybe also there was some element that markets have not done well, but markets go through cycles. We had a few years of bumper move, and then markets consolidate. But and I think there was that element as well, and many were pointing out that maybe in the budget we will see FII-related taxation perhaps being equalized to how they're taxed everywhere else in the world. I don't know if you have any thoughts at all, or was this?
I think you're again coming back to the fiscal measures. You should be asking these questions elsewhere.
But was that part of the consultations, pre-budget consultations?
No, I would say that let's look at the kind of measures that we have at a regulator.
Right.
Taken for the FPIs.
Right.
For us, to do the market development is to see, the frictions are reduced. There is a greater speed with which they can operate. So there is a registration issue where we have completely now looking at a very different approach to registration. We want it to be digitized. We want it to be fast. We want it to be not days or months, but actually literally a week or 5 days. So can we reduce it to 5 days? So what it takes to reduce it to 5 days? So we're working with custodians, FPIs, other market participants, and then you have now India Market Access Portal for everyone, where all the FAQs, all the different measures. So if you want to enter India, you have one place as FPI what you need to do, what documents you have.
And I must say, it does not get enough attention. It is not a hot enough topic, but it's a point which many serious foreign investors have raised over the last many years.
And these are the things that we have actually deeply engaged with them. And some of the new registrations have come with India digital signatures of submission of documents, which is an important part of delay. If you have, in this time and age, if you have always a document, physical documents, wet signatures, notarize, apostille, be submitted on different things, because you have to keep on updating the control and other measures. So whenever there is a change, again you have to send out the documents. Now, if it could be just instantaneous through digital signatures, it will really remove the friction. It's just something that we really do in our domestic market very, very effectively. We have such a digitized economy, digitized society. So this is one area where we are now pushing forward proactively to see that we move into completely digitized
So
registration.
from the time that FIIs, when a new foreign investor comes, registers, to the time that they're able to actually invest and start trading, etc., you want to bring that down to a matter of days, basically.
Exactly.
Right.
And we have achieved considerable progress in this.
Okay.
We have a portal-based approach. The new portal, the front end has changed, and we are engaging with them how the India digital it becomes the norm on the same sort of documents which they submit for registration. So with no extra burden.
Well, the Nifty is holding on to that 24,900 mark, but some stocks which are higher today, even the mid-cap index actually is sharply recovered from the day's low. In the morning, the Nifty mid-cap index was down close to about 1.7%. Now it's trimmed its cut to about 0.6%. The small cap index had opened with a cut of more than 2%, nearly a 2.3% decline at open. And now it's down about 0.6%. So the intraday chart of the Nifty and mid-cap will come up for you on your screen. So what's higher? Many of the metal names: Hindustan Copper, Hindustan Zinc, Nalco. These are stocks where there is buying emerging. SAIL is another big mover. Tata Steel is up nearly 0.6%. Vedanta is up about 0.5%, and all these stocks have recovered. In the morning, they opened up lower, 2-3% down, but now buying has emerged in metal names. So it's not just the defense sector, which is the pillar of the market holding up in the green. You've got the metal index also. While defense continues to see buying, we've been talking about it, the Nifty Defense Index is now inching towards a 2% rally. Metals is the one where we have seen a marked change from the intraday lows. On the way down, it continues to be about tourism, banks, realty, many of the IT-related names. PSU banks are selling off. Autos are down 1%. IT is lower in trade. The consumption names are weak in trade, but it's largely metals and the defense stocks which are up.
The good part is that the recovery from the lows today, this morning so far, has given bulls some sort of confidence to go ahead and write some of the puts. So early in the day, and these are options that expire today itself, 24,900 put writers are fairly active, and as are 24,800 put writers. And that is something that we can see in the put call ratio, which, at Friday's close was 0.63, and first hour itself, it's moved higher. That means that there have been some puts which are active right now.
The PCR also, Mangalam,
yep, there's 1.03 right now.
From
So
around
that'll be very
0.6.
interesting.
Okay, one word, Bharti Airtel is another stock which is in the green because they held a call with the investors towards the end of last week. And one key takeaway from there is that that financial commitment for the NBFC in year one will only be 10 to 15% of the committed 20,000. It shouldn't go beyond that, the overall 20,000 that's been committed. And now the new goal post on ARPUs is 350. Remember earlier it was 300. Now they're talking about 350. Rohit Srivastava, founder India Charts and Strike Money, is now joining us on the show. Rohit, your first thoughts on the price action today? The panic low was 24,650, but we've swiftly recovered. And now even the cut on the mid and small cap index seems more manageable.
Well, I wouldn't jump the gun over there looking at intraday bounces because it's very important to note that at the start of February, when we had the trade deal, we did a massive gap up. And that gap zone is above 25,108. And today we have gap below that. Now, in technical terms, when you have a gap in the same zone and you go back below it, we call that an island reversal, which means that 25,108 now becomes a major resistance, which you most probably are unable to cross. And it would really take some major change for that to happen. And only when you do that would we really say that the worst is behind us. So having said that, I think the break today does get us to the first most important support. 24,600 is essentially the trend line of the last two important bottoms that we've made over the last year. One, of course, occurred, on budget day, and one was sometime last year in August of 2025, when the trade deal had fallen apart. So when you connect those dots, you come to 24,600. Yes, that is an important support, but we can't say that that support has held or broken based on an intraday bounce. And like I said, now that we are below 25,108, the bias would be clearly negative.
Okay.
It remains a sell on rise market.
Sell on rise market. Got it, Rohit. And you've been pretty clear that you believe that there's further downside in store. So we've taken that point on board. How low can we go, though?
So let's start with what happens if 24,600 breaks. It would open up the possibility of going, down to around 23,500 to 23,300. So that is the risk we are really staring at right now.
And what probability would you assign to that? And now that we're above 24,600, do you think we can go higher from current levels?
No, I wouldn't bet on higher. Like I said, if you're below 25,108, that is more critical than whether you've held 24,600. 24,600, we'll have to give some time to see whether it holds. Okay. I'd probably put a 70% chance on us breaking the lower end based on, whatever is going on. And of course, the setup itself, because on Friday, even before the war came out, we were seeing a lot of selling volume in the market. So there were other reasons why it was really falling.
Well, what will make you negate this particular negative, outlook that you have? At what level? 25,108. That's the first level that we're looking at.
That's the first level where we'll go back and reverse that. Then beyond that, of course, then we go all the way back to 25,600. From where this fall started 2 days ago. So
okay, all right. Rohit, just a quick word on a couple of other assets, gold as well as crude. Do you have a view, and if any levels you're tracking on both these two?
So I know a lot of people start thinking about gold as the hedge in a uncertain situation like this, which is geopolitical. But when we look at the history, sometimes gold does move for a day or two and then sells off. My sense is we may not get really past 5,600, the high that we made in January. However, the real trade during war times is actually in oil. And oil is actually breaking out today. The trend line of all the tops of the last 1 year was at around 70.5 WTI. And we are trading above 70.5. So this is now a signal that if we stay above 70.5, we can even go towards $100 if the situation remains grim or even worsens. And so if there is a trade, a war trade, it is actually in oil and not in gold.
All right. The war trade is in oil and not in gold. Thanks a lot, Rohit, for joining in and giving us your views on the index as well as a couple of sectors. Going forward in these times of uncertainty, you bet the probability on the downside a little more, but on the upside, 25,108 is the level that we should be tracking. But another sector that has been doing well is the defense pack. Hormaz joins in to tell us about those moves. Hormaz.
The only other sector that's doing well other than the metals today, and that is defense. And of course, there's a sentiment positive considering the circumstances that we are in right now. But more than the bigger names, it's the smaller names that are making a lot of noise in today's session, be it the likes of Paras Defense, be it the likes of Idea Forge. Idea Forge, of course, being significantly below its IPO price, still up 9%. Paras Defense is up 13%. And then come the other underperformers. Bharat Dynamics was one of the worst performing stocks in the broader markets in the month of February. That's up 3%. Data Patterns, which did well last week, is extending its gains in Monday's trading session, and Midhani too, one of those defense names that are doing well, gains of around 3 to 4%. Now, of course, we saw this happen before as well, going back to as early as last year itself when Operation Sindoor was in effect, and all of these defense names had surged anywhere between 20 to 25% during that period, and they had this, and that's because, of course, the fact that the probability of more emphasis on defense equipment, the components used to manufacture them, that goes up, and as a result of which this kind of impact that you're seeing on these defense names. And there are select names that did well in the first 2 months of the year as well. Stocks like MTAR Tech was the best performing defense name in the defense index. The stock was up almost 60%. Bharat Forge has done well this year. The stock is up 30% in the first 2 months of the year. This is, of course, as of Friday's closing. Data Patterns has done well, as has BEL, which is a part of the Nifty now, and Solar Industries seeing double-digit gains. Among the underperformers, though, as I mentioned, Bharat Dynamics, of course, that Cyient DLM is one of the worst performing names on the defense index, along with names like HAL and Masgaon Dock. But if you take a look at stocks that are at 52-week highs, MTAR Tech is of course one of those names. Bharat Forge is at a 52-week high, as is Data Patterns and Cyient. DLM on the flip side is trading at 52-week lows. However, we did speak to the management of MTAR Tech earlier in the day, and they mentioned that defense is a very small part of their business. Only 5% of the overall business comes from the defense business, and they are very selective in the contract selection from this segment. So the defense is one name that's bucking the trend this time around, and as long as the conflict persists, they'll continue to remain in focus as well.
Thank you very much for that. The gains in metals and these defense names is trumping the up move that you can see in stocks like ONGC. ONGC has completely flattened out, and crude prices too are now hovering around $77 per barrel. Manisha will join in on the other side and tell us more on what's happening in the world of commodities.
Fly Emirates, fly better. Welcome back. Let's talk commodities now. Manisha is joining in with her eye on crude prices. Manisha.
Thank you so much for that. And the crude prices should come in on your screen, because when we opened the trade today, we were up 13% for the crude oil prices, and we started the day with $82 a barrel. Since then, it is 6% on the higher side. So some bit of a loss is there. Well, remember, market has had 24 hours to digest in what is happening in Iran, and this is a measured stance. When we opened, it was a knee-jerk reaction. There were a lot of trade positions being opened and closed, but at this point in time, it seems kind of settled in the markets therein. This is an 8-month high that the crude prices are trading in at this point in time. And it's not just about crude oil prices, because when you talk about on what's happening in West Asia, it also is about Qatar and various other countries where gas also is a bit of a concern. So you have seen natural gas prices gain up by 10%. The gasoline prices also are up by 4%, trading at an 18-month highs in the Asian markets right now. Well, it's a couple of things that the street will market or monitor. One, of course, is the Strait of Hormuz. Now, shipping companies, while, of course, Iran has said that the Strait of Hormuz is open, but it really is about the insurance companies, which have told the shipping companies that they are looking to increase premium. In some instances, there are reports that the premium has been hiked by as high as 50%. And then apart from that, the insurance companies also have told shipping companies that they are cancelling policies if they take that route. So a lot of shipping companies seem to be rerouting or just waiting on the either side of Strait of Hormuz to cross through. So there is a lot of weight right now and no clarity really, and that is what is keeping the crude prices where they are. The second really is about Iran launching attacks and retaliatory attacks. This is on US assets in various neighboring countries, some 8 to 10 of that. That also is something that the street will continue to keep an eye on. When you look at Strait of Hormuz itself, it is an important area. 20% of the global crude passes through this. Iran exports 3% of global crude as well. So two things that the street will now keep an eye on is on whether or not Iran exports take a hit in any sense. And then it is about Strait of Hormuz, on whether or not we are able to find some clarity, some resolution onto that area as well, on whether or not the ships can pass through. At this point in time, we have most shipping companies suggesting that they will not be taking Strait of Hormuz. If it continues like that, if it gets prolonged, then you are looking at higher crude prices therein. There are major concerns as well in sense of longer shipping routes that many of these vessel companies will have to take, the disrupted and elongated supply chain as well, and then the rise in freight rates, risk of wider inflation are some of the factors that the markets are factoring in. Interestingly, when you look at the history in crude prices, it's not too many days that you see such a hike in case of crude oil prices. A hike as high as 13 to 15% has only happened 5 times till time as the record has been maintained. And today has been one of those days where we saw 13% of a jump up as soon as the markets opened there. Before that, it happened in 2019 that we saw nearly 14% of a gain coming in for the crude oil prices there. Interestingly, well, last 3 years, it was negative crude prices in 2022, 23 and 24 as well, 25 also for that matter. This year till time, we are already up by 23.5% in matter of 2 months, with markets anticipating that this is going to be a bullish year going forward from here. Another reason that you haven't seen crude prices run up is, one, it's the month of Feb and March, which is usually a low demand period. That is what is keeping the prices in check as well. Second, you have OPEC Plus announcing that the production hike of 200,000 barrels per day will happen from 1st of April. So you have crude supplies coming into the market. Also, when you look at the OPEC and allies, it also is about that if the need be, then they will increase exports as well, especially into the Asian markets, to China, etc. And that's yet another thing keeping the prices in check. Well, remember, it's a fluid situation, quite volatile as well, and that is something that could keep the crude prices, the war premium in the prices, much on the higher side.
Thank you very much for that. On the other side is our special segment, Indianomics. Lata speaks to MPC member Saugata Bhattacharya and Citi India's Samiran Chakraborty and Nomura Holdings Sonal Verma on the GDP series, the Gulf War and the Indian economy.
Hello and welcome to a special Indianomics given the special circumstances. Growth rate and inflation of the Indian economy has gotten a shake-up after the new CPI and GDP series were announced by the Ministry of Statistics. And now, with the war over Iran, which has impacted crude prices and shipping through the Strait of Hormuz, there are more changes expected. The new GDP series has led a few economists to raise India's GDP forecast for FY27 by about 10 basis points. I think Goldman Sachs did that. And it's made many economists lower the CPI forecast for next year again by 10-20 basis points. But the war may put some question marks over both growth and inflation, with crude prices already about 10% higher from last week. So how is the economy poised here on for FY27? I invite my elite panel of economists, Saugata Bhattacharya, an MPC member and economist, a senior fellow at the Centre for Policy Research, New Delhi, Samiran Chakraborty, chief economist at Citi India, and Sonal Verma, chief Asia economist at Nomura Holdings. Gentlemen and Sonal, thank you very much for your time. Samiran, I'll come to the war in just a bit since we have just begun parsing it. First, the GDP numbers. Some people have chosen to say that because the current year's GDP has been revised up from the earlier 7.4 to 7.6% in the new series, there is a move to revise it higher for FY27. Anything positive, any revisions from you?
Thanks, Lata, for having me. I don't think we have made any big changes to our FY27 forecasts on the GDP based on what we have heard on Friday. But there are two distinct things here. One is about the size of the GDP and how it has changed in the new series. And the other is about the growth rate of the GDP. So what we have witnessed is that the past size of GDP has been revised down by approximately 3%.
Yeah.
And what we have witnessed also is that the past growth rates have been brought down by, on an average, about 50 basis points. Yes. But more remarkably, the growth rates now appear over the last 4 years to be almost flat. So between kind of 7.1 to 7.6%, rather than the big ups and downs that we had seen in the growth rate in the old series. I think that's a very important point, that we have got a much stable growth path in the past and a much lower size of the GDP than we had estimated before. None of these make us change our growth forecast materially. However, I must say that there is a better growth momentum in the high-frequency data than what the markets would have anticipated even a month back. So to that extent, there is some logic in re-looking at all the growth indicators. But as you mentioned, there's now new headwinds developing, so we have to watch and find out to what extent they act against this momentum.
Fair point. Let me get Sonal Verma's view as well, and then go to Saugata, who is the policymaker in our group. Sonal, there are a couple of things in the new GDP series which look positive. Manufacturing is far, better. It is double digits if you look at the 3 years on average, 24, 25 and 26. Plus, private final consumption expenditure, which appeared to have slowed in the previous year, has now jumped back to 7.1% from, I think, 5.8 previous year. So both consumption from the expenditure side and manufacturing from the supply side seem to be good. Is there a scope that there is at least an upside risk to GDP numbers?
Yeah, Lata, I think there are two different sort of takeaways from the GDP number. One is what it's saying about where we are, and second is where we are coming from. So where we are, the numbers clearly suggest that there is strong momentum in the economy, and the high-frequency indicators essentially suggest that this momentum should continue. So for FY27, we are expecting GDP growth at 7.1%. 1%. So we do think cyclically things are going to improve. And as you said, manufacturing and certain private services segments growing in double digit was a clear positive. But I think, what the GDP numbers also say about where we are coming from is important. And the 3 to 4 percentage points downward revision in the nominal GDP was led by almost a 10 percentage points downward revision in the size of nominal private consumption expenditure on the demand side, and a 25% downward revision in the trade, hotel, transport, communication segment on the supply side. This is per annum. Now, this tends to be an informal, unorganized sector. What it is telling us is that the post-pandemic, recovery was much softer than one had anticipated. And I think if we map that with the benign core inflation prints we've seen for the last 2 years, I think that now sort of makes sense in hindsight that, the private consumption side was much softer. And I think it implies that the output gap was a bit more negative or at least less positive than estimated earlier. The second important implication is on what this means for the public debt to GDP ratio going forward, because if the size of the normal GDP is lower, then the debt to GDP gets 2 percentage points higher than what was anticipated earlier. So the 56% moves closer to 58% of GDP for FY26, which is the starting point. So if we still need to get to 50% plus minus by FY31, but the starting point is higher, then the speed of consolidation will need to be much faster. So I think that was also an important takeaway.
No, absolutely. In fact, even for the current year, if you have to meet 4.4%, I think, Samiran, you're pointing it out in your note, that you have to cut down expenditure by about 40,000 crore. Actually, I wanted to get some CPI numbers as well, but the policymakers with us. Saugato, in the CPI series, I should have allowed the economists to say that, but the broad view was that the CPI for FY27 has now gotten revised lower by the economists. It's not yet come from the Reserve Bank, obviously. That's because although food looks stronger, the whole weight of food is lower. Core is not as fiery or galloping as much as the old Reserve Bank, old series indicated. So does this make the overall approach to monetary policy somewhat more dovish, because inflation is not going to be the threat it was?
Well, first, thank you for having me on your show. Second, the entirety of the data from the GDP numbers, the CPI numbers that you're talking about, does seem to suggest that what we had understood, what Sonal was saying, that the amount of slack in the economy is probably a little bit more. We were working with a slack of around 5%, 6% compared to the pre-pandemic growth trajectory. Now it seems it's likely to be about 9-10% odd, which is exactly what is also probably showing up in the CPI print numbers. Having said this, I think from the overall tenor of the GDP numbers seems to suggest that the numbers that are captured is better, that potential growth, given the numbers that we have seen for the last 3 years, around 7% odd, 7% plus. And the fact that we are still not seeing any signs of any overheating in the economy seems to suggest that potential growth is actually up now to 7% odd. So all of this. Having said all of this, I still think that we are in a relatively good position as far as monetary policy goes. It's right, it's appropriate at this point in time. And going forward, I mean, whatever data comes in will guide policy.
Yeah, of course, data can change given the war over the weekend. And the combined wisdom right now is that it may not be a prolonged one. But I'm not the expert on that. Samiran, let me come to another question which our current viewers will be very interested in. One message from the GDP numbers, revised numbers, is all the past 3 years were very strong. I mean, they were above 7%, which was not our past 20-year run rate of GDP. It was more like 6.5% if you took an average. The past 3 years, it is 7.2, 7.1, 7.6. But we don't see it in the corporate numbers. Corporate numbers for the last 6 quarters ending September, actually even the one ending December, the Nifty earnings are single digits, often mid-single digits or low single digits. Why this dichotomy? If the growth, as Saugato says, potential growth looks stronger, why are corporate earnings lagging?
So it's a very involved question and probably requires much more research to substantiate what I'm saying here. But there could be 2-3 different reasons for this. One is that we are seeing in some sort of data that the proportion of consumption expenditure that goes towards services, that has been significantly going up compared to goods. And typically the earnings data that you are talking of has some sort of a bias towards goods economy than towards the services economy. The second aspect could be between the large listed players versus the unlisted players. In several sectors, we are seeing that significant unlisted players are gaining market share. And to that extent, that gets captured in the GDP data, but does not get captured in the earnings data could be another reason. And the third is that there is this, in the last at least 1.5 years or so, the rural economy has done better than the urban economy. That's the standard hypothesis. In that sort of a situation also, there is a possibility that the company earnings data does not pick that up very quickly. It's more comes in the GDP data. Although I must say that we were surprised that the entire agricultural GDP growth has been much weaker than in the series than what we had probably thought of. But rural demand is different from agriculture, not just agriculture. So that could be one of the factors. But on a lighter note, I think the point that was really interesting to me was that despite this extremely flat GDP growth for last 4 years, we have seen a 250 basis point hike by RBI and then another 125 basis point cut by RBI also within the same period. This correlated well with the earlier GDP data, but does not correlate that well with the current GDP data.
Oh, excellent point, Samir. I have to remind you of what Y.V. Reddy told us, that central bankers like Saugato are always faced with uncertainty about the future. But in India, they are faced with uncertainty about the past also. So perhaps that's what's hurting. Very quickly, Sonal Verma, before I take my first break, the war. How does that fit in? Do you think, we may be forced to up our inflation numbers and down our growth numbers because of what is a spreading war?
No, I don't think we are at that stage, Lata. I think one is just we need to see the duration of this conflict and what it means for oil prices on a more sustained basis. But second, importantly, oil prices are also regulated at pump level. And therefore, the impact will be seen more in terms of the profit margins of OMCs. Fair. And of course, we'll see the impact on the current account, but the inflation pass-through and therefore the growth impact, I think, does not look to be that material at this stage. So it's more of a wait and watch for now.
Okay, fair point. Oil prices regulated in India and therefore this one-to-one correspondence doesn't work, though at the moment even shipping lines are impacted. So perhaps there could be some price rise in other things. Many more questions to my guests. We have to take a break. We'll be back. Bazaar viewers, you will get to watch the whole show after market hours.
Well, hello and welcome to Chartbusters. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel, with me is Vinny. And the markets, though under pressure, have recovered a little bit from the lows of the day. The obvious trade was to go ahead and buy the dip. That's played out to some extent, but just keep an eye out because there'll still be some leverage positions that'll be getting knocked out in the next 60 to around 90 minutes or thereabouts. So keep that in mind. Hey, Vinny, what's up?
Hi, Nigel. So yes, we'll keep an eye out on that. What happens in the 60 to 90 minutes next? That'll be key to watch out for. As of now, 24,870 is what the Nifty is at. But let's welcome on board Nalin Kant, who's of Automotive Division of Mahindra & Mahindra and Executive Director at Mahindra Electric Automobiles as well, to discuss the auto sales numbers. Hi, good morning. Thank you so much for joining in. You managed to report a good number, inline set of numbers with what the street was expecting as well. While obviously you have the support coming in because of GST, February sales were good. How is the demand trend expected to be?
Firstly, Nigel and Vinny, thank you for having me on the show. Strong month, if you ask me, and 19% growth on the SUV front. Compared to the industry of about 18% SUV growth, I think they've out-tracked. I think the piece which is even more heartening for us is from a Vahan registrations perspective, which tracks end user or end customer demand itself, that grew at about 21.4% year on year. So that gives us strong confidence that the portfolio has strong traction with the market. And of course, beyond the GST, there's a couple of major launches we had done in the previous quarter and in Jan as well. 7XO on the ICE side and we had 9S on the EV side. Both these products have gotten very strong customer reception, and that's helped us with February bookings as well and billing as well.
Hi, Nalini Kant. Good to see you, Ben. Quick word before we get to the demand trends. There was an Indonesian order. I think you're back to 35,000 units of Scorpio pickup, to an Indonesian company. And there were some doubts with regard to that. Any doubts? That order's on, right?
Yeah, we've started shipping vehicles to Indonesia. In fact, the first set of vehicles have already reached, and we continue to deliver on the order that we have. There's no update beyond that at this point in time from our side.
The size of the order as well, we understand it was 35,000 units. It hasn't been scaled down or anything, right?
Yes, that's correct.
Not scaled down.
Like I said, we're delivering to the 35,000 units. Yes, absolutely.
Okay, got it. All right, let's talk about the EV volumes then. I think they were around 4 to around 5,000 units, and you were talking about it scaling up. What was it in the past month, and how do you see it pan out, say, in March? Because I think February would be a shortened month, but in March, you'll see a bit of an uptick?
Yeah, no, absolutely. And even in Feb, if you look at it, you're right, it was a short month. But from an overall volumes perspective, EVs, we actually delivered north of 6,500 vehicles. So the first time we've actually crossed the 6,000 mark on these vehicles as well. So even in a shorter month, I think it's done well. Look forward to a strong March as well. And of course, 9ers would be a backbone of that. But we continue to see good traction on 9E and BE6 as well. And in the 9E, we've actually introduced a new couple of variants we announced it yesterday as well. So we're hoping that that starts to give some heft to the overall number. If you see past 1 year, volume has been in the 4,000 to 5,000 range. Our capacity is 5,000. We are scaling up that capacity to 8,000 by April. So with 9S coming in, we are hoping that that 8,000 capacity will be largely utilized as well.
Okay, so you're expecting 8,000 capacity. We'll start seeing this in Q1 FY27 then, right? The 8,000 you all have spoken about, even for EV units. So then from April onwards, we could see these numbers coming in for 8,000, 9,000 units of EVs, right?
8,000 of capacity, we normally utilize about 80% of capacity. So you should expect us to be around the 7,000 mark in terms of volume, 6,500 to 7,000, which we already started to scale up to, right? Feb is at 6,500. We are hoping we'll inch up from there.
And then when do you expect it to reach 8,000, 9,000 units, right? Because I believe when we had spoken to Mr. Anish Shah, he had spoken about it at one point of time, reaching that 8,000, 9,000. Would it be in FY27 itself?
Yeah, so we have a bunch of launches coming in later part of F27 and early part of F28 on the EV space. So that's probably the right time for scale up. Like I said, our line itself is ready for about 10,000 units, and we operationalize incrementally as new launches come in as well. That's an easier way of doing it. So that's what Anish was probably referring to at that point.
Okay, all right. Final question before we let you go. The feedback you're getting is that the CV cycle is in very, very fine rhythm. What part of the CV cycle are we in? Because a lot of ancillary stocks as well are doing well. A lot of them are talking about they've been totally booked out, and CV is showing traction. So according to you, where are we in that CV boom cycle? Middle, end, start? What do you think?
No, I would say that in the early days, if you ask me, and Nigel, the replacement cycle is definitely well underway at this point in time. But the heartening news is beyond just the replacement cycle, we are also seeing the first-time buyers, what we would call the driver segment, folks who have been driving a CV and eventually wanting to buy their first commercial vehicle. That segment has started to kick in as well. So that's a great sign for us. So it's replacement cycle plus new customers coming into the fold. So I would say it's early days for us in the cycle. Normally, a cycle lasts about 12 to 18 months. So we'll see how it plays out. But we're quite sanguine on this segment right now.
Beautiful.
Just one question I want to know, given the current geopolitical tensions that are going on across the globe, any concerns on export fronts or any blips that one could expect to see then?
Specifically to the Middle East, we have very limited exposure from an exports perspective, volume itself. We are largely in South Africa, Australia, and South Asia markets, so we don't necessarily see a big risk from a volume perspective from that side.
Okay, no, not much of a risk, but in case, there is any stoppage in terms of Red Sea, Strait of Hormuz, as of now it is not. But would that then cause any concern for you all, or nothing on that front affects you all?
Early days to see how that plays out. It can play out in multiple different ways, but we have had challenges in the Red Sea in the past as well. We've had some geopolitical tensions in different ways and forms earlier. So we'll watch it very closely and we'll take decisions as we go through. But at this point in time, very early to say if there's any kind of disruption coming out of it.
Okay. Thank you so much, Nalinikant, for joining us this morning, speaking to us about the numbers. Hope to see you again next month as well, after you report the next numbers. Thank you so much for that. But on that note, we're going to slip into a very short break. We'll be joined by the management of CleanMax Enviro Energy Solutions. Kuldeep Jain will be joining us, and this is after the listing. Stay tuned in for that conversation.
Global markets in a bit of a tizzy, and so is the Nifty as well as the Nifty Bank. The good news is both the Nifty and the Nifty Bank have come off a little bit from the lows of the day. And by the end of today, you'll actually not want to revisit those lows that we saw in the first few minutes itself. From the Nifty, the problem is a couple of big names like L&T, they're dragging the index. In fact, L&T is one of the top losers, down close to around 4.5 to around 5%. Giving it company on the downside is Interglobe Aviation, because obviously flights are cancelled, and also you have fuel costs that have spiked up, so and that could hurt them as well. Adani Enterprises, that's the other stock that's part of the losers list. On the flip side, defense is going to be top of mind now, going by the geopolitical tensions. And BEL, one of the top gainers on the Nifty, Hindalco as well is giving it company on the upside. But it's not just BEL that's higher. Defense buzzers in trade today include the likes of Solar Industries. It's been a wealth creator over the last few years, and that one's up close to around 4%. Bharat Dynamics actually off late has been an underperformer, but that's participating today as well. In times of uncertainty, a lot of money moves to gold as well as silver. And from the stock market perspective, you have Hindustan Zinc, that's the lone silver play out there. Muthoot Finance, that's a gold financer as well, so that's a play on gold prices. And MCX, because there is some fundamental news as well as volumes on gold will move up. In turn, they will earn some more money. So all those three doing well in trade. But otherwise, from the broader markets, there are plenty of stocks that actually started off in the red, and they've seen a big recovery from the lows. Case in point being a Tejas Network. The stock is up close to 50% just in the last 1 month or so. Fino Payments Bank, there's negative news flow, but the stock is still up close to around 8% from the lows of the day. And Sarda Energy as well. We've got the Supreme Court verdict that came in their favor. That one is up close to around 5% from the lows of the day. So plenty of action from the broader markets. By the end of today, the number of stocks advancing. You'd like to see the number around 6 to around 700 odd. Remember, the start of today, it was just around 100 or thereabouts. Vinny, coming back to you.
Thanks so much for that, Nigel. Surely watch out for that advanced decline ratio and where it's going to be headed. But we have the next management on the show today joining us right now. That's CleanMax Enviro Energy Solutions. Saw a bit of a muted listing today, but given the market condition, 9% discount is what it listed at to its issue price. To talk about the outlook of the company going forward, we have Kuldeep Jain, founder and managing director, joining us right now to discuss the business and growth going forward. Kuldeep, good morning. Thank you so much for joining us, and congratulations on getting listed. But let's get started with some bit of a numbers, right? Now, finally listed, so you can give us some idea in terms of what we could expect. Let's start with the EBITDA performance, right? For H1 FY26, when you've seen in terms of EBITDA, your EBITDA margins have come in at 68.4% versus a 72% last year for the first half of the year 25. What is the run rate that one could expect from the business in terms of margins, FY26, FY27? Any indication you could give us on that front?
Thank you, guys. And we are delighted to be listed today on the stock exchanges. In our business, we add about 1,500 megawatt of solar and wind capacity every year and sell the energy so produced to corporate customers, which we are very well on track to do. We don't issue EBITDA guidances, but we've historically been a 58% annual growth rate on EBITDA kind of business. And as of October 25, we had about 6,000 megawatt contracted, but of which only half is built and half more is under construction. So lots of growth still to come.
Okay. Hi, Kuldeep. Good morning. Good to see you in a bit of a tricky one, right? Not the best day to get listed, but it's been a journey for you as well as the team in terms of coming so far. Markets today not obliging, but your investors will be interested in creating wealth over the longer term. What's this backstory with regard to this jacket that you're wearing?
Thanks, Nigel. Thank you for asking. I wanted to not stand alone at the NSE platform while doing it. So I got a jacket made with all 600 of CleanMax employees on it. So you can actually see everyone. I wanted to make myself feel and make my team feel that, we are all in it together. So that's the jacket that I'm wearing.
Okay, interesting. Oh.
And I'm still at the National Stock Exchange. So that's the jacket we got made for this. Thank you.
All right, good.
So it's just the individuals of CleanMax.
It's a team effort then. And, nice to see, you're actually wearing them on this big day. Let's talk about a couple of aspects then. What about business? For the last year, if I look at it, your EBITDA number was ballpark around 1,000 crores. I know you don't give us a guidance, but, in the previous 2 years, if I look at it, your EBITDA doubled in 2 years. From around 400 crores, it went to around 1,000 crores.
That's right.
In the next 3 years, there's a probability that this EBITDA number doubles?
Yeah, and absolutely there is, Nigel, because if you look at our business, 3,000 megawatt is built and another 3,000 megawatt is under construction, which will happen in the next 2 years. So therefore, just by those simple metrics, that doubling kind of number makes a lot of sense. And what we see also is that we've had a huge boom in our customer offtake from data and AI as a segment. And data and AI is today already about 43% of our contracted volumes, with all the data centers in India as well as with all the big tech giants. And we, given the global mega trends in data and AI, we see a lot of good prospects for that line as well.
Sure. Kuldeep, a quick one. What's your plan in terms of debt reduction strategy? Some of the amount that you've raised will be paid towards debt. So how much will be left on the books, and cash and cash equivalent also? What are you looking out for, or what can we expect by the end of FY26 here today?
So we are repaying about 1125 crores of debt out of the 1250 crores of primary proceeds, which will lower our debt to EBITDA ratio, but our net debt to EBITDA is already at about 4.6. For the rest of the renewable energy industry, that number is closer to about 5.5 to 6 times. So we are in any case more conservatively geared compared to the rest of renewable energy industry, and we will repay some of that debt.
Okay, all right, Kuldeep, we look forward to having a longer chat with you as well as the team, but congratulations to all of you all. Like the idea with regard to the jacket, but the street will be looking forward to better numbers in the time to come. Initially, the stock is down, but delivery of those numbers that you're talking about will be top of mind. Well, time to slip into a short break. We have another management waiting for us. KEC is waiting for us on the other side to give us a broad sense in terms of their exposure to the Middle East amidst the conflict.
You want to talk business? Meet me in the On-Board Lounge.
Welcome back. You're watching Chartbusters. You're on CNBC TV 18. As promised, let's get in Mr. Vimal Kejriwal, the MD and CEO at KEC International, that joins us on the show. Hi, Mr. Kejriwal. Good morning.
Hi, Nigel. Good morning.
Thanks a lot for joining in, sir. Before we get to business aspects, just wanted to ask you about your employees that you have in Middle East. Hope all well and everyone is safe.
Absolutely safe. Thank you. All are well.
Well, that's good to hear, because the human aspect first is what we would like to focus on. Let's talk a little bit about business then. I believe 20% of your business has exposure to the Middle East. Could you tell us what are the conversations in the last 40 hours or so with your customers? Is work functioning as normal, or has there been a bit of a standstill, just temporary?
So basically, if you look at our exposure in Middle East, we have around order book of around 10,000 crores, which is roughly 20-25% of our overall order book. And it's 50% of that is in Saudi, and the rest is divided between UAE, Oman, Kuwait, and a little bit of inter-Emirates work. So that's a part of the order book which we have. As far as today the situation is, UAE is completely shut down. It's based on what is happening in the local scenario and the advisory from the local government. We have shut down all work on the projects, and also the factories right now not working. But the rest of the places like Saudi, Oman, etc., the work is going on as usual. So there's no stoppage or nothing else is happening on the rest of the Middle East, if I can say that.
Okay, so Saudi, Oman, where your business continues to be as usual, and the impact that has come in terms of the halt of the factory that you've spoken about, what would that be in Q4 that we could see, sir?
Honestly, too early to say. It depends on when we start. Otherwise, if you look at the revenue, it will be around 50-60 crores per month is the revenue. I think we do around 600 crores and odd from that factory. So 50 crores is a monthly revenue. So depending upon how many days it is shut down and what happens, it's been shut now for, I think, last 2-3 shifts. So, as of now, I don't think it's a significant, but if the shutdown continues for a long time, then maximum is 50 crores for a month if it's shut down for the entire month.
Okay. So 50 crores if it's shut for the entire month is maybe, if it's shut for the entire month, that you can see.
Yeah.
Okay.
Yeah.
And so as of now, no advisory coming in on Saudi Oman front as well, because that is also there in the line of fire. So right now, what is the situation there? You said it's all working, but any advisory or steps that you all have to take?
Right now, no. Actually, on the first day when it happened, we shut down some of our projects on the eastern border of Saudi. Okay. But then there was nothing which was happening. And then we spoke to the client and everything, and they said there's everything normal. So Saudi is completely normal. UAE, obviously, first day the factories and all were working. But then UAE has now issued an advisory of, work from home and other things. So basically, and they said you should avoid being in the public areas, etc. So because of that, and also keeping in mind the safety of the people with, missile parts falling, etc., we decided to, shut down our UAE operations.
Right, sir. Thank you so much, sir, for joining us this morning, just giving us an understanding on what is happening on ground over there as well. And we would request you to join in again with more updates as and when anything comes in. But thank you so much, sir, and hope your team stays safe there as well. Thank you so much for joining in. So that was the management of KEC International, giving us an update in terms of what's happening in terms of West Asia and the updates over there. As of now, UAE side, they've shut the operations. Oman, Saudi continues to be there.
That's right. Vinny, in terms of the markets, we are down. But, the news flow that's coming in from the Middle East is not very, very encouraging in the last hour or so. Hopefully, things settle down. But as of now, no signs of any big de-escalation. So I'll be looking forward from a humanitarian aspect that we see some kind of de-escalation in the Middle East. But that's actually absent. For the time being, we leave you with the markets down close to around 300 points on the Nifty Bank down close to around 500 points, and just around 400 stocks that are advancing. Chartbusters wraps up, but Trading Hour comes up next.
You're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu. With me, Hormaz Fatakia. This morning, the indices were expected to open lower given the geopolitical uncertainty. They opened lower, far lower, and thereafter there was a bit of a recovery from the lows. And that recovery has swiftly been sold into as well. Back to that 24,850 sort of mark. Between 24,800 and 24,850 is where the lower end of today's trading range has been so far, and that's where the market has been flitting. The bigger story today has been the broader market. If you look at it, over 2,100 stocks which are in the red for less than 500 stocks which are in the green. And that will tell you the widening gap between the gainers and the losers in your portfolio, which tells you that if you're looking at it right now, it's a deep shade of red ahead of Holi as there is global uncertainty. Hormaz.
Hi, Mangalam. And only fair, you do not want to go into a holiday with positions, especially in a scenario that is developing every passing minute. And there is, of course, as of now, no signs of de-escalation, with Iran having rejected any proposal of talks with the US. So as of now, a 300-point cut on the index, and at very key levels at 24,850. That's what the analysts were projecting if the 25,000 level gets taken out on the downside. But there are a couple of pockets that are doing well. One of them, of course, being the defense names. They are the ones that are soaring higher. Solar industry is doing well for itself. Now, the smaller defense names, be it Paras Defense, be it Idea Forge, both of them seeing double-digit gains now. Paras Defense is up 12, the Idea Forge is up 11. So they are doing well. And the only other sectoral index until just a few minutes back was the metals index, but the recovery in the metal stocks has also been sold into, and most of the metal names now have sold off. At least they are off the highs of the day, even if they haven't sold off. Hindustan Copper still up 2, Hindustan Zinc is up 1.5%, but otherwise most of the others deep shade of red, as Mangalam was highlighting. The top loser on the Nifty is Larsen & Toubro, of course, a 5% cut on LNT. But the big talking point as a consequence of what has been transpiring in the Middle East has been the surge in oil prices, and that's because of these tensions. Let's go across to Manisha to get us all that is happening in this space. Manisha.
Well, thank you so much for that, Hormuz. The markets have had 24 hours to digest this, and is the reason that even as we saw the crude oil prices gain up by 13%, we have seen them ease down a bit right now. There are 4 or 5 things that the street will watch out for at this point in time. One is Iran itself. Remember, it exports nearly 3% of global consumption. What really happens to that? What do those numbers look like? Second is Strait of Hormuz, and 20% of global crude passes through this one. And as of now, we do understand that Iran has not shut Strait of Hormuz, but it is the insurance companies which have hiked premium somewhere as high as 50% as well. And there have been reports of cancelling policies for some of these shipping companies also. So this is what really seems to be bothering crude prices. The third thing really is about Iran retaliating on various neighboring countries. Until now, we do understand that none of the oil facilities has been hit, but that continues to be a concern as well. And the fourth point really is about the OPEC and allies increasing production by 200,000 barrels per day starting 1st of April. And then comes India, and this is the most important point, because India imports more than 80% of its crude requirement, and nearly 40% of that flows from Strait of Hormuz. So are we looking at disrupted supply chains? Are we looking at longer routes? Is something that the street will look at. What you have on your screens right now is the times that crude has given you great strong gains in a matter of just a single day. So it really has been 5 or 6 times in the history of crude that you have seen 14-15% of a jump up with what the crude opens it, and today is one of those days. And remember, after 3 years of constant declines, this has been a year that crude is trading in positive. So 2 months of this year, and we already are 23% higher in case of crude prices. But joining us now is Richard Regalia. He's CEO of Matrix Global, for his sense on the space. Richard, hi, thank you so much for joining in. Your initial reaction, first of all, on what really has conspired over the weekend and the kind of statements that we continue to hear, that this is not the end and this is a fluid situation, just perhaps may continue in the weeks to come. How are you reading it all, first of all?
This is a very fluid situation. In my mind, this is a situation that is equal to the fall of the Berlin Wall. This is something that can have ramifications going on over the next decade or two. This is not a Middle East war. This is a Middle East regime change of trying to remove the largest state sponsor of terrorism in the region, and has been a thorn in the side of many players in the area. I saw your statistics on price. It was very interesting. The price was up 14%, but now the price is up about 6.5%. Many of the reasons of why the market reacts so quickly now is information technology. Realize that right now around the Gulf of Hormuz, I think you made a point that Iran says they haven't closed the strait, but the insurance companies have raised rates so high that people do not want to take chances while this war is very live. And so what that means is all these cargoes and all these ships are sitting offshore. But historically, they would sit offshore and we didn't know where they were. Now technology shows us where every single cargo is, which direction they're doing, which way they're turning. And so the technology allows us now to make real-time decisions on what is actually happening. The reason I think this is important is there's many parts to this, but the real key is that we're losing up. We're not losing. We are putting pressure on a partner that has caused significant strife, not only in the sense of the terrorism and issues around that, but also within OPEC itself. And so I think what we're seeing right now is a market reaction. It reacted up to $75.33. It's now trading $72. Remember, I was on your show back in June of last year, where the market went up to in one case went up to $81 during the IDF attack, and then went up to $78 the following 2 weeks when the U.S. took out the Iranian nuclear facilities. The market has learned. It learns that there's plenty of barrels in the marketplace, and so while there is a reaction, there is no longer an overreaction.
Richard, I want to present to you with three scenarios, and do let know on how the crude prices will react to that. One, the Iran exports itself. If that completely shuts down, even for a few days, what would that mean for the crude prices and the global supplies? The second is about Strait of Hormuz itself. As of now, we understand it's about the insurance companies and where the tankers are, but we do know that there is no movement there. So if that is prolonged, what do you think on where the crude prices can head then in these two different situations?
Okay, in the first case, here's something interesting. I mentioned this again a year ago. The one thing that sits in the middle of the Persian Gulf is Karg Island. 90% of all Iranian crude oil leaves from Karg Island. Karg Island has not been attacked. Why has Karg Island not been attacked? It has not been attacked because the powers that are directing their forces against the Iranian government is that they want a new Iranian society. And that society is going to need oil. And so I think everyone should find it pretty interesting that while they attack every other missile source and every other military aspect of Iran, they're leaving the #1 lifeblood of their export facility alone. And so let's put that off to the side. You said Iran produces 2.5 to 3 million barrels a day. Now remember, they produce 2.5, 3 million barrels a day. They only export about 1.5 million barrels of that. And so there will be some problems here in the short term. I believe that some of those barrels will be taken up by Saudis and others. India will suffer a little bit here, I think. It's important to think that they are a huge importer of crude from the Persian Gulf. And also remember, oil is not just crude, it's products. And so while we talk about crude prices being up $7, $8, product prices in a barrel, let's use distillate prices because that's the #1 fuel used in the world. Distillate prices were around 106 barrels last week. Today they're 119 barrels. So while crude's gone up about $9 and come down around $4, the distillate prices have gone up about $17 and are currently up around $13. And so I think what we're faced with right now is a market that is assessing the situation. It realizes there are extra crude oil barrels in the marketplace. We're going to have to wait and see how this thing plays out. I believe we're going to see hostilities last for a few. Well, again, what do I know? But I would think we'll see if hostilities last for another bit of time. Will we see barrels start to move through Strait of Hormuz? Probably. Okay. Probably.
I also want to get in your best case and a worst case scenario in sense of prices right now, but there are so many reports flying around talking about 100 and 120 and 40. I mean, a lot of numbers out there. So when you take in account all various situations that we are in currently, what's your sense on prices then?
think I say this every time I come on. I think they're going lower. Remember last time we thought that the market would trade from 78 down to 55. It got down to $55 in price. It started to find some support in there. OPEC Plus came out and said they were going to stop increasing production at the beginning of this year. They were increasing production on a regular basis, and the market got up to around 63, 64. And then the U.S. put its entire military into the Persian Gulf. So everyone removed their short positions, and the market started to drift higher. And now we've culminated in this move here. What's interesting, what do you think the price is in WTI in December of this year? It is $65.20. So it's not what I think about where the price is going. It's what does the market think where the price is going? And we're in a situation where there's some tightness in the market currently. You're right. If barrels don't move through the Strait of Hormuz, we will see that tightness increase, and that'll probably get the price up, maybe back up to the high we saw today, around $75, $76. Even possible to get to $80 if this conflict lasts for, say, more than a month or so. We'll see a larger drawdown of inventories. But once the dust settles and we look forward, where are the forward prices? And the forward prices are a significant discount to where they are now. When you mention $100 to $120, I would think that would have to be a catastrophe that we can't even fathom right now. I don't think we're in that situation in any scenario except a horrible one. I would tend to believe this time next year our prices will be probably back 60 or even below $60.
All right, we take that point. Thanks a lot for joining in and giving us a perspective on that. Brent now closer to 78, but were things to de-escalate from here on, you would see a sharp decline from here on as well. Manisha, thank you for taking us through that conversation. The Nifty is still about 330 points lower. We'll take a short break, come back on the other side. We'll take note of the impact that this could have on some of the exporters amid a lot of uncertainty that there is. Maybe the US tariff situation right now, the geopolitical situation, the shipping lines which may be extended because of the Strait of Hormuz, and whether there could be any adverse impact on the recently reduced RODTEP benefits as well. Dinesh Nolka of Nitin Spinners joins in to discuss a whole host of things, a conversation you don't want to miss. Welcome back. Oil and gas players all in focus right now. The upstream companies doing well, whereas the downstream ones are feeling the heat right now. We've spoken about the oil and gas space, the geopolitical uncertainty. What kind of impact would it have on some of the exporters? Dinesh Nolka, who's the chairman and managing director, Nitin Spinners joins in. Obviously, we'll be talking about the impact of West Asia tensions, whether there could be some shipping delays, etc., on account of that. And then, obviously, all of this comes at a time when there is the India-US trade deal, the status check on that. Especially after the 18% negotiation that was made, and then the Supreme Court developments that happened, and then we had the impact of RoDTEP changes on the textile space as well. So a whole host of topics to discuss with Mr. Nolka. Obviously, he's been traveling lately. Mr. Nolka, let's start with the issue at hand right now. The impact that there is on West Asia. We were speaking to a few corporates. They said that a lot of the orders that were placed last week, as recently as last week, have now been placed on hold because of the transport-related uncertainty. Have you felt the same? Orders going to Europe, orders going to US. How much of that travels via affected areas right now, and how much of that has seen a big increase in shipping prices?
For us, actually, there is no major impact of this particular East Asian tensions. Because most of our goods already 6 months back have started to move from the Cape of Good Hope. So already the transit times have been increased, and all these bulk commodities like cotton yarn and textiles were moving, already transit times were changed. So we were expecting that once this settles down, then the transit time again will be back to 3 weeks, which has increased to about 5 weeks, right? So as such, it will not have any impact for US as well as European shipments.
And no orders have been withdrawn because of this uncertainty, right?
So, for us, there is negligible exposure in West Asia. So no such issues. And also for Europe and the US, there has been no such information to us.
Right. And just to complete the loop on that, you said that 6 months ago, all your products were routed through the Cape of Good Hope already. But now with the worries that the Strait of Hormuz will be, impacted, and as a result of which the shipping rates around the Cape of Good Hope would increase. Could there be a little bit of a risk there?
Yeah, definitely. In that case, the cost increases. So there will be more shipments going towards that side. So slight impact could be felt on that side also.
And that would be passed through, right?
Yes, of course. That is normally passed through. Normally the shipments are on FOB basis, and all these costs are factored in accordingly in the final prices. So normally it is passed through.
Mr. Nolka, the other bit that has been a talking point for you all beyond the status check of the India-US trade deal has been the new RoDTEP changes and the 50% reduction in the RoDTEP rates that have been put in place. How does that impact you as a company?
I think this is really unfortunate to have this kind of RoDTEP reduction. We have been representing to the government of India, Ministry of Commerce, that this should have not been done, and in such uncertain and volatile times, this should have been kept as it is. Rather, we were expecting some increase in the incentives to us. However, all said and done, we have exports of about more than 60%. So an average impact is about 1.4 to 1.5% of our exports. So on the EBITDA level, the impact will be about 0.85 to 0.9% for us.
All right, 0.85 to 0.9%. You did say that, you are making a representation to the government. Is there a possibility of this being reversed? I mean, the industry is speaking to them, but have you heard anything from them?
Yeah, actually, what has been said that there was this year the budget went short. So that's why this is a temporary measure, and they are expecting it to revise it back to the normal levels from the next financial year. This is what we have been hearing from the sources. So we expect that this takes faster. With this new development happening recently last weekend, I think it's more volatile times, and this kind of support from the government is expected, that they will keep the rates as it is.
Just to make it clear, Mr. Nolka, by next financial year, you mean FY27, right? Or FY28, because you're already on the cusp of FY27.
For us, it is FY27 starting from April 26.
All right. So 0.8 to 0.9% impact on your EBITDA because of this, and you believe that this could be reversed starting the next financial year. So probably a a concern averted as of now. Even though it is a concern, it is limited for players like you. Similar is the case with what's happening in West Asia. Your exposure is limited, and any sort of increase in shipping costs also would be passed through. Let's talk about the other part now, India-US trade deal. I mean, it was negotiated at 18%. It could have been a benefit for all of you guys that there would be certainty, but we're far from there. Thereafter, there was the Supreme Court order that came to about 10%. Then Donald Trump posted was 15%. Amidst all of this, there is this tension which is taking place already. So seems like what was just 4 or 5 days ago seems like months ago because of all these tensions that have happened in the middle. So where do we stand on the India-US trade deal?
So basically, what has happened over here is that we are back to the same levels as we were in the July of last year. In July, the rates for most of the exporting nations to US was at par at 10%, and then it went at different levels from August onwards. So I think during that particular period, the Indian textile industry has lost a lot of orders, and new orders were not forthcoming, and we were just trying to meet the ends. I think we are back to the similar level. We are back to the levels what we were in 24 and 25. Yes, we were expecting that we will have major gains going forward because of the advantage in the duties, in the tariffs. So that has not come forward. But we are still hopeful that since Indian government is still under trade BTA with the US, if something favorable comes up, because it is expected that US will give some tariff concessions to the labor-oriented industries. So I think we should be one of them, and we expect something better to come out of the trade negotiations.
Right. One final question, Mr. Nolka, actually multiple ones. Firstly, have there been new orders forthcoming as of now, since you mentioned that the industry lost a lot of orders? B, have you looked at expanding into newer geographies? And lastly, with all of this that is currently transpiring, what kind of growth rates do you see for this year? What do you end FY26 at? And what are you projecting for FY27 as well on the top line and the margin front?
Now, first of all, for the new orders, there has been, again, discussions have started. Earlier, everybody was waiting for the trade deal to happen. So already discussions in the US market with the customers of our various suppliers have already started. Also, for the European countries, since we are going to enter into FTA, a lot of activity is also there. So it is not that we do not get the order on a daily basis, but when we discuss with the long-term order books, we have to continue to engage with them, and that process has already started. And looking forward, that we are expecting to have much better order book situations going forward from the US as well as from Europe. Your second question was regarding the newer geographies. Of course, when the orders from the US and Europe dried down, we tried to go into the newer geographies, like in African continent, Latin American continent, and also to various Asian countries. So that has paid some good dividends to us, and we were able to maintain our exports as well as our turnover revenue rates as well. And capacities were fully utilized also during that period. So going forward, once all these markets open, we will have a much better opportunity, and we'll have better pricing power going forward. Regarding growth in capacities and as well as on the turnover side, I think this year, because of the lower prices of the raw materials, the finished goods prices have also come down. And because of that, our top line will be maybe 3 to 4% lesser than the last year. But however, going forward, we have embarked upon a expansion of our capacities, where we are expanding our fabric capacities as well as our spinning capacities, which will start to come on board in the second half of next year. So that should give us a good trajectory in the top line as well going forward.
All right, Mr. Nolka, thank you so much for sparing time and joining us today. Wish you good luck for the forthcoming year as well. We'll take a short break. The Nifty now down 350, heading back towards that 24,800 mark now on the downside, nearing the lowest point of the day. The Sensex down 1150 as of now. The recovery that you saw intraday has been very swiftly sold into. Take a short break. A quick chart check with Rajesh Palvia of Axis Securities on the other side, along with some top trading ideas as well. Stay tuned.
This is worth sharing.
Faster Wi-Fi on the new Emirates A350.
The market has extended its fall right now, currently at the lower end of the range. Nifty on the verge of breaking that 24,800 mark. In fact, as we speak, the Bank Nifty is down by about 720 points as well. The mid-caps have it even worse, 1.5% lower, 2,500 stocks in the red for a few hundred stocks which are in the green, 422 to be precise. This is on the NSE, and that exactly is what the F&O update is right now. We're at the low point of trade, back near that 24,800 mark with 46 Nifty stocks in the red. The India VIX has shown the massive spike that the street was anticipating. It opened with a 10% up move, and now moving towards that 16 mark with a 16.5% jump, telling you that there is still a fair amount of uncertainty, fear, and as the market progresses towards close, tomorrow is a holiday, remember, and towards the end we will also have the weekly options expiry that plays out, which has been preponed because of the expiry, because of the holy holiday tomorrow. So we have the gainers in the form of defense names, some of these upstream oil companies. Those two are pairing gains because ONGC is up 1.1% off the highs. Oil India just marginally in the green. Even the defense names, they're marginally in the green. The ones which have fallen have fallen a lot more. The only thing that we have to monitor now is ahead of expiry, what happens to these put writers who've taken positions at the 24,800 mark on the short side. Nearly 2.5 crore shares written for a premium of almost 50 to 60 rupees, telling you that they expect support to play out between 24,750 to 24,800. Were the markets to decline further from here on, all these 2.7 crore, writers of the 24,800 put will have to unwind their positions, and that can cause a bigger gash, maybe on the way down, where we would perhaps test the budget day lows of the market as well. But that is only so long as the market, does not break the 24,750 mark. On the way up, call writers are fairly active. 25,000 call, 25,900, 24,900 call. All these ones, I've seen a fair amount of writing telling you every bounce from here on up until expiry, until we sustain and see short covering, could see supply. And that's exactly the situation which is playing out right now, Hormaz.
Indeed, and we just briefly slipped below the 24,800 mark, as Mangalam was also highlighting cues from the FNO space right now. So 370 points lower on the index, fighting to hold that 24,800 mark. 46 stocks on the Nifty trading with losses. Time for a quick chart check. Rajesh Palvia of Axis Securities is joining in with the same. Rajesh, good morning. Thank you for joining in. Now that we are below 25,000, now that we are below 24,850 as well, do you see that there is room to move back towards the budget day low, which was 24,571? Or do you see a bit of a bounce now that we have fallen almost, what, 600-700 points in just 2 sessions? That and your stock recommendations as well.
Yeah, good morning. So this is second consecutive day where we are trading below to 200-day moving average. In the gap down opening, Nifty has, broken the put-based concentration support area of 25,000 level, and post this opening, I think most of the put writers have unwind their position and now shifted lower towards 24,800, even 24,600 strikes. So that shifting is clearly showing a sign of weakness, as the confidence on the buying side is very low. Looking at the call writers confidence, which is now at 24,900, 25,000 levels. So I think these levels are likely to act as a steep resistance for near-term trend. So until the Nifty not crosses 25,000 level, there is a high possibility that yes, we may test the budget day low also in this continuation of this fall. So sell on rise would be the strategy till we are not able to take above 25,000 level in the near-term perspective. For Bank Nifty also, we have broken the major support area of 60,000, and if it continues to trade below 60,000 level, we may see more profit taking in most of the large cap banking basket also, and that could give more pressure on the Bank Nifty also, and possible down move towards 59,500 we could see in the near term perspective. So here also sell on rise strategy till Bank Nifty not able to regain above 60,500. On the stocks front, one long, one short. On the long side, Bharat Electronics is looking attractive as because of the geopolitical. Again, the defense stocks are in buying interest, showing buying interest. So BL is looking attractive. Stock is in clear uptrend across all time frame. Looking at the near-term, short-term structure, we believe that till stock is trading above 440 zone, there is a possibility of 465 to 470 target in the near term. So one can buy BL. On the short side, Container Corp is looking weak. Series of lower top, lower bottom formation. Stock has already broken the support area on the weekly chart. Looking at the structure, we believe that this stock may slide further. On the downside, 470, 465 would be the target. One can remain short with stop loss of 488.
All right, take that point. Thanks a lot, Rajesh, for joining in. We'll take a short break, come back on the other side. Sonam Srivastav, fund manager at Right Research, joins in for the market fundamentals.
Fly Emirates, fly better.
Welcome back. The index still fighting to hold 24,800, still 360 points lower as we speak. The Sensex down almost close to 1,200 points. Let's get in Sonam Srivastava from Right Research PMS to talk more on the markets. Sonam, good morning. Thank you for joining in. Now, in a market where everything seems gloomy as of now, would you, as a long-term investor, recommend that, okay, this is an opportunity because geopolitical events die down sooner or later and then the market starts to move higher from there? What is your call on the market currently? What are you recommending to your clients?
So definitely, I think, like you said, geopolitical events like these, we've seen historically have had short-term impact. I think even today, if you looked at the pre-market, I think the reaction that was expected was much higher, and the market recovered from those levels. Right now, we're seeing some consolidation. In fact, some of our portfolios where we have allocation to a few metal names and industrials, they in fact turned positive during the day today, so which was very exciting. But I think there's more consolidation going on. So I would say that we have to be strategic. I think there is a lot of interest in the manufacturing industrial basket where you can start picking up some strong names in this current correction, right?
So in that case, where are the specific sectors other than the ones you just highlighted that you are seeing an opportunity, because most of these sectors now have corrected from the February highs? Where are you putting your money to work?
So recently, see, I think what we have been bullish on is some of the names which are probably linked to the data center economy. You've seen even power, energy, a lot of stocks in the metals, wires, etc. I think manufacturing, capital goods. I think that's where we're seeing a lot of interest, even in the financial side, on the NBFCs, on the credit growth cycle. I think that's where we've seen taken a bet, and I think. Again, very difficult to comment on this huge geopolitical events. How long does this last? But that is where on the domestic economy we are seeing a lot of interest. Right? So that is where if I were to accumulate right now, that is where I would be accumulating.
So, and is there a sector or is there a basket that you would particularly like to avoid at this point of time, especially considering the current scenario?
Yeah, I think in the current scenario, the stock that are exposed to high crude prices. For example, we do have a few auto names, a few auto ancillaries. I even hold a tire stock which is seeing some correction today, right? So I think avoiding those stocks where you have exposure to rising crude prices would be diligent right now, because the crude economy would be highly impacted. I think that's what the big impact of escalation in Iran would be, that the crude economy is impacted. So I think we would be staying safe of those stocks right now. But again, you have to see how long does this escalation last, and how much does the impact last.
Now, the one pocket that has been outperforming in the recent past has been metals, and you mentioned metals briefly as well. But do you see metals as a super cycle play, or do you just see it as a tactical opportunity just because base metal prices and gold prices are also going up in the global market? So you would play this theme for now, and once it starts to die out, you would move out of the sector?
Yeah, I think I would not say that we are in a super cycle just yet, because macroeconomically you would see that the growth hasn't come back in a very emphatic way for us to say that this is a commodity super cycle or a long-term allocation. I think it's a tactical bet, especially due to the interest that is going toward the precious metals. I think there's a pickup that we're seeing through the industrial demand in other commodities also. So I think it's still a tactical play. It could turn into a super cycle if the geopolitics and if the economic situation sort of calms down. But I would say that it's a tactical opportunity driven by some supply and demand constraints right now.
Sonam, pleasure having you today. Thank you so much for sparing time and joining us today. Looking forward to having you more often on the platform. Take a short break, focus on the bond markets with Manisha Gupta on the other side.
CNBC-TV18 and India Bonds presents Bond Street.
The markets recovered a little from the lows. The Nifty is now closing in on the 24,850 mark. It is the Nifty Bank, which when we spoke, a few minutes ago, it was down by about 750 points. Now it's down by about 650 points. There's a 100-point recovery on that index as well. But let's get in the bond market action. Manisha Gupta, as always, joins in for Bond Street. Manisha.
Well, the Indian bonds have seen a bit of a decline as we start a new day and a new week for that matter. And this is on expected lines. And this is after geopolitical tensions in West Asia, which has led to oil prices spiking on the higher side. In the opening trades itself, we saw crude oil prices gain up by 13%. It seems to have adjusted at this point in time. Remember, it has all been about the weekend where the markets have had some time to digest the news, but it still continues to be very, very fluid. The US and Israel jointly attacking Iran over the weekend has led to Iran as well retaliating and striking US and Israeli bases in various global neighboring countries therein. The disruption of traffic in Strait of Hormuz, remember 40% of crude that India imports comes in from Strait of Hormuz as well. So India in that sense, whether it's going to be about our fiscal, Indian rupee, crude prices, and that is impacting the money markets and the bond as well. Interestingly, there also is going to be focus on the large supply of the state government bonds. You have 13 states trying to raise nearly 431 billion rupees in this day to day, and the US Treasury is also below the crucial level of 4% are some of the factors that the street is keeping an eye on. In the meanwhile, you have RBI, where the government is switching 4 bonds. This is worth nearly 250 billion rupees maturing in FY27. These are going to be swapped with nearly 5 long-term gilts in the auction today. Apart from that, it has been SEBI chief. Remember, he's been talking to CNBC or various channels, and he's pushing for need for a robust secondary market. The SEBI chief has been saying that there is improved trading activities beyond primary issues that need to be worked upon, and this is about enhancing the retail awareness. He also said that the strategy includes reforms like the request for proposal and the request for frameworks as well. SEBI also in the recent past has said that it is aligning with RBI to create a variety of strong bond indices as well. So various and a lot of work being done when it comes to corporate bonds by the regulators also.
Well, Manisha, thank you for that update. Larsen & Toubro is now at the lowest point of the day, extending its losses. What is also at the lowest point of the day is the rupee, 91.45 now on the currency against the US dollar. L&T now down almost 6% as we speak. What has also slumped to the lows of the day is Godrej Agrovet. That has made its list now as the second biggest underperformer on the Nifty 500, that too trading with losses of around 6%. Take a short break, more on the markets on the other side.
CNBC-TV18 and India Bonds presents Bond Street.
You want to talk business? Meet me in the On-Board Lounge.
Any recovery is being vociferously sold into. You know, when we went into the break, the Nifty was 24,850. Within 5 minutes, there's been a 55-point decline. It's led by the Nifty Bank. It's led by a couple of these IT names as well. So pull up the intraday chart of Infosys, that's lower. M&M continues to sell off. L&T, Eicher Motors, HDFC Bank, all these index heavyweights are now at the low point of trade. So the Nifty is back near the low end of today's trading range so far and below that 24,800 mark as well. But in an exclusive interview, as Tuhin Kanta Pandey completes his first year in office as the SEBI chairman, he spoke about ways to make cash markets more liquid in a conversation with Prashant Nair. Listen in.
It's indeed our endeavor that the cash markets must further become more liquid. And whatever we need to do, we do have a working group looking into it to review the short selling and the SLBM framework under the cash market, which is there, but it's somehow there are some barriers where it's not really taken off. So therefore, the industry and the SEBI officials and other experts will look into it and suggest measures, and we will move forward.
You know, one thing I've heard, and this is my last thought. Sorry, you will forgive me for this, but STT on delivery, for example, I've heard it from every day when we speak with, and we don't talk about this every day, but whenever we have these discussions, it always comes up. Why can't the government, if the idea is to curb short-term options in the F&O space and encourage cash, do away with STT on delivery? Is that something you would, SEBI is the expert, and SEBI will, of course, advise and tell the government, and of course, it's for them to decide, but is something that is on the agenda?
No, I'm not going to discuss on TV what inputs we'll give to government and not give to the government.
But cash market development is very much, as you said,
yes.
There's a group which is...
I think whatever needs to be done, we should be doing this.
Just to complete this topic, can I say, and I'm paraphrasing here, the idea is to reduce the turnover in the futures and options segment, and there the specific thing, short-term options, relative to the cash market. I mean, the size is, as many have pointed out, is very disproportionate. Cash market size as compared to the options, the short-term options market. Would you say that the idea is to kind of sort of not equalize, but reduce the disparity?
Well, I think, as I said, that the cash markets need to be more liquid. There should be more turnover, and so therefore there could be several issues. We have to wait for the working group to come in. Tax is another issue, of course. You have rightly pointed out.
The SEBI chairman there in a conversation with Prashant. We take your leave on this edition of Trading Hour from Mangalam and me. Thank you for watching. We leave you with the Nifty nearing the lows of the day. The mid-cap index too down almost 1,000 points. Halftime report on the other side.
Stocks opened sharply down following escalation of the US-Iran conflict, but marginally bounce off the lows. Auto, consumer durables, energy and realty are the big drags, while industrials and metals are most resilient.
SEBI Chairman Tuhin Kanta Pandey, on completing a year at the helm, signals an intent to boost equity, cash segment liquidity and bank and insurer participation in commodities. He aims to cut FPI registration time to 5 days and assures no new action on options till impact of earlier steps are assessed.
Brent crude prices jumped 13% in its fourth biggest daily move since the 1990s after Israel and US strike Iran. Natural gas prices too surge as insurers hike premiums, cancel policies and shipping companies reroute vessels from the Strait of Hormuz.
And Jefferies global head of equity strategy, Chris Wood, thinks Trump may quietly back off from tariffs as these are unpopular among Americans. He also thinks gold is a good bet, while flagging the rupee slide to $90 was a negative for FPIs.
Hello, good afternoon. You've tuned into Halftime Report coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny Motiwala. With me are my colleagues Ekta Batra as well as Sonal Butra. Good afternoon, ladies. But again, a day that we're seeing red across the screens. No de-escalation that's coming in from the West Asia front as well. And markets clearly under pressure because of that now. 24,700 around that mark is what the Nifty continues to trade at as of now.
Hey girls, good afternoon. I came back from leave and over the weekend explosion, so many things happening across the globe. Having said that, yes, markets continue to be under pressure. They have recovered a tad bit from the lows of the day, so keep an eye out on that. Pharma index is falling the least, but again, okay, all right, there's another fall from the high, so we are at the day's low, so it's changing by the minute at the 25,770 mark. As I said, it's the pharma index which has recovered from the lows of the day. Metals are falling lesser than the others, but all the sectoral indices are in the red right now. Few and far of these names which are in the green right now. We'll discuss that. But overall, the sentiment continues to be negative.
Yes, absolutely. But, you know, you have to put it into context as well, because the low for today was around 24,645. So there has been a recovery which has taken place from the day's low. So currently, yes, down around 1.6%. We have the mid caps which are down around 1.8%. But there has been some amount of buying from the day's low which has taken place. But it is definitely going to be a volatile session. Just want to pull up a lot of the defense stocks which are actually resilient in today's trading session. Say, for example, Paras Defense, which is up, Idea Forge, BEL, HAL, Bharat Dynamics. So there's a lot of enthusiasm around that, but you need to put those kind of moves into context. If you look at these stocks from their 52-week highs, there is a significant distance that they have to travel to those levels. For example, Paras Defense, which is 26% away from its 52-week high, Idea Forge, which is around 28% from its 52-week high, which is at around 660 odd rupees, BEL, HAL, Bharat Dynamics, all of these stocks, except for BEL, you'd have to say that's very close to its 52-week high, but nonetheless, HAL and Bharat Dynamics are a huge distance away from that 52-week high. So buzzing today, but there is a distance that they have to travel to the all-time highs or the fresh highs that they've seen in the past 1 year. But nonetheless, that's on the entire defense space, which is buzzing about and is quite resilient in today's trading session. But let's tell you what we have on the show today. In the next 1 hour, we will be putting the spotlight on the US-Iran trade tensions and bring you a view on the fertilizer sector with IIFL's Ranjit Kirumala. Stay tuned for that. In our special What's Trending segment, we will be focusing on the travel and tourism sector, which is impacted due to the West Asia tensions. We'll also bring you the top market voices we spoke to and what they had to say on the impact of the geopolitical tensions, specifically on the Indian market. And on our Movers and Shakers segment, we'll be putting center stage on defense, oil and gas, as well as stocks such as MCX and L&T.
Okay, now let's move on and start with the top movers and shakers of the day. And we have Vivek joining us from the world to take us through all of that. Vivek, over to you.
Well, thank you so much for that. What a weak trading session. We're witnessing extremely volatile, a brief intraday recovery that has been quickly sold into. In terms of individual stocks, individual sectors that we are tracking, some of the names that are doing quite well, very few, but MCX clearly, the interview from the SEBI chairman indicating that there could be FPI participation in the commodity derivative option segment is something that the street clearly likes. Now, coming to different stocks, something that you mentioned at the start of the show, many of these names seeing a bit of buying today. Solar Industries, BL, most of these names amongst the few stocks from the broader end of the market that are seeing some buying activity. Amongst the top NSE 500 gainers, Sterlite Technologies, that particular stock up quite significantly, and ONGC, some of the few oil and gas names, especially upstream companies seen benefiting from higher oil prices, are moving higher, cooled off a little bit from the day's highest point. But the list of laggards are quite significant. First up, of course, OMCs, most of the crude sensitives have fallen. HPCL, BPCL, IOCL, all of these names under significant pressure. Most of the companies, industries, EPC companies, as well as capital goods names with exposure to West Asia or Middle East, most of these names under significant pressure. Both raw material prices could go up, as well as there could be significant delay as far as project execution is concerned. These worries have kept names like L&T down almost 6% now. Bartek Waba, Cummins, KC International, most of these names under pressure. Travel and tourism stocks, again, another sector that's been impacted due to geopolitical tensions. So look at names like Indigo, down significantly, higher prices, as well as flight cancellation, something that's weighing in on sentiment there. Indian hotels as well as Spicejet under significant pressure. Companies that use crude as a raw material, so paint companies, tire companies, even cement companies that use petcoke as raw material, most of these names under pressure today. Asian Paints down almost 2.5%. Shree Cement down over 2% in the session today.
Okay, it's more down than up in the trading session today. Thank you so much for joining us, Vivek, with all those details. Let's now focus on the fertilizer sector. IIFL Securities, in a recent report, says US-Iran conflict will increase pressure on fertilizer supply chains. Also adds that India has limited imports from Iran, but it can materially impact landed costs, availability, and the government subsidy burden could be impacted because of that. Ranjit Sirumala, who's the Senior Vice President, Research, Agri and Chemicals at IIFL, is joining us now. Ranjit, good afternoon. Thank you so much for joining in. If you can explain how important is the Strait of Hormuz for the entire fertilizer chemical supply chain and some of the companies that do depend on the chemicals or fertilizers that are used or transported from that area.
Thank you, Sonal. If you look at India, we are structurally dependent on the imports. Urea demand is around 40 million odd tons, of which almost 17-18% is what gets imported into India, while non-urea is around 35 million tons, of which DAP is the most significant, around 10 million tons, of which 50% is what gets imported into India. In addition to this, we have MOP, which is 3 million odd tons, 100% of which gets imported into India. In addition to this, the NPKs, which is around 15 million tons, a significant part of the raw materials gets imported, the rock phosphate and the phosphoric acid. Rock phosphate around 9 million tons and phosphoric acid around 3 to 4 million tons gets imported. If you see the most of this do transit the shipments to the Strait of Hormuz, and if you look at the key countries that we import are typically the Jordan, Senegal, and Morocco. So hence the supply chain becomes important. The way we see it, that there is going to be two things that we have to keep in track. One, the availability, and second is the pricing. So clearly, even if there is a short-term disruption, we have seen in the past that they take some weeks to get the unwind of the debottlenecking of the shipping thing, and that may impact the preparation to the Kharif season. While on the pricing front, we have seen the prices firming up over the last few weeks, and if that continues, that will have some pressure. But historically, we have seen Government of India kind of stepping in and increasing the impacts, and we have seen fertilizer bills spiraling. The same is what can be expected in the next couple of months.
Okay. All right, Ranjit, a lot of questions there. Thanks very much for joining in. Just wanted to understand that what is the kind of inventory buildup that these companies back home might be having in the urea as well as the complex fertilizer space at this point in time, and hence how protected are we from any kind of intense volatility that might happen in the next couple of days or weeks?
So if you look at the demand patterns, is not uniform. We have skewed more towards Kharif and the Rabi season. Fortunately, what we see is that the consumption is kind of nearing to an end, with the Rabi showing almost complete. Now, what the companies will be in probably tying up the volumes for the ensuing Kharif season. And to that extent, while the inventories will still be on the lower side, given that it's a lean season, but the key thing would be on the pricing. The kind of a pricing the companies will get into is what will impact the profitability in the Kharif season.
Obviously, the pricing is going to be the key there. Ranjit, good afternoon. This is Vinny joining in the conversation as well. So normally, just help us understand what is the lag time that you see in terms of the impact coming in for this pricing as well? If you can start with that.
See, if you look at the government of India, as far as urea is concerned, it is largely a pass-through mechanism. So what happens with the urea companies is that the cost will go up, and to that extent the working capital intensity rises, and the government compensates them as and when the liquidation of the consumption happens. But when it comes to the complex fertilizers, the government comes up with an NBS policy every 6 months. So since we are towards the end of the Rabi season, the policy is expected towards the end of March or early April. And given the last 6 months inflation period, we expect government to take that into account and hence revise the NBS rates upwards. And that is what should be beneficial for the complex fertilizers.
Okay, so if you have to end this conversation with some stocks, Ranjit, which are the companies which tend to get impacted maybe positively or negatively because of the changes that are coming by, and do you think this could be a medium-term impact only for now?
Yeah, we do see this more of a transition kind of a thing. If you look at the companies, Coromandel has an exposure to the phosphoric acid in the rock phosphates, while most of the fertilizer companies have an indirect exposure to, because in India, LNG is what gets completely imported, or most of it gets imported, and that will have the value chain on the raw material pricing. So most of the fertilizer companies, either way, direct and indirect exposure will be there. The Coromandel, the Chambals of the world is what will be vulnerable. But as I said, the government support is what is will be there, and to that extent, the cushion will be impacted.
You spoke about import substitution as well, Ranjit.
Yeah, so what we have seen in times of such disruptions is that the import substitution plays do gain a bit of attraction. So what happens is that there will be an immediate impact on the pricing, but the cost inflation will come with a lag. And to that extent, there are tailwinds. And if it kind of continues, so we have highlighted the phenol or the ammonium nitrate, Deepak fertilizer or Deepak nitrites, and even to that extent, the PVC may see a bit of a tailwind. We have seen a price hike taken in the PVC from the 1st of March. And if you look at from the December till the end of February, there is almost an 18% increase in the PVC pricing. And that kind of bodes well for a company like Chemplast Sanmar. While phenol is what we haven't, if that spreads improves, PVC spreads or ammonium nitrate spreads, so we have highlighted Deepak fertilizers, Deepak nitrate and Chemplast Sanmar may benefit in the near term.
Okay, all right, Ranjit, we're going to let you go on that note. Thanks very much for joining in. Just want to point out that for the markets now, it is looking very tentative. So 24,774, not at the low point of the day, but there's a fresh wave of selling which is coming through. Just watch out for the broader markets, because that seems to be where the pain is exaggerating at this point in time. So we have the mid-cap index, which is down around 1.7%. Maybe the BSE small-cap index should come up for you. And let's see how that's performing at this point in time as well. The advanced decline ratio will really tell you a picture for today's trading session. Just about 788 stocks which are advancing to over 3,600 stocks which are declining at this point in time. There's been absolutely zero respite in terms of the advanced decline ratio and the gap between the red and the green line at this point. Stocks, just about 5 stocks which are gaining within the Nifty space, so just about holding their head above the water. We'll take a short break, but up next, Sudarshan will join in. He'll focus on a slew of market voices, which is extremely important at this point in time, who we spoke with on the impact of the ongoing West Asia conflict. That coming up. Stay tuned.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. Well, definitely a tough day for the markets, and the mid caps, like we pointed out, are showing further pressure. So down at the low point, down around 1.9% at this point in time. But all is not too bad at this point. You would have to say that there are some stocks which are managing to zoom ahead, and one of them is Tejas Networks. You have to just look at the way that stock has moved this month. It's gained 40% this month itself. It's up around 12.5% in today's trading session. In fact, it's gained for the fourth consecutive trading session. If you just look at the chart, maybe a 7-day chart will tell you the picture about Tejas Networks. But just look at the way that stock is zoomed. A couple of days ago, they did announce, an order win from NEC Corporation to manufacture, supply 5G massive MIMO radios. And since then, that stock has just zoomed past and is seeing some amount of traction today as well, up around 12%. But that's on Tejas Networks. That's not the same case for the markets at this point. So the Nifty is currently at around 24,728. Remember that the low point was below that. In fact, it's a good time to get in a technical check with the markets, and let's go full tilt on that. We have Sudeep Shah of SBI Securities joining in. Sudeep, hi, welcome to the show. Well, it's looking definitely like a tough day. We are seeing a fresh wave of selling coming through. The broader markets are under significant pressure as compared to the frontliners. What would your strategy be?
First of all, good afternoon, Ekta. What we feel is that these situations of war, it's important to trade with levels, and the sentiment right now is completely that of a sell-on rise. So for me, 25,000, 25,100 now would be a formidable resistance on the upside. On the downside, there is that last month's low of 24,500, 24,600 zone, which will now be extremely crucial. But by the looks of it, it looks as if that also could be taken out with the kind of selling pressure that we are seeing since morning post that first round of recovery. So 25,000, 25,100 would be that level that I would be eyeing out for any call on recovery or for the markets to bottom out post this entire event.
Take that point. As we speak, Nifty is again at the day's low, very close to breaking that 24,700 mark as well. In a market like this, Sudeep, what are some of the stocks that you're trading on?
Couple of them now. One is from the pharma space. We've seen in the last entire week, the pharma space has been resilient, and today also they have been the first ones to recover. And within the pharma also, there are a couple of names like, say, Glenmark Pharma, for an instance, where the charts are quite strong. The weekly breakout is intact, and we feel that at current levels, Glenmark Pharma. At the current levels, or on dips that can be added, and the stop loss could be 2,030 on the downside. The targets would be 2,200, 2,250 on the upside. The stock is Schaeffler India. That's an auto ancillary name which is outperforming. There are, say, breakout on the weekly charts, and here also we feel this stock can do well in the coming few weeks for a target of 4,800, and this can be bought with a stop loss at 4,100.
Okay, Glenmark Pharma and Schaeffler India is what you've spoken about, right, Sudeep? Perfect. Okay, Sudeep, thank you so much, for joining us this afternoon and, helping us understand in terms of markets as well as individual stock news that you've been tracking. But on that note, we're going to slip into a very short break. We'll get you more on markets, more stock-specific action on the other side.
Welcome back. You're still tuned into Halftime Report. Let's stay with the US-Iran trade tensions. We had a slew of market voices and who spoke on the impact of the ongoing conflict and how it will have an impact on the Indian market. For now, let's go across to Sudarshan, who's joining us to give us a roundup on what they had to say. Sudarshan, take it away.
So amid ongoing tensions, basically geopolitical tensions, and US and Iran war is underway. So at this point, what exactly one needs to do? Who all can understand better than our market gurus? Chris Uru has spoken on this. Samir Arora has spoken on this. Even Manish Sonthalia had made a comment on this. So first, starting with the Chris Uru, he believes that it's hard for markets to not account for geopolitical risks right now, but at the same time, someone can look at diversifying using gold and energy stocks. And on gold especially, he has a target of almost $6,600, and he believes that it could reach even to $10,000. And talking about markets, except US, he believes that all the other markets might outperform. But the big question is, when will FIs come back to the Indian market? On that, he believes that FIs can come back to India if semiconductor trade peaks with a sell-off is seen in Korean and Taiwanese market. Then only FIs might make a comeback to Indian markets. And on talking about IT, he believes that counter-trend rally in IT services is expected, but long-term growth will be a key monitorable going forward. Now talking about Samir Arora, he also has made a comment. He believes that market can be a bit tricky in the phase of geopolitical tensions, but amongst all his picks, he believes that one sector that can outperform is the defense names, and the reasoning behind this is the support that the sector is getting from the government, and the preferred pick is Bharat Electronics Limited, and he believes that he's going to start making investment today, and it's a good opportunity for people to start making investment with a sharp fall we are seeing in the market amid geopolitical tensions. Last one is Manish Sonthalia. He believes that incremental flows are expected into India, with market is looking very attractive after the recent fall that we have seen from the highs of almost 26,300. Nifty is now trading much below 24,800 also. And amongst preferred picks, he believes that auto components and tire companies are likely may outperform going forward. Even financial stocks, including insurance, are some of the recommended buys as per him. And select commercial vehicles, power transmission and defense names also, as per him, look very attractive after the fall we have seen in the recent past. So overall, even though market has seen a sharp fall in the last 2 or 3 trading sessions, these market veterans believe that it can be a good opportunity.
Okay, absolutely, Sudarshan. Thanks very much for getting us that comprehensive list in terms of what the market experts are saying at this point in time. Crucial there, but let's also get you that special conversation with veteran investor Christopher Wood. He says US President Donald Trump will back off his tariff agenda as the country is approaching midterm elections. Our colleague Nimesha caught up with him and began his discussion by asking about geopolitical risks. Listen in.
Geopolitical risks have been there, as you rightly say, for at least 4 years. Yeah. So it's extremely hard for markets to discount geopolitical risk. In fact, they can't. So the only way you can discount it in a portfolio is via gold, and I would say this year via energy stocks. So there's probably a bit of a Iran risk premium in the oil price today.
Chris, you've been a big-time bull on gold, and it's proved right in the last at least 2 years. Gold has been the best-performing asset class, so to speak. With the kind of rally we've seen in the gold and the commodity stocks per se, what's your call now? Do you see further upside on gold from here, or it's a time to book profits into gold?
No, in the medium term, I see big further upside in gold, but I wouldn't be surprised to have a period of extended consolidation.
Okay.
Sideways consolidation to maybe sideways to down, but I'm talking tactically.
But you're not expecting.
If I had a leverage position in gold, I would have taken profits.
Okay, but what's a long-term goal? What's a long-term target on gold? Say maybe 2 years, 3 years down the line.
Formally, my long-term target is now 6,500, but I mean, gold can easily go to 10,000.
Oh wow!
Because if you look at I'm talking US dollar terms. So in US dollar terms, the growth of M2. Sure. You can easily get $10,000 on gold. Mm-hmm. But my formal target based on is currently 6,600.
Sure. Apart from gold, anything in the hard commodities that you like and you're looking to add into it, the silver, copper, aluminum?
No, I have copper stocks in my portfolio and oil energy stocks. But if I only own one, it would be gold.
Okay.
Silver is high beta gold.
Sure.
But it's not. If you're a purist, you will only own gold.
what is the best case as far as the US equities are concerned for, say, for this year? How much?
My view on US market, I've got a stronger view on the relative story in the absolute. So my view has been since the end of last 24 that the US has made an all-time peak as a percentage of world stock market capitalization. So to be precise, the US peaked at 67% of MSCI All Country World Index.
Okay.
And I think that's an all-time peak, and that's consistent with my view that you're going to get a derating on the hyperscaler stocks, which dominate the US market.
Sure.
Because of the huge capex, which is making these companies generate less free cash flow.
Sure.
So I believe we've begun a period where markets ex-US will outperform. That happened last year, and I expect that to continue.
Okay. Now coming to India, Chris, because you travel to India so much, and there's a lot of fan following in India as well. To read to what Chris believes on India, I saw a tweet. You recently met Piyush Goyal as well, the Commerce Minister. You think from a trade point of view with the US or with Europe or with the other countries, it's largely been settled now?
Well, I think
no downside risk in terms of tariffs?
Well, I think it's good news that obviously the European-India trade deal has finally happened, and it looks like Donald Trump was a spur for that to happen.
Sure.
So that's a sort of indirect positive. On the tariff thing, I personally think there's a chance that Donald Trump backs off the whole tariff agenda, although he's not going to admit it in public.
Okay.
The reason I say that is the polls show in America, we've got the midterm elections this year, and the polls show that the tariffs are not popular amongst ordinary Americans because despite the inflation data in the US, which looks relatively benign, it's quite clear from the opinion polls that ordinary Americans feel the cost of living. And I just don't think the tariffs are popular.
Okay.
So I think there's a good chance he sort of quietly backs off the whole agenda without admitting it.
Okay. Well, that will be a great news, right, for countries like India.
Yeah.
But even if he doesn't back off...
Because it's not popular. Right now, he's losing the midterm elections.
Sure, sure. Even though if he doesn't back off, still at the current rates what we are with the US and with the European nations, you think it's pretty okay for India to do well from here?
But I don't. Hopefully, the experience with the US prompted the Indian exporters to look for other markets. I think one unfortunate consequence of the tariffs, though, is that I think the central bank allowed the currency to weaken more last year to support the export industry. But personally, I think that was a mistake because the rupee going through the 90 level is a key psychological level. And I think a lot of Indian corporates were not positioned for that because I've met many Indian corporates in the last few years who basically have been of the view that depreciation is going to be less going forward. So I think that's been a negative. It's also negative from the point of view of foreign investors.
Yes.
Because it made the rupee India underperformance worse last year. And again, it wasn't expected.
One from a sector point of view, the one sector which everybody's been talking about of late is a sharp sell-off in the Indian IT names. Sitting out of India, looking at all global markets in terms of tech stocks, what's your view on Indian stocks now? I know your analyst has downgraded recently all the Indian names. But
the IT services.
Yeah, IT services. But what's your thought on the IT services?
No, I haven't got the IT services in my portfolio, but frankly, I never have. Never had because I've always had a Indian green venture portfolio more focused on the domestic side. But at some point, there's going to be a counter-trend rally in these software stocks because it's not like these businesses are disappearing tomorrow. So I think the role of Indian IT services will be to help corporates migrate to small business models, the small language models designed for their own purposes. So there's a role for the IT services, but you know their long-term growth, revenue growth, is going to be less than people were hoping for probably, and they're going to be, I think, importantly for the economy, the risk is they're employing fewer people. So while there can be a counter-trend move, I don't think they're a structural hold. No.
But do you foresee or do you see a risk of a second-level impact on, say, consumption and the real estate stocks in India on the back of sharp sell-off in the IT names?
That risk exists, definitely, but I think that risk in the first instance is greatest in the developed world.
Sure.
So these predictions of all these white-collar job losses, which are potentially very bearish, if that's going to happen, it's going to happen first, in my view, in the developed world.
Okay, an interesting chat there with Christopher Wood. But, let's look at the markets right now. Again, we are seeing a bit of a decline coming in. And especially in the last few minutes, the market has seen a further bit of a fall. 24,730 around levels is what the Nifty is trading at. Day's lowest point is what we're seeing. But important flashes at the bottom of your screens for you all. It's coming from M&M. They're talking about a prudent capital allocation move that is coming in to exit the agri-machinery business in Japan as a part of the portfolio rationalization that they're focusing on. It's the capital allocation move after a strategic review is what they've taken this move coming in. So they are going to be, it's an ordinary transition company, will cease operations by H1 FY27. The stock is down as of now 3%. I believe we do have Sudarshan joining us right now, if he's there. Sudarshan, over to you. What does this mean for M&M? What sort of part of this business is there? I believe it's the Japan side of the business that they're moving out of.
So in 2010, Mahindra & Mahindra and Mitsubishi Group had signed an agreement, and under that agreement, they had created a JV, and that was related to farm machinery. Now, over the last few years, this business has been facing structural headwinds. And considering those headwinds, it's an important announcement that Mahindra & Mahindra Group has made it, and they have decided to exit that business. So what they are saying, they'll be exiting the agri-machinery business in Japan, and this is as the part of portfolio transition, that rationalization that company is undertaking, and it's a prudent capital allocation move after a strategic review that group has taken over the last few months. And it believes that it's an orderly transition and will cease the operations by H1 FY27. So that completion is also going to happen very soon. But it will continue parts and warranty support for the customer, and some of the context that company has mentioned. First, that because of the structural headwinds, there has been a shift in overall demand. That was also one of the reasons why company has gone ahead and taken this decision. Second, that context it has made is competitive pressures. Over the last few years, competition has increased. So many new players have emerged, and that also emerged as one of the reasons of group to go ahead and exiting this business. And last is production constraints that company has been facing over the last few years. So these are some of the reasons that company has made. But overall, considering the demand shift that has been taking place over the last few years and the headwinds, it can be taken very positively.
Okay, all right, Sudarshan, thanks very much for that. The stock, however, obviously because of the market sentiment is lower. We do have Ashwin Patel joining in from LKP Securities for a quick view on this. Ashwin, thanks very much for taking the time out. If you could just give us a sense in terms of how you would read this move by M&M, where they are exiting the agri-machinery business in Japan. It is expected to possibly be positive. Do you know any of the numbers that supported this?
M&M, as far as M&M is concerned, they have been, exiting prudently all those businesses which are facing a lot of headwinds or, are not picking up from the losses. I'm not sure about the numbers in this business because the company never stressed upon it. It may be a smaller business, but definitely, as far as the farm machinery business is concerned in Japan, there's a lot of competition building up over there, and it's the investment, in Japan. Maybe not that, heavy. And that's why, and Mahindra has been doing great in other geographies as well as in India. So this may be kind of a laggard in their overall scheme of things. So, it would be quite wise to exit such businesses. Mahindra has been doing such in the past. They exited Samsung, they exited several other farm machinery businesses across the globe. So this is, they have selected certain companies as their gems. So within this, they are focusing on those particular businesses only on the console level. So, this is a business they would have, thought about it up to a great extent and exited at the right time because a lot of competition is building. And there is no point in, continuously investing or, just having that investment for a longer time and which is not, yielding any profits to them. So it would be a wise decision. So I would say that, it's a good, a good act from Mahindra's table.
We don't know the numbers, but you suggest it is a positive move because they're letting go of a business which was not yielding them any profits. Are there any other businesses that are on your radar, Ashwin, which needs to be disinvested in order to bring more structure to the entire business?
See, in the past, they have taken all those moves like exited the two-wheeler business. They have exited Sangyong, then other several subsidiaries in the on the global front in Europe, US, Latam, etc. So, but this going forward, they have actually filtered quite a lot and prudently now at a level where they need not exit too many businesses at this point in time. But this particular JV with Mitsubishi in Japan is exiting that is a very good move, because on the farm machinery front they are quite strong in the domestic markets and they do not need anything which would pull their profits down on the global front. So in the domestic market, they are market leaders in the rice transplanters, the rotavators, etc. All those businesses, they are doing fantastically. So there is no point in being there in such a business which is not yielding them strong profits. But as far as I know, there are very few businesses now left where Mahindra needs to exit.
All right, Ashwin, that point is taken. Thanks very much for joining in and giving us your perspective. So that's the word coming in on the exit of the agri-machinery business in Japan by M&M. We need to focus on the entire commodity space now, and we have Manisha Gupta joining in to give us more, considering that it is top of mind post the West Asia conflict. Manisha, over to you.
Thank you so much for that. And I have a guest joining me to exactly talk about that. Vandana Hari is founder and CEO at Vanda Insights. Vandana, over the weekend, and it has been an absolute lot of inflow of news information. The markets have had 24 hours to digest it all, and is the reason we perhaps are not looking at prices surging too high. But more information continues to come in, and it's a volatile market right now. One, what is the sense that you're making of all that's happening in West Asia, and how are you looking at the crude prices reacting on that?
Good afternoon, Manisha. So I think as of now, there's still a lot of confusion and chaos in the market, a whole lot of uncertainty, not a very clear picture emerging either on the logistics level, fundamentals level, in terms of what ships are passing through. Basically, what is the state of oil flows from the Middle East that go through the Strait of Hormuz, nearly 20 to 21 million barrels per day. And there's also confusion reigning supreme on a geopolitical level, which is obviously very important to try and gauge what direction this conflict takes, whether there is still room for negotiations and a return to diplomacy between US and Iran, or whether this will now continue unfolding the way it has been over the past 2 days. So in the midst of all of that, what we have seen is crude has packed in a little more of a risk premium. Mind you, there was already a good $10 or so risk premium on a build that had built up ahead of the weekend, and today we are seeing another $6 to $7 per barrel premium added to that. But at every stage, because of the situation being in a flux, I think the market's going to be wait and watch. What is the next? Because it's between two binary outcomes and everything in between, it's absolutely up in the air which way this goes.
I'm sure of that. But Vandana, let's take both the scenarios right now. If the countries come on table and there is a diplomacy in sense of a conversation there, and as you've mentioned, there is almost $16 to $17 of a geopolitical premium on prices, how much of that would go away with that conversation starting yet again? And if not, and if this prolongs slightly more, and there is a problem at Strait of Hormuz with insurers doing what they are doing, and the way things are unfolding in Iran and other neighboring countries, in that aspect, let's say if it goes on for another 2 weeks, in both these scenarios, how would you look at the crude prices?
Okay, so in the case of diplomacy, I think the market will still remain extremely cautious in unwinding the risk premium, because we have seen what route the diplomacy has taken and what results it has yielded, unfortunately, over the past few weeks. So no one is going to be betting or holding their breath for a very quick resolution, which means that we may again also see a start and stop of diplomacy and a military conflict. So I would expect perhaps a little bit of relief, a little bit of pullback in crude, should there be a ceasefire and a return to the table, but not any meaningful drop in crude prices. The other option that you're talking about, at this point, just absolutely scary scenario to even contemplate, but it would be catastrophic, nothing short of that. A quarter of the global oil consumption of every day being stopped, even for a few days, let alone several days or weeks, is going to push the world into a recession. And even if it is somehow then contained and things return to normal, we're going to have a ripple effect of that going potentially into months in terms of supply chain. So that's an absolute horrific scenario for overall the global economy.
Just before I give it back to my colleagues here, Vandana, what's your sense on prices then? Both scenarios, if you could give us a number.
We are definitely looking at triple digits. Manisha, it'll be almost impossible catch a falling knife to put a number in triple digits, because that'll again depend a whole lot on how long the worst case scenario, namely a complete blockade of oil flows, unfolds. In the event that we do see a return to diplomacy, as I said earlier, we would need to see a quick at least an interim or a framework deal for crude to meaningfully lose the risk premium it has. So in which case we see Brent perhaps climbing back towards the mid-60s, but again, in a very, very gradual...
There are some flashes on the screen which suggest that there have been some concerns within Saudi Arabia as well. Some oil facility perhaps being hit, and I mean, of course, this is still being confirmed, but we do see those flashes coming in. Now we're talking about another country, which is Saudi Arabia. Until now, we were thinking that if there are concerns in many of these countries, you at least have OPEC to come to rescue, Saudi Arabia oil facilities as well. Now that it's come to Saudi Arabia now, how would you look at this?
Saudi Arabia does have plenty of spare capacity. Arguably, Saudi Arabia, UAE are really the OPEC Plus members that have any meaningful and readily available spare capacity. But again, not in the current scenario. It doesn't offer much comfort to the market, because even if they produce more...
As I'm reading more, it says that it is the Ras Tanura refinery, owned and operated by Saudi Aramco, which is the oldest and largest oil refinery. One of the largest in the world, also has had some hit come in. How would you, now that we have a name and a number there, how would you react?
Yeah, look, this is going to be an ongoing danger as long as the hostilities are continuing. That ongoing danger that Iran either deliberately or inadvertently ends up hitting an oil and gas production facility or a refinery. Middle Eastern refineries are absolutely critical, especially for refined product supply, diesel supply to Europe. So that wouldn't be good news for the market in general, and especially European market, European buyers who are dependent on a lot of imports. Slightly good news for refiners as margins go up, but then again, refiners have a much bigger problem on their hands right now in terms of paying much more for crude and ensuring that their crude supplies that they had bought continue coming smoothly to their refineries.
Sure. Vandana and Manisha, thank you so much for taking us through that important conversation. It's a developing situation, what's happening in Saudi Aramco and other parts of Middle East as well. We'll keep tracking that for you and talking about crude levels as well. For now, we'll slip into a short break. When we come back, this will be an important segment, What's Trending. We'll focus on travel-related stocks. Stay tuned for that.
Fly Emirates, fly better.
Low point of the day, or just about getting there, we have the mid-caps which are under pressure, down around 2.2% currently, and the Bank Nifty which has now shed 873 points. So markets take center stage, and one segment which seems to be really taking the brunt in today's trade is the entire travel-related stocks. So this is our What's Trending segment. We have Madiha joining in to tell us more about all of the travel-related issues which are taking place at this point in time. Madiha, over to you.
Well, since the conflict continues to escalate, large parts of West Asia airspace remain impacted, particularly Tehran, Tel Aviv, Beirut, Baghdad, Jeddah, Bahrain, Amman, Kuwait, Doha and the UAE are the most restricted airspaces currently, and there is no flight movement seen in this region. Indian Airlines have suspended operations to the Gulf since the 28th of February when the conflict started. So Air India, Indigo, Air India Express, SpiceJet have cancelled flights to Gulf destinations until the 2nd of March, which is today, and Akasa Air has just announced that it has suspended its operations to Gulf till the 3rd of March, which is tomorrow. Now, Indigo, the largest Indian carrier, has suspended all flights to the Gulf and several western destinations. Airlines are now looking at alternate routes to continue long-haul operations. Air India, for example, is using the Oman-Saudi Arabia corridor to operate flights to Europe, the US and Canada. Several Air India flights were seen today which were airborne, including services from Delhi and Mumbai to London, Rome, Vienna and Paris. Foreign carriers like British Airways are using the Afghanistan-Pakistan airspace corridor to operate flights to India, Singapore and Australia. So all are avoiding the Middle Eastern airspace, but the rerouting comes at a cost. Flight times increase, fuel burn rises, operating costs go up, crew schedules get disrupted. And three major Middle Eastern carriers, which is Emirates, Etihad and Qatar Airways, that carry bulk of the transit traffic from Asia to the West via the Middle East, have suspended all flights until the 2nd of March. And we're also hearing that the UAE airspace will remain closed till the 3rd of March as well. So more disruptions will continue. But with thousands of passengers now stranded at various Gulf airports, we will continue to track if there is any change in this situation and whether flights will resume anytime soon.
Okay, all right, Madiha, thank you so much for bringing us the latest updates. This is, of course, a developing situation, as Madiha said. We'll keep getting you more updates. For now, the market's under immense pressure. 460 out of the 500 Nifty 500 stocks are under pressure. Nifty is at the day's low. 38 out of 40 Nifty energy stocks are trading with cuts. There are hardly any stocks in the Nifty pack which are seeing any green. So we'll keep tracking that for you. For now, we'll slip into a short break. When we come back, we'll discuss more on markets.
Fly Emirates, fly better.
Welcome back. We're below the 24,700 mark. It's a sharp fall that we are seeing from the highs as well. If you talk about the mid-cap index, that's the one which is bearing the most amount of cuts from the top. So 2.2% lower on the mid-cap index, and the advanced decline ratio is 1:7 in favor of decline. So we'll keep tracking the market moves for you, but take your leave on this edition of Halftime Report. Stay tuned. Business Lunch will take all the action ahead.
Stocks open sharply lower following escalations of the US-Iran conflict. All sectors except defense see deep cuts.
SEBI Chairman Tuhin Kantapande, on completing a year at the helm, signals an intent to boost equity cash segment liquidity and bank and insurer participation in commodities. He aims to cut FPI registration time to 5 days and assures no new action on options till impact of earlier steps are assessed.
Brent jumps as much as 13% in its fourth biggest single-day move since 1990 after Israel and the US strike Iran. Natural gas prices have also surged as insurers hike premiums, cancel policies, and shipping companies reroute vessels from the Strait of Hormuz.
Jefferies global head of equity strategy Chris Wood thinks Trump may quietly back off from tariffs as these are unpopular among Americans. He also thinks gold is a good bet, while flagging the rupee slide to $90 was a negative for FPIs.
Good afternoon. You're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Fatakia. With me as always, Arundhati Raman. And Arundhati, good afternoon.
Hi, Hormaz. Good afternoon. I mean, it's been a weekend where, there's been this war in West Asia and the markets opening sharply lower, still at the low point of the day. Not looking good for the markets today.
Your jacket is reflective of the Monday blues, and you can see that on the screen as well. Almost 500 points now lower on the index, 24,700. After every hour, the index is trying to fight 100-point lower levels. At around 12 o'clock, we were fighting to hold 24,800. Now we're fighting to hold 24,700. It's every single recovery that you are seeing intraday is getting very, very swiftly sold into. There is absolutely zero respite from any sector whatsoever. All stocks on the Nifty Bank trading with losses. All stocks on the FMCG index trading with losses. All stocks on the IT index, PSU Bank index, Realty index, all of them trading with losses. 14 out of the 15 on the Nifty Auto and 38 out of 40 on the Nifty Energy. That tells you a lot.
Absolutely. And if you take a look at that advanced decline ratio as well, it's 1:7 in favor of the declines, right? So it shows you what kind of a picture it is for the markets today. And if you take a look at the sectors, there's only one sector in the green, and that's those defense names, right? We've got Paras Defense, Bharat Electronics, Bharat Dynamatics, all of them gaining. Bharat Dynamics coming off its highs also about just a little bit in the green right now. BL, Paras Defense, both of them. Paras Defense 7% in the green. BL about 1% in the green. So those are the only stocks that are seeing some respite today. But these stocks are also significantly off their 52-week highs. We've got OMCs that are losing in trade, HPCL, IOC, BPCL, all of them down between 2 and 4%, as you can see on your screens. L&T is the top Nifty loser and is seeing cuts of over 6% at this point in time, close to 7% lower in trade. And this is due to its significant exposure in the Middle Eastern market, right? And if you look at some of those tourism names, we've got SpiceJet, that's down about 8%. And we've got Interglobe Aviation, which is also down about 5%. Lots of names in the red, as Hormaz pointed out. But the top story today, Iran's supreme leader, Ayatollah Khomeini, has been killed in airstrikes by the US and Israel. A member of Iran's Guardian Council, Ayatollah Arafi, has been appointed as the interim leader. Iran has promised revenge and launches ballistic missiles at Jerusalem, Bahrain, Doha and Kuwait in retaliation. US and Israel also launched a fresh wave of strikes at the heart of Tehran for the second day. Iran claims a school was bombed, leading to the death of nearly 165 children. With missiles flying around the region, the airspace has been closed and thousands of flights cancelled. Around 850 flight cancellations have been cancelled in India as well. Maritime route has also been disrupted after tensions erupt in the Strait of Hormuz. This small stretch carries 1/3 of the world's crude oil trade. Following the US and Israeli airstrikes, Iran's Foreign Minister Abbas Araghchi said that they have a good record of being open to diplomacy, unlike the Americans, who have a very bad and negative record. Meanwhile, US President Donald Trump says combat operations are going to continue in full swing. Take a look.
All over Iran, the voices of the Iranian people could be heard cheering and celebrating in the streets when his death was announced. The entire military command is gone as well, and many of them want to surrender into saving their lives. They want immunity. They're calling by the thousands. Combat operations continue at this time in full force, and they will continue until all of our objectives are achieved. We have very strong objectives. They could have done something 2 weeks ago, but they just couldn't get there.
And Sanjay Suri is now joining us on ground from Israel to get us the latest. Sanjay, tell us more.
So this here is Beit Shemesh, a small town about halfway between Tel Aviv and Jerusalem. And this is where the Iranian missile hit. This here, this rubble that we see now, was a synagogue, and people had come there to pray. And while they were praying, there was a siren sounding, alarm that there will be a missile on its way. Beneath the synagogue was a shelter. They duly sought shelter over there. As it happened, this turned out to be a direct hit. A missile with an estimated 500 kilograms, a half-ton warhead, hit the synagogue directly. There's no sign left of that synagogue, and the devastation finished the shelter. There was no sign really of the bodies too. The impact was so severe, and we can see that there has been damage caused all around. There is shock waves that have flattened roofs nearby in the neighborhood. People 100, 150 yards from here were shaken in their homes. Their window panes were smashed. There will be questions really about shelters primarily, how those could be strengthened and made bomb-proof to an extent, considering that there is no absolute guarantee of anything. But more worrying, a question how this missile got through. Again, bearing in mind, there is no such thing as a 100% guarantee of success in intercepting missiles. Israel has 3 layers of defense in place. The Iron Dome, above that what's called the David Sling, and on the very top the Arrow system. Between the 3, this missile could not be intercepted, and most certainly there are investigations continuing how this missile managed to get through and whether defenses can be strengthened. This is only on the 2nd day of the war. On the very first day, an Iranian missile got through to hit an apartment block in Tel Aviv. 1 woman was killed, many were injured, and there was great devastation all around. The whole apartment block was destroyed. This came on the 2nd day. The question is how much more destruction and devastation will follow. This war looks set to last for quite some time, and there is concern in Israel and Iran how much death, how much destruction this will leave behind.
So Sanjay Suri there in Israel, bringing us the latest on the West Asia war. But on that note, it is time for us to head into a short break. More news and updates on the other side. Stay tuned.
Fly Emirates, fly better.
Welcome back. You're still with us on Business Lunch. Oil prices continue to soar higher in trade on the back of the Iran-Israel tensions. Let's go across to Manisha Gupta to get us all that's happening in the commodities space. Manisha?
Markets have had 24 hours to digest this, and is the reason that even as we saw the crude oil prices gain up by 13%, we have seen them ease down a bit right now. There are 4 or 5 things that the street will watch out for at this point in time. One is Iran itself. Remember, it exports nearly 3% of global consumption. What really happens to that? What do those numbers look like? Second is Strait of Hormuz, and 20% of global crude passes through this one. And as of now, we do understand that Iran has not shut Strait of Hormuz, but it is the insurance companies which have hiked premium somewhere as high as 50% as well. And there have been reports of cancelling policies for some of these shipping companies also. So this is what really seems to be bothering crude prices. The third thing really is about Iran retaliating on various neighboring countries. Until now, we do understand that none of the oil facilities has been hit, but that continues to be a concern as well. And the fourth point really is about the OPEC and allies increasing production by 200,000 barrels per day starting 1st of April. And then comes India, and this is the most important point, because India imports more than 80% of its crude requirement, and nearly 40% of that flows from Strait of Hormuz. So are we looking at disrupted supply chains? Are we looking at longer routes? Is something that the street will look at. What you have on your screens right now is the times that crude has given you great strong gains in a matter of just a single day. So it really has been 5 or 6 times in the history of crude that you have seen 14-15% of a jump up with what the crude opens it, and today is one of those days. And remember, after 3 years of constant declines, this has been a year that crude is trading in positive. So 2 months of this year, and we already are 23% higher in case of crude prices.
All right, Manisha, many thanks for those details. And in further updates, Saudi Aramco's Ras Tanura refinery has been hit by a drone strike. The refinery has shut operations as a precautionary measure. Sources also tell Reuters that the situation is now under control. The eruption of the conflict has also resulted in a container log jam at JNPT. Containers en route to West Asia have been plugged in and parked at JNPT, and stuck containers have increased since yesterday, causing a problem for exporters who have to shell out parking charges for the port. Perishable items too are at the risk of spoiling. The Nifty is trading with deep cuts as uncertainty rises following the eruption of the conflict in West Asia. But is the Nifty about to hit a seasonal bottom? Hormaz is here to tell us more. Hormaz?
Well, in a screen that looks extremely gloomy, try to infuse some optimism here, or at least some hope. Now, at least for the first 2 months and the first day of March, so far the Nifty is down 5% and counting. So it's not been a very pleasant start to the year for the index. But that has been the case for more often than not over the last decade. It is the first quarter that the Nifty drops, usually makes a bottom for the year, and then starts to move higher starting April. Now, if you take a look at the last 10 years, 8 of those instances have seen the Nifty make an annual bottom either in January or February or March. Now, if you can see the first 5 years from 2016 to 2020, all of them belong to anywhere between January to March. If we take a look at the last 5 years as well, barring a couple of instances, which also includes last year, which is April, because of the Donald Trump tariff tantrum, that was one instance, and in 2022 when the Nifty made its yearly bottom in the month of June. Otherwise, in 8 of these instances, it has either been January, or February or March when the Nifty has made its low for the calendar year. Now, if you take a look at it year-wise as well, in 2016 when the Nifty made its low on the 29th of February, which is the budget day low of 68.25, it was still the time when the budget used to be presented on the 29th or the last day of February. The index gained 20% from those levels. And barring 2018, when there was only a single-digit move from the lows, most of the others have seen gains of anywhere between 15% to 30%. You may want to exclude the COVID year, of course, because that was an exceptional scenario when the Nifty fell to a low of 75.11 and then staged a rebound. Even in the last 5 years, most of these bottoms that the Nifty has made in the calendar year has either been in January or even in last year's bottom when the tariff, Donald Trump announced a 90-day pause on tariffs, the index made a bottom and then the index was up 20% from those levels. So it's not all gloomy as of now. The index we are entering a period where the index can make a bottom for the year. The street would definitely be hoping so. At least the situation in West Asia now remains the big key monitorable.
Absolutely, Hormaz. Many thanks for taking us through those details. But on that note, it is time for us to head into another short break. But more news and updates on the other side. Stay tuned.
Welcome back. Now in an exclusive interview, Tuinkanta Pandey completes his first year in office as SEBI chairman. He says that the market regulator is working to cut down FPI registration time, and the aim is to enable FPIs to start investing within days. Listen in.
I would say that, let's look at the kind of measures that we have at a regulator taken at for the FPIs.
Right.
For us, to do the market development is to see, the frictions are reduced. There is a greater speed with which they can operate. So there is a registration issue where we have completely now looking at a very different approach to registration. We want it to be digitized. We want it to be fast. We want it to be not, days or months, but actually literally a week or 5 days. So can we reduce it to 5 days? So what it takes to reduce it to 5 days? So we're working with custodians, FPIs, other market participants, and then you have now India Market Access Portal for everyone, where all the FAQs, all the different measures. So if you want to enter India, you have one place as FPI what you need to do, what documents you have.
And I must say, it does not get enough attention. It is not a hot enough topic, but it's a point which many serious foreign investors have raised over the last many years.
And these are the things that we have actually deeply engaged with them. And some of the new registrations have come with India digital signatures of submission of documents, which is an important part of delay. If you have, in this time and age, if you have always a document, physical documents, wet signatures, notarize, apostille, be submitted on different things, because you have to keep on updating the control and other measures. So whenever there is a change, again you have to send out the documents. Now, if it could be just instantaneous through digital signatures, it will really remove the friction. It's just something that we really do in our domestic market very, very effectively. We have such a digitized economy, digitized society. So this is one area where we are now pushing forward proactively to see that we move into completely digitized registration.
So from the time that FIIs, when a new foreign investor comes, registers, to the time that they're able to actually invest and start trading, etc., you want to bring that down to a matter of days, basically.
Exactly.
Right.
And we have achieved considerable progress in this.
Okay.
We have a portal-based approach. The new portal, the front end has changed, and we are engaging with them how the India digital it becomes the norm on the same sort of documents which they submit for registration, so with no extra burden.
Jio Financial Services has launched its AI-led Jio Finance app and introduced an early access initiative called FinSider. Speaking to Shireen Bhan on the sidelines of the Rising Bharat Summit, MD and CEO Hitesh Sethia said that the platform aims to cater to financial products across insurance and lending. He also said that the app will be customized to each user with agentic AI and neural networks. Take a look.
Our thinking was we need to launch a marketplace which should cover the length and breadth of every product across investment, insurance, lending products. Now, if you offer so many products, obviously there is a lot of choice fatigue. To solve for that, we said we want to make it agentic so that what is relevant for you as a customer is what is shown to you.
Okay.
And this is based on computation and mathematics. This is not based on intuition. This is not based on anything else except your context, your information.
So each app is going to virtually be different for every customer.
Yes, and that is the neural part of it. So that if your OTT and e-commerce app, Shireen, can show what you want, then why not your financial service?
Well, still 500 points down on the Nifty. 24,690 is where we stand on the index. There is absolutely no change in the advance decline ratio. Still almost 2,300 stocks trading in the red compared to just 200 stocks advancing as we speak. And well, all stocks on the FMCG index, all stocks on the IT index, PSU Bank index, Realty index, all of them trading with losses currently. Take a look at some of the big losers as of now and look at L&T. The biggest casualty possibly of this Middle East war that is currently in place. 7% lower now on India's largest infrastructure company, significant operations in the Middle East. That one is the top loser on the index currently. So 7% lower on L&T. LT Foods, another casualty of this. Rice exports currently under question. That stock too trading with losses of around 7%. And all of these names in the broader markets, be it Syrma SGS, Reddington, RVNL, RailTel, Suzlon, all of them, Ireda, trading with losses of anywhere between 6 to 7% as we speak. And this is, of course, on the Nifty 500. If we take a look at the lower market cap category names, the Yatra Online is down another 11% as we speak in today's session. Safari Industries is down 8%. Of course, that's a travel and tourism proxy with the luggage manufacturers. So 8% lower on Safari Industries, and some of the other names too not doing very well in today's trading session. What's only doing well though are the defense names. Idea Force still up 11%, Paras Defense still up 9%. Take your leave on this edition of Business Lunch from Arundhati and me. Thank you for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar, live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Putra. With me, as always, is Vivek Iyer. 500 points gone on the Nifty as we speak. The Midcap Index has taken a brutal beating. Bank Nifty is not far behind, but across the board, there's a big cut we are seeing and continuous updates coming in from the Middle East.
That's right. Good afternoon, Sonal. And, the negative news flow, especially in terms of geopolitical tensions, continue to escalate, and that's leading to a further risk-off sentiment as far as the equity markets are concerned. A lot lined up on the show. Some important sectors that are impacted by these tensions is something that we will discuss on this particular show. So let's start off with the top headlines. Stocks trade sharply down following escalation of the US-Iran conflict. All sectors except defense see deep cuts.
The West Asia conflict sends crude prices soaring. Stocks of oil marketing companies slump with input costs set to rise.
Industrials and capital goods stocks trade with deep cuts following a fresh blow amid the ongoing US-Iran conflict. L&T, KC International and Kalpataru with exposure to West Asia trade lower.
Shares of Clean Max extend their decline following a weak market debut. The stock now trades with cuts of over 25%.
The conflict in West Asia also sends defense stocks soaring on potentially higher demand for equipment. Stocks of Bharat Forge, Data Patterns, MTAR Tech hit a fresh 52-week high.
All right, those are the top headlines that we are tracking. A lot of sectors, a lot of stocks which are impacted because of what we are seeing in the West Asian region. Let's get in Jinesh Joshi, who is the research analyst at PL Capital, to focus on the aviation space. So many flight cancellations in that particular area. How does that impact some of these listed players and the aviation sector in general? Jinesh, good afternoon. Thank you so much for joining in. Well, Interglobe Aviation is one of the companies which does have frequency when it comes to Dubai, comes to Abu Dhabi. How much of their volumes does get impacted because of this? What is the impact on their ASK? Can you give us some numbers here?
Yeah, sure. Thank you for having me on the show. See, if I talk about Indigo, roughly 30% of their ASKM is deployed in international markets. And out of that, roughly about 40 to 45% of the ASKM is deployed in the Middle East region. So I think in terms of overall capacity, roughly I think 12% of the capacity is currently under duress because of the Middle East crisis.
Okay. Jinesh, so give us a sense of yields, right? What were you penciling in as far as fourth quarter FY26 was concerned? What were you penciling in for FY27? And in case there is an extension of the conflict, how will that reduce by?
Sure. So for 4Q, we were penciling in a flattish kind of a yield scenario given the guidance that they had given. And even for FY27, our growth assumption was not very high. We were expecting a growth of about 1.5 to 2%. So no doubt, I think after the FDTL scenario that took place in the previous quarter, we had seen some softness in yields come through. And I think that scenario might continue in 4Q as well. And for FY27, given we are already at about 5.1, I think expecting a meaningful rise from here on could be slightly challenging.
You know, the other factor that's impacting the aviation space, of course, has to be rise in crude prices. It was quite stable in the quarter gone by. There's a sharp spike overnight. What is the impact of $1 per barrel or say $5 per barrel increase in crude oil prices on profits for aviation companies, specifically Indigo?
Yeah, so see, if I talk about fuel CASK, roughly about 1% change in fuel CASK impacts the earnings of Indigo by about 4 to 5%. And given the fact that in the month of March, the ATF prices are up by about 5.7%, and given the spiraling issue that we are seeing in Middle East, if the crude prices rise further from here on, definitely there will be a dampening impact on Indigo, given the fact that fuel is roughly about 35 to 40% of their overall cost.
Right. Jinesh, the other question, of course, has to be the fact that Indigo, when you're speaking about only that particular company, has been grappling with other issues, right? Like issues with the roster. So is there now a worry that the company could lose significant market share, especially when it comes to international aviation? And do you also have an opinion on other ancillary players like the airport space, or do you have any sense of the impact they could face, especially a name like a GMR Airport?
See, airports I don't cover, so I won't be able to give a view on that. But as far as the market position of Indigo is concerned, I think in the month of Jan, the market share that they reported is somewhere around 63%. And no doubt this temporary issue in the Middle East that we are seeing will have an impact on their market share. But see, it's a sector-wide issue. There are airspace restrictions, which means that no airline can operate over there. So it's the same scenario for each and every company. Now, till the time this issue gets resolved, definitely there will be an impact on Indigo in terms of international operations. But once the issue gets resolved, I mean, definitely the recoupment will be as soon as the verdict comes in their favor.
Last question before we let you go, Jinesh. You said that around 12% of their total capacity is to the Middle East in terms of their flights. Does that also include flights which have a layover of Middle East? I'm just trying to understand of the total international flights that they have or the routes that they have. How much is impacted just in Middle East, and the other routes also are getting impacted, right? Something which is going via Middle East for now.
Yeah, that will also get impacted. So there are two options. Either you reroute, which will lead to a higher fuel burn and will have an impact on your margins, or you cancel that flight altogether. So it will be a mix of both these factors. So apart from the specific region impact that you're going to see on ASKM, definitely there will be a material impact that could come from rerouting as well. So there's no doubt about that. Yes, that can have an impact on fuel burn.
Well, thank you so much, Jinesh, for joining us. A short, brief interview, but we've covered most of the important points, especially in terms of number one, market share loss, margin compression, as well as the impact on deals as far as aviation stocks are concerned, especially Indigo. Well, we'll now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned. Welcome back to Midcap Radar. Well, the sell-off in the market continues. India VIX has spiked significantly over 25% higher on an intraday basis. It's the kind of spike that the VIX has seen. The Nifty, as you can see, is down over 2%. The mid-cap and small-cap end of the market have seen or bearing bigger selling pressure. In fact, both of them down almost 2.5% each. What's seeing the maximum selling pressure? Look at the OMCs, IOCL, BPCL, HPCL, all three names at the day's lowest point. Some of the auto names too, on the back of the fact that will expect to see margin impact across most of the sectors. Names like Maruti, names like Bajaj Auto, most of these names under significant selling pressure and at the day's lowest points. But a whole host of stocks is what Upasana has on our radar. This is our special segment, Mid-Cap Movers. Upasana will take us through the mid-caps that are moving around in the session.
Well, certainly the mid-cap index is down over 2%, bearing the brunt of the global geopolitical turmoil. Now, first up, let us focus on the top losers. RVNL is down nearly about 6%. Suzlon is near its 52-week low. Next up is Irida. It is down nearly about 6%. Again, it is nearing its 52-week low. Next up is IRB. It is down about 5.3%, and Voltas also down about 4% in today's trading session. Now, coming to NHPC and even CleanMax, the recent listing, that is down over 25% post the listing today. Now, let us look at some of the infra and capex themes which are down due to the higher significance in the Middle East exposure. First up is Kalpataru projects. The company has 11% exposure in the Middle East if we look at the company's order book, which is on 9-month FY26 basis. And even Thermax in Focus down nearly about 2%. It has 39% exposure to exports and order inflows 9-month basis. Now let us on the flip side look at the top gainers in the today's trading session. Tejas Networks up for the 4th straight consecutive trading session, up more than 12%. Next up is Paras Defense. Mind you that the company has incorporated a subsidiary and it enters the semiconductor business. IdeaForge is one of the biggest volume buzzers in today's trading session. The volume stand at 93 lakh versus 1.2 lakh, which is the 1 weekly average in terms of volumes. And lastly, coming to Sterlite Technologies, it is up nearly about 6% and the stock is at its 52-week high. So all in all, these are the major buzzers in today's trading session.
All right, thank you so much, Upasana, for joining us. So those are some stocks on our radar, the mid-cap index, where the advanced decline ratio is massively in favor of declines as we speak. Slip into a short break. When we come back, we'll discuss more in terms of markets and stock-specific action. Welcome back. You're still tuned into Midcap Radar. There's so much happening geopolitically. Let's try and understand what the impact of this conflict mean for the rice industry in the country. Dev Garg, who's the Vice President, Indian Rice Exporters Federation, is joining us now. Dev, good afternoon. Thank you so much for joining in. First up, if you can tell us what's the impact? How much of rice do we export to Iran and Middle East as well? And how are we already seeing a big impact that has come back?
So when such a crisis arises, the very first casualty is the freight and insurance. Because in such situations, we have seen that there is mass cancellation of containers. And also due to the unavailability of marine fuel, which in other words, we also call bunker fuel, those prices have also gone significantly up. So across the board, we are seeing that many shipping lines have imposed board surcharges. In many cases, major shipping lines such as MSC, Maersk, and CMA have imposed surcharges of up to $2,000 per container, which is a very significant amount. And in many cases, containers have even been cancelled. So today we are in a situation of great uncertainty where the supply chains have seemed to be broken down to the Middle East. So secondly, with respect to insurance premiums as well, because any cargo that is exported out of the country has to be covered by insurance. Otherwise, exporters are and the foreign exchange is subjected to greater risk. In many cases, insurance has been suspended and insurance premiums have significantly gone up. So we have even advised our members to not undertake any exports on CIF basis, that is cost insurance and freight basis. On the other hand, we have advised them to conduct all contracts strictly on FOB basis to mitigate such problems in the future. Now, if you look at the export scenario, the Middle East is the biggest market for basmati rice from India. We export our exports this year from April till December to the Middle East have been around 27,000 crores. This is quite significant because out of the entire export bracket, this accounts for nearly 25% of all rice that is exported out of India. Now, if you look at the major markets for basmati rice, the top 5 markets are all in the Middle East. Number 1 being Saudi Arabia, followed by Iran, followed by Iraq, Yemen, and Kuwait. So all these, the top 5 markets for basmati rice that account for nearly 50% of all basmati rice exports are directly affected by this crisis. So today we are currently in a wait and watch situation because the situation in Iran has quite deteriorated. Nobody has been able to touch the importers that are there in Iran. In the past 2 months, we had seen that there was a massive stockpiling of stock in the Iranian market. That also saw a major increase in the domestic basmati rice prices. We saw that basmati rice prices in India went from 10% to 15% only in the last.
Dave, we seem to have you on a bit of a patchy line. Dave, if we could interrupt you. Seem to have you on a bit of a patchy line. Like Dave was saying, there has been a significant impact, especially as far as exports from India are concerned for the rice players. A couple of stocks, that do make rice and export it abroad. Look at a name like LT Foods, that particular stock you can see down 7%, KRBL down 4%, even a name like Heritage may not have too much of export, but again, that particular stock too is down over 3% today. Dave, thank you so much before we were interrupted by a slightly patchy line. If you could give us a sense of the kind of impact the last 3 to 4 days have seen, especially in terms of inventory piling at various ports. What is the quantum, if you could quantify the amount of rice or the tons of rice that are now stuck at various ports, and what are the options that exporters have to go ahead and get this freed?
Stuck at the destination is to be at the mercy of the importer. Because sitting in India, when the flights are not operating and you're not able to visit the importing destination, so the only option is to pray to God that nothing wrong happens and the situation comes under the control and the importers are unaffected by it. Whereas on the other hand, for people whose cargo are in transit, so they have an option of redirecting their cargo to some other destination. So those options are also available. And for the cargoes that are currently lying at port, they have to wait and watch before the situation improves, before making the shipments. Because if they ship in the current scenario, that will expose them to a very great loss and significant risk going forward. Every month, we are seeing that exports to the Middle East are ranging somewhere around 3,000 to 4,000 crores. So now in the next 2 months, in March, we are expecting that all these exports will come to a standstill. There might be some export, but we are seeing a significant drop in quantity in the next 1 month. We are seeing that we anticipate that more than 80% drop in the quantity exported to the Middle East. In the past 4 days, if we talk about the insurance, about the fuel cost, fuel costs have gone up from $570 for bunker fuel, that is the marine fuel, to around $680 today. Now, what this further, because since we are hearing disturbing reports about attack on oil refineries, where this price increase will further go is a subject matter of speculation. And in the coming days, we'll have a more clearer picture on it. With respect to ocean freights, we are seeing an increase in ocean freights of up to $100 to $150 per metric ton, which is a very significant increase for a single day or 2 day increase in shipping freights. But the more important concern is the non-availability of cargo and vessels being cancelled. Because today, even if you have a booking in your hand, there is no clarity whether that vessel will come to the port or whether that vessel will reach the destination. So we are currently sitting in a complete environment of uncertainty, and the risk profile today is very high. So we have advised all the...
Okay. All right, Dev, take that point. Totally take your point as well. We are sitting in an environment of uncertainty, rising freight costs, rising crude oil prices, going to impact exporters and travel as well for the industry. With that, let's move on and talk about an exclusive interview. As Tuhin Kanta Pandey completes his first year in office, the SEBI chairman says that the SEBI is working to cut down FPI's registration time, and their aim is to enable FPIs to start investing within days. Listen in.
I would say that, let's look at the kind of measures that we have at a regulator taken at for the FPIs.
Right.
For us, to do the market development is to see, the frictions are reduced. There is a greater speed with which they can operate. So there is a registration issue where we have completely now looking at a very different approach to registration. We want it to be digitized. We want it to be fast. We want it to be not, days or months, but actually literally a week or 5 days. So can we reduce it to 5 days? So what it takes to reduce it to 5 days? So we're working with custodians, FPIs, other market participants. And then you have now India Market Access Portal for everyone. Where all the FAQs, all the different measures. So if you want to enter India, you have one place as FPI, what you need to do, what documents you have.
And I must say, it does not get enough attention. It is not a hot enough topic, but it's a point which many serious foreign investors have raised over the last many years.
And these are the things that we have actually deeply engaged with them. And some of the new registrations have come with India digital signatures of submission of documents, which is an important part of delay. If you have, in this time and age, if you have always a document, physical documents, wet signatures, notarized, apostilled, be submitted on different things, because you have to keep on updating the control and other measures. So whenever there is a change, again, you have to send out the documents. Now, if it could be just instantaneous through digital signatures, it will really remove the friction. It's just something that we really do in our domestic market very, very effectively. We have such a digitized economy, digitized society. So this is one area where we are now pushing forward proactively to see that we move into completely digitized registration.
So from the time that FIIs, when a new foreign investor comes, registers, to the time that they're able to actually invest and start trading, etc., you want to bring that down to a matter of days, basically.
Exactly.
Right.
And we have achieved considerable progress in this.
Okay.
We have a portal-based approach. The new portal, the front end has changed, and we are engaging with them how the India digital it becomes the norm on the same sort of documents which they submit for registration. So with no extra burden.
Well, that was the chairman of SEBI speaking to our colleague Prashant, talking about how they will go ahead and cut down registration time for FPIs. Well, with that, it's all the time we have on this edition of Midcap Radar. Your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny Motiwala. With me is my colleague Arundhati as well. Arundhati, good afternoon. Today, obviously, we are seeing red across the screen. Given the tensions that we've seen on the West Asia front, US, Iran, Israel front, and there's no de-escalation that seems to be coming in even today.
Absolutely.
And markets day's lowest point, if you pull up the Nifty chart as well, 24,600, it's just managing to hold on to that level. Broader end of the market, that's also clearly seeing a bit of a pressure and underperformance coming in. Look at the Nifty days low. Like I mentioned, for the Nifty 50, mid cap 2 is down 2.66%, which is also at the day's lowest point. Small cap also trading at the day's lowest point. So broader end of the market too under pressure. And in terms of sectors, all the sectors are trading in the red, whether you look at the realty space, PSU banks, autos, no respite there. Everything in the red today.
Absolutely. Even the defense stocks that were at one point, the index was in the green, that's also in the red now. Everything across the board in the red. If you take a look at that advanced decline ratio, it's 1:8 in favor of the declines. And if you pull up a few stocks like Paras Defense or, Bharat Dynamatics, those stocks are doing a little bit, they're doing well, they're in the green. But if you take a look at every other sector, whether it's L&T, which is the top loser on the Nifty, that stock has a lot of exposure to the West Asian market. So, that's down about 7 to 8%, if you can bring that up on your screen. Even stocks like SpiceJet, we've got Interglobe Aviation, all of them not doing so well in trade today on account of what's happening in West Asia.
Absolutely, clear pressure coming in on most of these names today and uncertainty that is building in over there. But on that note, let's get started the show and answer all those stock-related queries with our experts for today. We have Ashish Gyal, Chartered Market Technician and author at Wave Strategy Advisors, as well as Gaurang Shah, Senior Vice President at Geojit Financial Services, joining us on the show to answer all those queries that you all have sent us. First up, let me get started with the first query. We have Umesh Jain, who's writing to us from Madhya Pradesh. He holds 300 shares of Ola Electric, price is 25 rupees per share, asking if he should stay invested in this or maybe switch to another stock. Your view on this one, Gaurang?
Thank you, Vinny, for having me on the show. Good afternoon to all the viewers of CNBC TV, to you and to your colleague and my good friend Ashish Gyal, and wishing all of you all a very happy and colorful Holi from my company, our company Geojit, and myself. A small disclosure, Vinny, all recommendations that I'll be sharing with you this afternoon on the show, they are part of our fundamental research team from a long-term point of view. Our company Geojit or myself, we do not have any kind of personal investments, no financial interest, no conflict of interest. But we share recommendations to our clients on similar lines. They might have their investment interest. So this has been, Ola has been an absolute wealth destroyer. I think the IPO was at 76, correct me if I'm wrong, Vinny. And from those levels, I think the stock went up to 130 or 150. And then a one-way move downwards. In between, we saw the spike going to about 70 rupees. And then today, I believe it's at a lifetime low. As a disclosure, while the IPO was there, we had given a subscribe recommendation from a long-term point of view. But our sense, currently, we don't have any fundamental coverage on Ola Electric. And my sense, Vinny, is that it is better to be with a little bit stronger players, established players who are into EV two-wheelers as well as ICE engine two-wheelers. Would prefer names like TVS Motors, Bajaj Auto, Hero MotoCorp from a long-term point of view. My sense is that Ola Electric has a very tall order and an uphill task, especially with the recent statements that the management has made of cutting down on stores. Complaints from consumers run into thousands, Vinny, and we've seen and heard incidences of customers putting their Ola Electric scooter on fire. It's better to look at stronger names. I won't give any specific comments because we don't have coverage, but prefer established players in this two-wheeler category.
Absolutely. Ashish, coming to you, right? I mean, Ola has seen a lot of issues, from sales falling, losing market share, governance issues. The stock has seen a lot of issues happening over there. So what's your view on the stock? Any levels to watch out for?
You, all the viewers, and Gaurangji as well. I concur with his view that the stock has not done anything, and it has been correcting from the levels of 70, now quoting below 25 as well. So the overall trend is bearish. I would suggest to avoid being in the stock or to average it, do not even think of doing that. It's better to be diversifying from here. On the upside, the stock has a major hurdle, which is around 26. It needs to cross 26 for any kind of bottoming formation. Until then, it's better to be out from here and invest in something like a Hero Motocorp or other two-wheelers, or maybe Tata Motors at this level looks much better.
All right. So to look at a different stock is what you're saying. You know, the next query coming in from Karan Kapoor, who's writing to us from New Delhi. He holds 200 shares of Eternal at 250 rupees. He's currently making a loss. He asks whether to hold or exit at current levels. Gaurang, let me come to you first. What's your fundamental view on the stock?
So, Arundhati, well, we do, again, a disclosure, Arundhati, we have a positive coverage on Eternal from a long-term point of view. We have approximate target, I can put it, is about close to 350. You know, the entire shakeup that we have seen because of the news flows of new entrants coming into food delivery stroke quick commerce, there is a little bit of choppiness and volatility. People are worried, street is worried about competition being at an elevated level, discounts cutting into revenues, etc. But the number of dark stores that Eternal has opened for Blinkit and the number of dark stores they are lined up for the year 2026 and the future, our sense is that Eternal is a relatively established player. Short-term, medium-term ups and downs cannot be ruled out, but we believe that long-term this is a good investment pick. Just hold on to it for a longer period of time, and that stock price is not far away from where he has invested, 250. It's trading at about 241. In case if the stock prices go down because of the geopolitical turmoil that we're witnessing, then somewhere close to about 220 or 225 would be a decent level for fresh investments, as well as adding on to your existing investments in case if you got in at higher levels.
Ashish, your view coming in for Eternal, what should the viewer do? He's bought at 250 rupees. Hold or exit?
My suggestion would be hold. His buy price is pretty decent because 250 rupees, the stock has been correcting from around 310 levels, and 250 looks very much near around where he bought. So hold on to the stock here. Over short term, we are seeing some pressure, but I think eventually the stock should move back towards the level of around 300 on the upside. On the downside, the support for the stock is around 227, where stop loss can be maintained.
We'll keep an eye out on those levels over there for Eternal. But just a quick look at the markets right now. Since we started the show, we were talking about 24,600 and just managing to hold on to that. And we're seeing a spike up coming in from those levels. Now it's at 24,750. So almost a 100-point recovery, Arundhati. In just the few seconds that we spoke about, we've seen that recovery coming in. Look at it. You can see that spike up in the last few minutes since we started the show. 100-point recovery there for the Nifty 50 broader end of the market. So Nifty mid-cap also has seen that recovery coming in. So that will be something that you should watch out for and where that is headed. But let's keep it going then with the stock-related queries as well. And the next query for today, we have this coming from Chetan, who's writing to us from Mumbai. He's holding 600 shares of Chambal Fertilizers. This is at a price of 525 rupees per share, as well as he's holding 300 shares of Vikram Solar. And this is at 300 rupees per share. So for Chambal Fertilizers, he's making a loss, and even on Vikram Solar, he's making a loss as well. Gaurang, what should he be doing with both the stocks? Should he continue to hold?
In a time like this, fertilizer sector, Vinny, does go through a lot of choppiness and volatility, given the kind of news flows that we have, point number one. Point number two, on the sector itself, we are positive. We have a positive coverage on a company called South-based company called Coromandel International. On Chambal Fertilizer, we don't have a specific coverage, so I won't be able to give a specific on buy, sell, hold for Chambal. As far as the second question is concerned, Vikram Solar, we had a subscribed note on the IPO. This was last year, I believe, in August 2025. In case if the investor has investable amount, since the investor got in at about 300 odd levels, if I heard that right, and the stock is trading at about 166, 167, you can add to it. This recommendations I'm making, keeping in mind the IPO note that we had subscribed from a long-term point of view.
All right. And if I can go to our other guest as well to ask Ashish about, these two stocks. We've got Chambal Fertilizers and we've got Vikram Solar. What is your view on these stocks?
Chambal Fertilizer has been consolidating between the range of around 470 as a resistance on the upside and 425 as the support. And it's moving in that range. So right now, hold on to the stock that you have, and if it manages to break 470 levels, we can expect it to go towards the level of around 520 on the upside. So hold is the recommendation with the support and the stop loss, which is going to be 425. As far as Vikram Solar is concerned, my suggestion would be to be out from here. The stock has been falling since the high was made around the levels of 400, and since then it has not recovered anything on the upside. It is best to be out from Vikram Solar. And we can clearly see that oppose the tariff implementation again on the solar panels, we have seen a substantial down move in this entire space. So it's better to be out.
Okay, but better to be out from Vikram Solar is what you're saying. The next query is coming in from Parag Joshi, who's writing to us from Navi Mumbai. He holds 60 shares of JSW Energy at 628 rupees. He wants to know if you should buy more or average or hold. He's currently making a loss on that. Gaurang, can you tell us what your view on the stock is?
So under the disclosure, we have a hold and a add recommendation buy call on JSW Energy. The entire power generation is go through major changes, keeping in mind the government policies and the additional new power generating capacities that is going to come up. 70-75% is going to be based on clean and green energy. You got in at a little bit higher level, but the market is giving you opportunity to add to it in case if you have the inclination of adding more to your investment. So hold and add would be the recommendation on JSW Energy.
Okay. Ashish, your view for JSW Energy, buy, average, or just continue to hold? The viewer has bought it at 628.
My suggestion would be at these levels, one can look forward to average. We can see that the entire energy space is again reversing back on the upside. JSW Energy has formed a very big base since around Feb 2025. It has been moving in a range, and eventually it should give a breakout. So average can be done at the current levels, but maintain a strict stop loss of around 450 levels on the downside. On the upside, we can expect the stock to eventually break out 550 and head towards its cost price of 600 above, and we should be able to see that again.
Okay, surely we'll keep an eye out on that. Maybe can look to average is what is the word on the technical as well. But on that note, we're going to sip into a very short break. We'll come back with more on markets and more on your stock-related queries after this break. Welcome back to your stocks and CNBC TV 18. Let's look at the markets quickly because we are seeing a bit of a recovery coming in from the day's lowest point. 24,770, about that mark is what the Nifty is trading at, so close to 24,800 levels. Good recovery that we've seen in the market in the last 15 minutes. And in the last 15 minutes, that I would like to highlight in terms of the Nifty 50 stocks that have seen a bit of an up move from the day's low. Let's talk about some of that as well. Like you can see, 182 points recovery. So what is supporting this recovery? Eicher Motors pulled that up because that's the one that's gone up 1.5% in the last 15-20 minutes. We have Hindalco, we have Adani Enterprises, Adani Ports that is seeing some bit of an up move in the trading session. So keep an eye out on that. You did see the list of contributors on the screen for you all as well. These are some of the movers that have come in. Broader end of the market too, obviously, is seeing recovery with the markets. Now Nifty mid cap is just down 1.5%. Previously it was down more than 2%. So clearly some bit of a recovery since 2 p.m. that we've seen coming in on the screens. But let's keep it going then, Anandati, with the stock related queries.
Absolutely. So the next query is coming in from Sriram Raghuraman, who writes to us from Chennai. He holds 25 shares of Cupid at 91 rupees, and he wants to know the one-year prospect on the stock. You know, Ashish, he is making a profit on this stock. Any key levels that he needs to watch out for?
See, the overall trend for the stock is broadly in a range. We can see that the stock has been finding a hurdle on the upside and is currently trading around 385. The support on the downside is at 364. Hold on over here with 364 as a stop loss. And on upside, we can expect the stock to cross that 450 mark and possibly reach towards 500 again.
Okay. Shalin, we'll keep an eye out on those levels over there for Cupid. Let's move on then to the next query. We have Govardhan, who's writing to us from Bangalore, and he wants to know the future prospects about specialty chemical shares, Deepak Nitrite, Lakshmi Organic Industries. Gaurang, today is a day a bit that we've seen, some of these names clearly are under pressure given what is going on the West Asia front. But in these two names, what would you be looking at for an investment proposal?
Well, so, the problem with specialty and agrochemicals sector, there was a thought, Vinny, that export market will open up a lot of opportunity. But now with the geopolitical tension, unfortunate thing is we cannot have any kind of preemptive ideas as to when this will end and how this will end. Having said that, we have a couple of fundamental ideas in the specialty agrochemicals, other than, of course, Deepak Nitrite. We don't have any coverage, but we like names like PI Industries, Tata Chemicals, Pidilite. And these are some, proven track record names with some strong management track record. My sense is that in markets like this, when you have opportunity, you should focus on established players and niche and marquee balance sheet with sound management.
All right. So you're saying he needs to focus on better names in the space. What about Ashish? What's your view? What's your take on this sector? And is it the right time to sort of enter these two names, Deepak Nitrite, Lakshmi Organic Industries?
See, I would recommend not to enter into Lakshmi Organic. The stock has continuously moved down and has not shown any kind of a positive traction. But Deepak Nitrite is forming a triple bottom kind of a pattern. There is a low which it created at 1516 levels in December, then again in the month of January, and again it's today showing some kind of a bounce back activity from those levels. So it's a very important support zone. 1510 should remain intact on a closing basis, and we can expect the stock to move back toward the level of 1700. So if one wants to enter, can enter now, but maintain a strict stop loss, because if 1510, 1511 is broken, there can be more pain left on the downside.
All right, so maintain a strict stop loss is what you're saying. The next query coming in from Richie Lalu, who's writing to us from Kerala. He is planning to invest around 1 lakh rupees in Zen Technologies and wants to know the outlook on the stock. Gaurang, let me come to you. What's your take on the stock? Is this a good stock to look at?
Well, with the theme in mind, there is a possibility of the entire defense-related names to perform well, given the kind of geopolitical situations that we have in front of us. Zentech happens to be a decent player. Unfortunately, since we don't have a coverage, I won't be able to give any specific view. But alternative investment idea, if somebody wants to look at defense, then we have positive coverage on names like BEL, MTAR Technologies, Astra Micro, a relative competitor to Zen Technologies, could also be looked upon from a long-term point of view.
Okay, some of the other names also that you've highlighted that one can look at from the defense perspective. Ashish, your view, Zen Technologies, is that a good bet, or would you also suggest some other names on the defense side?
No, I would suggest to be out from Zen Technology. The stock has been moving in circuits. We can see that happening in July 2025 when the stock crashed with lower circuits. Since then, it has been consolidating in a very, very narrow range. It's not going in any direction. The volumes have been erratic. So it's better to be out from Zen Technology, and maybe something like a BEL should be a better choice.
Okay. Some of the other names that even you have highlighted, Ashish, thanks so much for that. Next query for today is coming from Punitha, who's writing to us from Tamil Nadu. Holding 200 shares of Shakti Pumps, price is 700 rupees per share. Long-term investor, wants to know if he should continue to hold, sell, or average. Ashish, your view on this one?
See, Shakti Pump had a very important support of 560. The stock has broken that support level as well and is not showing any kind of positive attempt. My suggestion would be maintain a stop loss of now at around 455. That's the low which it formed today and bounce back. So 455 can be a very important support. The stock needs to prove itself by going above that 570 mark. That's far away, but there is no in between. There are no other levels. 570 is the only resistance level which it has to break and cross above. So hold with a strict stop loss, and 570 needs to be crossed from here on for Shakti Pump to perform well.
All right, so hold with a strict stop loss is what you're saying. All right, Ashish and Gaurang, we're completely out of time on the show, but thank you so much for joining us and answering all of our viewer queries.
Okay, and with that, we're absolutely out of time on this edition of Your Stocks. Thank you so much for tuning in. Remember, you can send us your queries on the WhatsApp number that will be on the screens for you all, or you can email us your queries as well. So do send us your queries. We'll get them answered on Monday, Wednesdays, and Fridays on Your Stocks at 2 p.m. But the last set of trade is still left, and for that, you have Closing Bell, which is up next to take you through all of that.
Go beyond market headlines to understand the reasons for the day's movers and shakers, and get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Taiwan index is down 5/10 to 6/10%. Hang Seng is down more than 1%.
Iran's formerly supreme leader, Ayatollah Khamenei, is dead.
And analysts are pointing out that, crude prices perhaps can head to $100 per barrel.
Between May and July 1999, the Sensex was up 37%.
We basically like only one company, Bharat Electronics. The issue, of course, is the Strait of Hormuz and the proximity to it. 21 to 22 million barrels a day of oil goes through it.
Straight away, the first tick on the Nifty is 24,850, 880, 890.
And in the medium term, I see big further upside in gold.
Markets are still under pressure, the Nifty as well as the Nifty Bank. However, we have come off a little bit from the lows.
We will continue to monitor this and have the data put it out.
We started the day with $82 a barrel. Since then, it is 6% on the higher side.
First time we've actually crossed the 6,000 mark on these vehicles as well.
Basically, if you look at our exposure in Middle East, we have around order book of around 10,000 crores.
They opened lower, far lower, and thereafter there was a bit of a recovery from the lows. That recovery has swiftly been sold into as well.
All stocks on the FMCG index, all stocks on the IT index, PSU Bank index, Realty index, all of them trading with losses.
The negative news flow, especially in terms of geopolitical tensions, continue to escalate, and that's leading to a further risk-off sentiment. Well, that was the day so far. Hello and welcome to Closing Bell. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel and with me is Rima. Well, Rima, final 60 minutes. We have a break tomorrow. The pullbacks have been feeble, but there is some kind of buying from lower levels, which is encouraging. However, the breadth of the market that actually had improved at around 11 a.m. odd, that's given away yet again. You only have around 350 stocks that are advancing. At one point of time, it was around 600 odd. But I think exciting 60 minutes coming up, because some will hope that there is de-escalation in the next 48 hours, then they'll want to play for a long trade. While the weekly expiry factor will also play a role, because at higher levels, you are seeing supply that's coming in.
The morning low was about 24,650, which was a panic low. We recovered quite smartly from that level, but once again, selling pressure came through. And then the intraday low on the Nifty was 24,600, from which again, we've started seeing some buying. So the Nifty, from the absolute low that it hit just some time back, as you can see, closer to 2 o'clock, has managed to recover about 130 odd points. So let's see whether we can hold on to 24,600 to 24,650. That is key, because that is a level above the February intraday budget low, which was about 24,571. But it's bleak, it's red across the screen, an absolute bloodbath across the key sectors. And the news flow, the headlines coming out of Iran, Israel is not looking good in terms of the destruction, in terms of the death toll, in terms of just the pure development. So one eye firmly on that. But how should you position yourself in the last hour of trade? Mitesh Thakkar now joins in from Bonanza Portfolio. Mitesh, hi, afternoon. What have you done with trade today? Take us through your own positions, and then what is the advice for the last hour?
Well, good afternoon. On my own positions, one, we've had this slightly negative outlook when the market started breaking down on Friday. So we have Nifty long put spreads, just some profits on one of the Nifty put spreads. I still have Nifty put options on the long side and Bank Nifty put spread. So the idea is that yes, we've had some bounce back. Yes, there will be these recoveries, because if you fall 600 points, I think 150, 200 point kind of bounce back, and I can put the direction biases remain on the negative side for me. So I think now today we had a gap down, and today is Monday, which is the weekly opening. So which means that a weekly gap has been created between 175, 150 to about 25,000. Till that zone is captured, I think the markets will see a lot of supply whenever it attempts a pullback to these levels. And on the downside, I would now pencil in targets of around 24,400 to begin with, and in a bad case scenario, 24,000 or below could also be tested. So the view remains on the negative side. On the stock side, I think Indigo is a sell. Keep a stop at about 45.75, 45.80 rather, and maybe then look for targets of around 4400, 44.10, 20. And the other stock is IRIDA or IREDA. That's a sell as well. Keep a stop at about 118 half for targets around 110.
Got that. Okay, all right. Mitesh, thanks a lot for that. By the way, a few stocks actually in the last few minutes. You have Hindalco that spiked up a little bit. Adani Ports as well has cut its losses. So a couple of these names are trying to fight back because they can only do so much, on the Nifty because their weightage is very, very low. But the US-Iran trade tensions, well, we had a slew of market voices who spoke on the impact of the ongoing conflict and how it will impact the Indian markets. My colleague Sudarshan is joining in to give us a roundup of what they had to say. Sudarshan, take it away.
So market is at a lowest level in last 2 to 3 months. Nifty is trying to protect the lows that we had seen on the budget day. So say budget 2026. In the last few minutes, we have seen a sharp recovery. Nifty had gone back to 25,800, but again we have slipped to around 25,740 odd. But in the last 24 hours, we had certain market voices talking about the impact of US-Iran tensions on the Indian market, or if it's the right opportunity to invest in the Indian market. So on top of the list is Chriswood. He believes that it's hard for markets to not account for the geopolitical risks that we have been facing for the last few days. But he advises that people can diversify using gold and energy stocks. And for gold, his target is $6,600 and also believes that it can go to as high as $10,000. Talking about the outperformance, as per him, except US, majority of the markets are likely to outperform. And on the big question, when will FPIs come back to Indian market? He believes that it can come back to India if semiconductor trade peaks with a sell-off in Korea and Taiwan markets. What about the IT? He believes that counter-trend rally in IT services is expected, but long-term growth will be a key monitorable. Next one is Samir Arora. He believes that it might be a tricky phase for market due to geopolitical tensions, but he's positive on one sector, that's the defense. And the reasoning behind that is the support that this sector is getting from government. And he says he does not believe that this ongoing war will last for so long. And amongst all the names in the defense space, one preference that he has is Bharat Electronics, or say BEL. Last one is Manish Sonthalia. He believes that incremental flows are expected into EMs also in India because valuations have turned very attractive after the sharp fall that we have seen in the last few months. His preference, auto components and tire companies, financial stocks including insurance, select commercial vehicles, power transmission and defense names. We'll have to see how the next few days pan out, but market move majorly will be decided how the geopolitical tensions happen over the next few days.
Thank you very much for that. And markets have a way to surprise everyone. In the morning, we all thought that, the historical instances tell us that all these drawdowns related to geopolitical uncertainty turn out to be buying opportunities. Well, at least not on day one. Today, the screen is very much red. Let's get you some more opinion. Mahesh Nandarkar of Jefferies says India's economic links with West Asia are strong, with the region taking 17% of India's exports, providing 55% of its crude oil and 38% of worker remittances. He says a prolonged conflict alongside a large jump in energy prices would be a major macro negative. A prolonged conflict and a rise in crude prices. However, he adds that recent regional conflicts have been temporary and a dip could be a buying opportunity. He says they're immediately negative on oil marketing companies, travel, hospitalities, rate-sensitive names, and positive on defense on the back of these developments. Dipan Mehta is now joining in on this last leg of the show. Dipan, difficult day, but would you treat it as a buying opportunity? Or did you?
Rima, good afternoon. Thank you for having me on your show. In my 35 years, how many days I have seen like this, where the markets correct the way because of some geopolitical event, and still I get stressed out about it. So, it's easy to say that it's a great buying opportunity, and who knows, few months from now, if you're looking at buying in a market like this, basically you're betting on the fact that the geopolitical event, this particular war, will end quickly and things will get back to normal. But that's so many ifs and buts over there. But the bigger problem, Norima, is that as I see investors' portfolios, as I see the flows into the equity market, they are thinning out. There's not much cash left in the portfolios because markets have been correcting and investors have been putting money to work over there. And even the net inflow into mutual funds, that also is like multi-month low. So while it appears to be a great buying opportunity, valuations are reasonable, getting into attractive territory. And certainly there's a case that India is not going to be impacted as much by the West Asian crisis. But there's a liquidity problem and there's a technical problem also. Market has gone down below 200-day moving average in a significant manner. And although I don't follow technicals, these are important indicators. So I'm just keeping the powder dry for the time being. Wait and watch, and let's see how this actually plays out. I'm not rushing in to buy. I wouldn't advise that as well.
Okay, all right, got that, Deepan. By the way, we had a swift recovery actually in the last few minutes. The Nifty has tried to fight back. You have Adani Ports actually that has recovered considerable ground. It's cut its losses big time. I recall the stock being down closer to around 6%, so that's cut its losses. Geo Financial is another name that's seen a bit of recovery, but I think we need to pull up a few more meaty names. From the lows, HUL. That one has a larger weightage on the index. HUL has actually cut its losses. It's on the verge of moving into the green. So I think we should get that one up for you. Maybe you get the FMCG index itself up for you on the screen. That as well is looking like it's making a good fight back. If I'm not mistaken, that's almost moved into the green. It was down more than 1.5%. Now that's down only 0.7%. ITC, HUL, both of them doing pretty well. And I think Coal India as well has seen some kind of a fight back. So there has been a bit of a spurt, but holding on to this sort of recovery is something that the bulls will be tracking very, very closely. Deepan, hi, good to see you, Ben. Deepan, what do you make of a couple of these auto names? Autos seem to be in good momentum. Bajaj Auto, Eicher Motors, these stocks have seen a good recovery in the last few months. Any view on these names? Would you look to buy any of these stocks?
Nigel, I think first of all, the monthly numbers were very decent across the board for all the companies. Either domestic market is doing well or exports are doing well. And that means that the interest in auto industry will remain with the investors for some more time. But look, these companies are now well discovered. I think after the GST cut, which has been a trigger for higher volume increases, I suspect that they are to an extent overowned also by investors. And my view is to remain invested in these companies, whether it's M&M or Maruti or Eicher Motors, and wait for a more deeper correction. Also, there's always the fear that base effect tends to catch up with these companies, and these kind of monthly sales figures may not be sustainable. And at the same time, these stocks are valued also significantly. So it's like a moving train. You remain invested, and if you have a longer term view, I'm sure you'll get decent returns. But it's not a pocket of a great deal of undervaluation, which is where investors must kind of focus on, because you don't want to miss a crisis like this whenever it comes to an end, to kind of rejig your portfolio to get into stocks which you may have missed or which are extremely attractively valued and yet the growth dynamics remain strong.
All right. Thank you very much for that. Let's talk about crude prices. When we started trade today, Brent was hovering around $77.5, $78 per barrel. But as the day progressed, Brent has inched now to 79.3. Manisha is now joining in to get us all that's happening in the world of commodities and crude. Manisha.
Well, thank you so much for that. Yes, when we started the day, we started 13% on the higher side. This was a knee-jerk reaction as the new week was opening, and we were reacting to the weekend therein. And since then, we have been holding around those levels, around $80 for the Brent prices there. Well, there are 4 or 5 things that the markets are looking at right now. Let me remind you that the situation is fluid. We are reacting to a lot of information that comes in on an hourly basis and is the reason you will see very, very volatile prices going forward. One is the retaliation that Iran is making in the neighboring countries. How much, at what scale, is something that the street is watching out for. The second most important is on how longer will this West Asia war last. US President has said 4 to 5 weeks. I mean, that's a long time. If it actually goes until then you are looking at much higher crude oil prices therein. The third point is about the Strait of Hormuz. Well, this is the place where 20% of crude passes by. Just let me remind you, when there was a problem at Red Sea, we saw shipping companies go via Cape of Good Hope. But when it is about Strait of Hormuz, there is no alternate sea route. So this is, when it is shut, that means it's shut. So there is no ships going through this. So even as Iran says that the Strait of Hormuz is open, but it is the insurance companies telling the shipping companies that if you want to go via that, you have to give a premium as high as 50 and 60%. And in various policies, we have seen the war as a clause being taken off. So the shipping companies are standing there. That area is quite clogged and nobody is passing through. Now, if this gets prolonged, if this is shut for a long time, then there is no way that you're looking at crude prices not gaining higher from here on. The other point is also about gas. It's not just about crude. Remember, a lot of gas passes through, natural gas passes through this Strait of Hormuz as well. Qatar is one of the major countries doing that as well. So this is another thing that the street will watch out for. The other, of course, is about hit on the energy infrastructure. Until now, in the last 2 days, we did not see that happen. But today we've seen that with Saudi Aramco's refinery, with Saudi Aramco having to shut that refinery as a precautionary measure as well. So see, these are some concerns that the streets is looking at. If this continues on, if this is more, and if there is energy infrastructure hit, then you definitely are looking at crude oil prices gaining much higher from here. We already are trading with a $10 to $15 of a premium in these current prices as well. The only reason that you haven't seen the prices go higher is, one, because there is surplus. 2, OPEC is going to increase production. 3, this is not a peak demand period. And 4, the OECD countries and China are holding huge reserves that perhaps might come into the rest of West Asia as well. But barring all of that, this is very volatile and high crude price scenario that we are dealing with.
Thank you very much for that. Back to chatting with Dipan. Dipan, you want to add anything? Do you have a firm view on what's happening with crude or any of the oil and gas sensitives which get impacted?
I don't think that it's going to have an impact as much. And I think Manisha covered it very well, that if it gets extended and if things escalate, then certainly the sentiment in crude will change and that will cause problems to the entire world, India included. But pending that situation, I think if you've missed on oil marketing companies, certainly they are a pocket of deep undervaluation, great dividend yields as well. And one could certainly look at them. A lot of the oil marketing companies have a lot of backward integration into refining itself, so they can capture the refining margins and less dependencies there on external sourcing or refined products. So that's certainly something going to work for them. But as I said, it's better to just wait and watch and not rush in. It doesn't mind if the war gets over quickly and stock prices recover by 4-5% also. Then even that point of time, the risk return will favor you. It's better to buy when there is some more certainty than in a situation like this where there's a great deal of uncertainty, because such wars can go south as well. And if it gets into a long drawn, kind of a battle for Iran, then, there are a lot of issues can come up. And West Asia is very important from India's point of view for remittances and, of course, for our energy security.
Indeed, you said that, right? You're going to keep your powder dry to wait and see how this situation evolves. But for now, the escalating Middle East tensions have disrupted travel and aviation across the region. Madiha is now joining in with a quick update.
Well, since the conflict continues to escalate now, large parts of West Asia airspace remain impacted, particularly Tehran, Tel Aviv, Beirut, Baghdad, Jeddah, Bahrain, Amman, Kuwait, Doha and the UAE are the most restricted airspaces currently, and there is no flight movement seen in this region. Indian airlines have suspended operations to the Gulf since the 28th of February, since this conflict started. So Air India, Indigo, Air India Express, SpiceJet have cancelled flights to Gulf destinations until the 2nd of March, which is today, and Akasa Air has suspended its operations to Gulf till the 3rd of March. Indigo, the largest Indian carrier, has suspended all flights to the Gulf and several Western destinations. Remember, international flights form about 15% of Indigo's overall network. So airlines are now looking at alternate routes to continue their long-haul operations. For example, Air India is using the Oman-Saudi Arabia corridor to operate flights to Europe, the US and Canada. Several Air India flights are currently airborne, including services from Delhi and Mumbai to London, Rome, Vienna and Paris. And foreign carriers are also doing the same. They're looking for alternate spaces. So say British Airways, carriers like British Airways are using the Afghanistan-Pakistan airspace corridor to operate flights to India. Singapore and Australia. So all are avoiding the Middle Eastern airspace currently, but that rerouting also comes at a cost. So flight times increase, fuel burn rises, operating costs go up, crew schedules get disrupted, and three major Middle Eastern carriers, which is Emirates, Etihad and Qatar Airways, that carry bulk of the transit traffic from Asia to the West via the Middle East corridor, have suspended all flights until the 2nd of March. But with thousands of passengers now stranded at various Gulf airports, we will continue to track if the situation changes in any form and whether flights resume tomorrow.
Thanks a lot for that, Madhya. Dipan, stocks like Interglobe Aviation, they still continue to have a strong, market share. The stock is pulled back considerably because of the company-specific issues, crude oil prices spike, and now you have this geopolitical issue. At around 4,500 rupees, you're interested. I think you'll have some investments, right, in Interglobe?
Yeah, that's it. So first, a disclosure. See, Interglobe in a good year can do 10,000 crores also of profit. It did 8,200 crores thereabout a couple of years ago. And thereafter, capacity has increased significantly. And at about 1,70,000 crores market capitalization, 17 times is not bad for a company which is controlling 60 plus market share. And even after the company-specific event, there's hardly any change in the market shares because structurally the industry is such that it takes a while for capacity to come on stream and new players to gain scale. And Indigo by itself also is adding significant capacity. And now I think the international routes are becoming extremely profitable and a big part of their revenues as well. So if you had one stock to buy in crisis, then you could consider Interglobe Aviation. But as I said, our views could be biased because of our ownership in the company. But these things tend to work out eventually, and travel will also pick up, and these disruptions may cause maybe a soft quarter or so. But once things are behind Interglobe, end of the day, it's a well-managed company, low-cost operator, and many factors going in terms of decent growth rates going forward.
Sorry, just one quick question. CleanMax, the new company that listed today, it's maxed out completely at the IPO price. IPO price was above 1,000 rupees. The stock opened at 960 and it's just gravitated lower, 20% down on that. I get that you don't want to buy anything right now in this kind of a market, but fundamentally, have you tracked this company and what are your thoughts?
That's it. I think it's India's largest independent power producer and massive capacities coming on stream, which will ensure that next few quarters, the growth rates will be impressive. And energy, of course, especially renewable energy, is a great and kind of favorite investment theme. Certainly, I think 20% lower, you could look at it, and it's not going to be impacted by the war in any way. But our preference is more for the solar and the power and the wind powered equipment manufacturers. We like stories like Suzlon and Inox Wind, and on this side, even Vari Energies and Premier and Vikram Solar. But even CleanMax per se, from these levels, I think 20% lower from its price should give decent returns to investors. And the best thing is that every time it declares quarterly numbers, you will have exceptionally good quarter-on-quarter, year-on-year sales and profit growth over there.
Got it. Okay. All right. Dipan, thanks a lot for that. In fact, on CleanMax, I think we should get an intraday chart. It went down to 760 rupees, I think so, the newly listed company. And from there, it's seen a good pullback, actually. It's pulled back, I think, closer to around 90 rupees from the lows of the day. So keep an eye out on that one. IPO price above 1,000 rupees. Stock, though, has seen some kind of bottom fishing at lower levels. Let's tell you what's going on in the F&O markets, though. I think we're focusing on the Nifty, but the important one to look at is the Nifty Bank. It went down to around the 100 DMA. That's around 59,100 odd. From there, it did see a bit of a bounce up. So the Nifty has seen a recovery because the Nifty Bank as well has managed to defend its 100 DMA. Volatility index, well, that's moving up, but that's on expected lines because the fear is back in the markets where you have a geopolitical issue. It's moved up, I think, to the highest they've seen in multiple weeks, so at around 17, 18 or thereabouts. So keep an eye out on the India VIX. From the highs of the day, actually, it's cooled off a little bit. The PCR is holding at around 1 approximately. It was around 0.97, 0.98. So that's moved up. We started the day at around 0.63 or thereabouts. Call writers, they are having a gala time today. 24,800 call. Guess what? When you went, you wound up Friday's trading session, the premium was around 440 rupees. Currently, that premium is around 80 rupees or thereabouts. But just the last few minutes, actually, the premium has moved from around 30 rupees all the way to around 80 rupees. So there was some out of the money call buying, and you made some money on that, though the writers are at play over here. 24,900 call as well. The premium, it came down to around 7 rupees just a few minutes back. We've seen a bit of a recovery. So that's why we're seeing that premium has spiked up yet again. So there's mixed activity taking place on the call side. On the downside, the 24,600 put premium has moved from around, I think, that's actually zilch right now because the time value of money is getting eroded. The short pointer is going by today's low, going by budget day's low, and going by important technical mark. I think this 24,500 mark is extremely important. You'll want to defend this mark, for the next few trading sessions, and hopefully there is some de-escalation that you hear about as well. L&T, that's one of the top Nifty losers. Aggressive shorts is what we're seeing out there. Fresh shorts in the system on L&T. Stock is down, open interest has swelled up. Petronet LNG, actually, there is some unwinding of positions on that counter. And BSC as well, we are seeing some kind of unwinding. I think the next 30 minutes still we'll have a couple of wild swings because the weekly expiry contract will play out. And also, you have a day where you hope that there is some kind of resolution. And that's why some bulls will want to take some kind of a bullish bet getting into this period. So let's see how that goes. For the time being, the Nifty has recovered more than 220 points from the low of the day. Slip into a short break, but we have Dinshaw Irani of Helios Mutual Fund who's waiting for us on the other side.
Welcome back. The market is trading with deep cuts as uncertainty rises following the eruption of conflict in West Asia. And today is day 3, and at least as of now, there are no signs of any de-escalation or abatement of the conflict. But the question is the Nifty about to hit a seasonal bottom? Hormus has poured through data over a very long time, and he joins us with his analysis and views.
Well, since there is some recovery on the index from the lows of the day, let's add to some of that optimism. Well, as of now, at least for the first 2 months of the year and the first day of March, the Nifty is still down around 5%. It's not been the most perfect start to the year for the index, despite making a record high already this year. But despite that, it can be said that this is possibly the period where the Nifty generally makes a bottom for the year, the low of the year, and then starts to recover. At least data from the last 10 years points to just that, because out of the last 10 years, 8 of those years has seen the Nifty make its annual low between January or March. Now take a look at this. From 2016 to 2020, it was always between January and March is where the Nifty made the low of the year. Even in the last 5 years, at least in 3 instances, the annual low that the Nifty made was between the first 3 months of the year, staying from 2021 to 2025. And last year, the low was in the month of April simply because of Donald Trump's tariff tantrums, or only then. Otherwise, it would have been March as well. Now you take a look at the years from where the Nifty made the low, and in 2016 on the February the 29th, which was back then the budgets were presented on the last day of February, the Nifty made a low of 68.25 and then recovered 20% from those levels. And even in 2017 it was Jan, 2018 was March. It was only 2018 where the Nifty recovery from the low of the year has been in single digits. Of course 2020 is an outlier because of the COVID low and then the subsequent recovery, but even in the last 5 years, most of the gains that the Nifty has had has been anywhere between 10% to as high as 30% back in 2021. And even then, the lows were made either in January or in March. The latest in the last 10 years that the Nifty has made an annual low has been in 2022 in the month of June. But otherwise, it's the period where the Nifty more often than not makes a bottom for the year and then starts to recover. Who knows, maybe today's low of 24,600 might just be that level.
Well, we live in hope. Hormus, thanks a lot for joining in and in fact giving us that neat piece of data. That said, let's welcome our Alpha Manager of the day. We have Dinshaw Irani, CEO at Helios Mutual Fund, who joins us. Hi Dinshaw, a rocky trading session. Samir earlier today was saying, probably you'll start deploying money today. That's the way it's played out, because, you had intraday pullbacks, but, there is still a lot of nervousness, and the sound bites that are even coming right now are making you feel a little bit uneasy. Thank God for the rest day tomorrow. But how are you feeling about the markets?
Thank you, Nigel, for having me on the show, and a very good afternoon to your team and the viewers. So Samir basically was talking about himself. He unfortunately gets a huge amount of flow every end of the month and beginning of the month. So that's what he was talking about deploying. We are having hardly any money to deploy, Nigel. So probably 1% or 2% lying here and there. But about that, probably we'll take another day. We'll wait another day to deploy it, but not in a rush to do it right now, because with so much less of money, you need to wait it out. And thankfully, yes, tomorrow's a rest day. So hopefully things will recoup. We'll get another day to make out whether things are evening out in the Gulf or no. But having said that, Nigel, I mean, if Iran had any firepower, it would have shown by now. The fact is that I think, if anything, they would be looking for a truce very shortly. So I don't think this conflict is going to last out too soon. So maybe the opportunity will not be there for long to deploy.
Right. One wonders, but why are they holding out for so long? Because anyway, as you're saying, they don't have the firepower. It looks difficult for them to pull through even a few days. But hopefully better sense prevails, and things get sorted out. That said,
they're playing a survival game, Nigel. I mean, if they go now for good. So I think they're trying to get the thing on the negotiation table. I don't think that's going to work.
Yeah, because, the captain's gone, the vice-captain's gone, a few more batsmen are gone, and you're left with not very, very strong names in the team. But still you want to go out there and, you're taking everyone on. We'll have to wait to see how things go. And hopefully, lives are saved and, human lives, not too many human lives are lost. That said, since you're not sitting on too much of cash, Dinshaw, will you all be looking at, rotating a little bit? Some of these old economy assets, these oil assets, they haven't been looked at. They've seen a bit of a spike. But sustaining this sort of crude oil prices is not something that the markets are working with. Similarly, defense companies, they could be back in business, because now this geopolitical issue is very red hot and the stocks have corrected a fair bit as well. any kind of rejig you're doing in your portfolio?
No, not really, Nigel. I think whatever stocks we got, we're very happy with them. As you rightly said, that the spike in crude prices, I don't think it's going to last. Once the conflict is over, I think they'll cool down again. Anyway, OPEC is committed to deliver more oil. I think they surprised the markets by an additional 2 lakh barrels, apart from what they were going to do earlier. From 1 to 3 lakh barrels is what they've agreed on. So basically, I don't think this is going to last out. So we're not doing any rejig in the portfolio. We'd rather deploy our money in stocks that we already hold. And frankly, I mean, quite a few have come off a bit, and probably we're excited. I mean, we're pretty enticed to do it, but we'll probably wait another day, as I said.
You want to tell us about the stocks? You said you'll wait, but you want to at least tell us the names of the stocks which are looking attractive, and at some point you will enter?
Nice try. No, we won't.
All right. Any new opportunities? I know you're not buying right now, but have you all identified any new opportunities? And if you could talk about that.
That keeps happening now and then, but frankly, I mean, right now, it doesn't look like, as I said, that even our existing portfolio, and in fact, we're very excited with the prices that we see in certain new age companies. I'm giving you a hint out here. But the fact is that, yeah, I mean, you'll we're pretty excited about these names, and we probably deploy the money there and rather than discover new names at this point in time.
Oh, which one? The delivery one? Which one?
Interpret my smile, so I don't say.
Got it. And what about on the EV place? Ola, you're out, but Ather is something you'll still hold on to, right?
Yes, sir. So Ather we continue to hold on to, and Ola also. I mean, the reason was, as I said earlier on your channel itself, that the bread and butter of that business, though it's a tech company, but the bread and butter of that business was supposed to be two-wheelers, EV two-wheelers. But that market share, he was going on losing. They were going on losing. So that's what drove us to sell it off at that point in time. So not getting back in, if that's what you're asking.
Travel and leisure stocks, they're getting hit hard. But, you know, I mean, you love to travel. I don't have that sort of, bank account, but trying to make things work. But, this is not going to be forever. The hope is things get sorted out, hopefully in the next 24 hours. When we come back on Wednesday morning, hopefully we have a brighter picture. But some of these stocks are pulling back. They're providing an opportunity to enter.
So even before that, Nigel, it's not about the bank account. It's what is in your mind and what you want to do. So
no, it's about what the wife says. I'll tell you very honestly. But tell us about the stocks.
Okay, so anyway, so basically on that front, yeah, we're very bullish. In fact, we continue to probably add there also as in we get an opportunity. I think it's a short-term blip, given that domestic tourism itself is on the way up. And frankly, I mean, the quality rooms that are available today, not only in the hospitality space, but also in the hospital space. And that's why we'll probably be, these two sectors are somewhere we'll be totally overweight on.
Okay, out of time. Thank you very much, Dinshaw, for joining in. That's the word coming in from Helios. Let's get to D Street chatter. There must be lots happening in dealing rooms today. Nimesh joins in with his insight. Nimesh?
Hi, Rimana. A small recovery from the intraday lows, but still down. Nifty is down almost 350 points. The broader markets are massively under pressure. But from a flow perspective, I don't think there is massive selling from the larger FIs. So today's institutional data could be quite interesting. My sense is there is a lot of unwinding happening in terms of margin books for HNIs and retail investors, and that's putting a lot of pressure in the broader market names. And that's the reason why the mid-cap index is down 1.5%, the small-cap index is down 2%. So that's the space where seems to be more pain and more selling. From a large cap point of view, a bit of buying as well. So, some of the commodity names are doing a bit of recovery in many of those, bitten on names as well. But technically, I think a crucial level has been broken. So watch out for, on a closing basis, watch out for 24,850. If we support that, maybe then you'll see a bit of a bounce back. But tomorrow being a holiday, truncated week, you might see that pressure going on because of the geopolitical risk. But again, my sense is, as I said earlier, the pressure in the broader market seems to be more domestic-led, more from the fact that there is a bit of unwinding happening from HNIs and retail investors because of the March end.
Got it. All right. But what about individual stocks, Nimesh? What are you picking up?
So the first on my list is L&T. It's been under pressure throughout the day, down 5-6%. But I understand there's going to be a small MOC buying in L&T so in today's market. So watch out for volumes. But you might see a small recovery in L&T only on back of that small MOC buying at a leading FIS today. So that's the first name. The second stock is Tube Investment. There was a small block in Tube Investment as well. And in the last few weeks, the stock has actually recovered from the recent lows on the back of buying interest. So even today, I understand some multiple domestic mutual funds were buyers in Tube Investment. So that's the second name. Third stock, a couple of names where there is delivery-based buying today. So while the markets are down, everybody is looking at sell numbers. NHPC and Petronet LNG stands out for me because in both these names, there is delivery-based buying at FIS today. And the last is Tata Steel. Under pressure, largely on back of weakness across all the names. But I understand there are buy flows and some large HNI investors, including a leading HNI investor, has bought Tata Steel in today's market.
Thank you very much for that, Nimesh. Always very helpful. Get into a break. On the other side, we'll get you a few BTST calls from our technical experts. Stay tuned.
Welcome back. Markets still down 330 points or thereabouts, but there has been some kind of recovery from the lows. Just want to pull up Tube Investments. The stock in the cash market is up closer around 3%. It's at around 2,840 rupees or thereabouts. But in the future space, I think it's around 2,810. So there's a 25 rupee difference out there, 25, 28 rupee difference on that. So just keep an eye out on that one. But I think we have Mitesh Thakkar who's back with us. Mitesh, what are your fresh trades?
A sell or STBK on SBI cards, Nigel, keep a stop at about 754, 755 and a target of 730 tomorrow. And the other one is on long side. KEI Industries is closing with good strength. The setup is positive. Volumes are good. So BTST here with the stop at 51.75 for targets of 52.60.
Thank you very much for that. Let's talk about defense, because that is an oasis of green in an otherwise weak market. It's been holding up strong since morning. And even many of the global defense companies have come in for strong buying. Hormus has done some data crunching.
You know, the smaller defense names are the ones that are making noise in today's session. Of course, the bigger names, the Nifty names like the BELs and the likes have also gained anywhere between 2 to 3%. But take a look at the smaller names. Paras Defense, Idea Forge at one point, of course, they were up 12-13%. They have all cooled off from the highs of the day in line with the volatility seen in the markets. But even in the US, the bigger names like Lockheed Martin and the others are up 6 to 7% in pre-market trading. It'll be interesting to see how the day pans out for them. But even if you take a look at the stocks, in general, the defense names generally react positively in a conflict-like situation. A similar scenario played out as early as May of last year during Operation Sindoor, when all of these names went up anywhere between 20 to 30% in just a month. And this is, of course, because of the fact that such conflict gives rise to the fact that there will be more requirements for defense. There will be more defense expenditure, requirement for equipment, components to manufacture these equipment, and so on and so forth. And as a result of which, they generally tend to react positively to these names. Before today's trading session, the defense index was fairly subdued at the first 2 months of the year, but there were stocks that did very well. MTAR Tech was up almost 60%, Bharat Forge was up 30%, Data Patterns was up 20%, even the Nifty constituent BEL was up in double digits, Solar Industries as well. Now there were underperformers as well. Sand DLM was down over 20%, Bharat Dynamics, one of the worst performing stocks in the month of February, was down 12 to 13 as well. So there were underperformers, but there were outperformers as well. In today's session, Bharat Forge, Data Patterns and MTAR were at 52-week highs. Sand DLM, of course, at 52-week lows. In fact, we did speak to the management of MTAR, and they mentioned that defense, in fact, is a very small part of their business. It is only 5% of their top line, and they are very selective when it comes to picking orders from within the defense segment. So that a stock that does not have a significant defense exposure is the best performer on the defense index so far. But of course, with this conflict starting to play out, the defense stocks will continue to remain in focus for the times ahead as well.
Thank you very much for that. Another stock on our radar is Muthoot Finance, because Morgan Stanley has upgraded Muthoot Finance to an overweight, kept a target price of 4,500. Gaurav joins in with more from the brokerage note.
Well, as there are a handful of stocks which are actually in green, and Muthoot Finance is one of them, and the reason being that Morgan Stanley, they have actually upgraded the target price, and at the same time they upgraded the rating to overweight. What they are saying is that the recent correction that we are seeing after third quarter is actually something which was sharp and higher than they were expecting. Remember, third quarter is actually relatively good for the company when it comes to numbers. When we look at the geopolitical risks which are rising, now that is a bit of a supportive when it comes to gold prices, where the loan book business is for Muthoot Finance, which can actually be supportive for the business itself. In fact, they believe that this also provides some upside risk to the forecast of gold prices. Apart from that, if you look at the valuation, now Muthoot Finance trades at 13th time FY27 price to equity and offers 24% ROE, which is actually attractive. Key risk, as they have highlighted, is that any sharp fall in the gold prices, and second is that high competitive intensity. Now that remains with the business, but overall, after third quarter, we have already seen Muthoot Finance actually cooled off its high levels of 4,000 rupees, and currently it's trading at around 3,400 rupees. And at the same time, gold price is also something which is supportive, and that's the reason why, if you look at the stock price today in this bearish market, we are seeing the stock is up more than 3.5%.
Got it. Okay, all right. Thanks a lot for that, Gaurav. And Gaurav is covering the stock in the green, and I think a tinge of green on his tie as well. Thanks, Gaurav, for joining in. Muthoot Finance glittering in today's session. Let's get in Amrish Balika. Amrish, good afternoon. Good to see you in. Not too great, actually, from a geopolitical standpoint, but sometimes these provide entry opportunities. First, give us your view on the gold financiers like, say, Muthoot, Manappuram, IIFL Finance.
See, I mean, as of now, it's all well because the gold prices are holding up. But the issue would be post the war, post the geopolitical issues getting sorted out, you could actually see gold prices correcting. And that's when the issues will come up for the gold finance companies. So at this point, more of a trading bet than an investment because valuations are decently high. So I won't buy fresh at this point of time. But for a trader, I think it's fine with a stop loss.
Okay, all right. But Amrish, we'll let you go on that one. But give us a nice pick. The market is hungry for ideas. And these sort of days, actually, Amrish, it provides you with an opportunity to buy the stock of your choice at the price of your choice as well, because it's that sort of a day.
And,
so which one is on your radar?
No, and at the same time, I think one should be very clear that you're not buying at the bottom. It can fall more. So you should keep some funds to buy at lower levels because you can't really call a bottom anywhere. I mean, the stocks may look very cheap and attractive at this point of time. So go ahead and buy, but keep some funds aside for a worse day going ahead. So looking at the way the markets are, the scenario is, I'm looking at more of India-centric business. So the stock is Orkla, which is a recent listing, and they have strong legacy brands. MTR and Eastern across spices and convenience foods. Dominant market share in Karnataka, about 31%, Kerala is about 42%, 15% in AP and Telangana, and exports account for about 21% of the revenue, and the market share in Indian spices exports is about 22%, which is decently high. Q3 performance was decent, spices volume grew by about 10%, EBITDA growth was 18%, and the margins improved to 16.1%. International revenue grew about 16%. Digital commerce saw a growth of 40%. So they have a huge moat in South India where it's actually a household name. So expecting an EPS of about 27 for FY28. And with that, my target price is 756, which is decently close to the IPO price.
Okay. Sorry, I missed the target price. Can you tell me?
756.
756 is the target price, so pretty close to the issue price.
Absolutely. The IPO price was 730.
730. But any particular reason why the stock, declined so much post the issue?
No, in fact, the acquisitions they had made for that to really merge and settle down, I think it took some time. So because of which, I think the margins were under pressure. But then I think from now onwards, we should see, margins also improving quarter on quarter.
Okay, all right, just hold that thought. We need to do a quick market check. It could be an expiry-related factor that's playing out. And also, it could be that optimism that in the next 24 hours, we hear some kind of a big breakthrough, actually. By the time you come back on Wednesday, you're hoping there'll be some kind of breakthrough and some kind of easing of these tensions. So just take a look at a few stocks. Bajaj Auto has cut its losses. Jio Financial is another name that's actually fighting back as we speak. And Adani Enterprises, just pull up the intraday chart out there. That as well is cutting its losses as we speak. So that explains why the Nifty is now holding about the 24,900. Remember, from the lows of the day, that's close to around a 300-point recovery from the day's low. So good going, Rima. Some of these stocks at least are seeing some kind of a fight back.
Indeed. So 24,900. On the stock, just some stocks which at least in the mid-cap end, which are seeing some buying today. Jindal Drilling is a big one. Tejas Networks continues to see buying from Thursday, Friday and today. The stock has gained close to about 40-odd%. Sterlite Tech has been a big mover. Idea Forge, Paras Defense. Hormus was telling us about the smaller defense names which have been very active. You've got Hindustan Zinc, Hindustan Copper, many metal-related plays also up and about.
A few more names, Rima. Just pull up Stovecraft, and that's another stock that's got hit very, very bad. It's been a big underperformer, but that as well is spiking up in the last few minutes. I think it's recovered considerably from the day's low. And Ambuja Cements as well has been a big underperformer, but that as well is cutting its losses. So individual stocks, they are seeing a bit of a pop from the lows of the day. And Sterlite Technologies, as Rima mentioned, has been an outright performer. The street has really been latching onto that one. Last 2 months, I think the stock is up more than 50%. If I got that correct. Last 1 month, it's up 57%. Any view, Amrish, on this name, Sterlite Technologies?
Sterlite Technologies, again, because of the data center requirement, which is going to boom going ahead, I think people are basically playing on that, as well as the 6G introduction. I think that's where the demand will also rise. So, but then at the same time, we should remember that the stock has nearly doubled from the recent lows. So at these levels, one should be a bit careful.
Sterlite Tech. iFinance is a big mover. That's up 1.5%, but a very swift recovery in the last few minutes. Jain Resource, 400 rupees stock now. Again, the stock seeing buying right now. Keystone Realtor stock has been hit 20%, but today it's bouncing back. Ajmera Realty is another one in the real estate pack, which is up and about. Vardhaman Textiles, IFL Capital is seeing some interest. Acutaas Chemicals, Swan Defense, Aztec Life Sciences. These aren't stocks that we talk about often, but they are seeing some big moves as right now. Stay on. We want to just play some sound bites when we had a chat with Samir Arora earlier, where he says that geopolitical tensions can lead to a tricky phase for the market. He also shares his preferred picks in this volatile market. Stay tuned.
It might be a tricky phase, but let's say it takes 2 weeks or 1.5 weeks, and therefore that way uncertainty is longer. But we broadly know from every other war or battle we have seen in recent years, or maybe even in the longer term, that in the next 30, 50 days, you will completely reverse the script and say, now this has settled and the US friendly thing has come and oil has come back. So therefore, once you broadly know, let us say, imagine what will happen, say 35 days later, 40 days later, 20 days later. So if you think that for the first 5-7 days, you will sell it, and then the 9th day you will buy it, I think that doesn't work. We basically like only one company, Bharat Electronics, because it does what we call day-to-day work. You don't need these very massive orders. You don't need orders which have 20-year execution cycle and all that. So basically in the end, there are very few small caps here and there, but otherwise you can keep calling it a good sector, but there are no stocks.
Welcome back. That's the screen for you. It's just red on the screen as we speak. A lot of stocks losing out today. There was a bit of a recovery that we saw from the lows, but that as well, got sold into at various points of the day. Breadth of the market firmly in favor on the number of stocks declining. Amrish, a lot of stocks are down. Some of them are providing an entry opportunity, you think? You've given us one such stock that you like. But otherwise, if I look at this month itself, in the last 1 month or so, some of these tech names have got badly hit. Tech Mahindra, TCS, Infosys. You liked any of these stocks?
Yeah, in fact, I would look at stocks like Persistent, LTI Mindtree, Tata Tech, Tata Elxsi. I think these are the ones to be looked at because they will be the first ones to really have AI, being used effectively as compared to the larger boys like TCS or Infosys.
Any defense stocks?
Defense stocks, again, I think it is going to be more of sentiment than fundamentals playing out. And because of which I would possibly use the defense stocks as possibly a trading bet. So here it would be BEL, HAL. I think these are the ones to be looked at for the next week or 10 days.
Okay, all right. What about from the metals pack? I think you've liked a few stocks over there. Today, metals actually has been an outperformer.
Yeah. Like in the metal space, I like steel as of now. I would not be looking at Hindustan Zinc or a Hindustan Copper. I think the play has already happened there. But something like a Tata Steel, there's still a decent upside of about 250 to 280.
All right. L&T, that's, perfectly in the eye of the storm right now. Stock has taken a knock.
Because of which it has taken a knock. But I think it could be a good buying opportunity at the current levels. I don't see much of a downside from here. Maximum of about 3,800, 3,850. I'm going by the hypothesis that this war will not continue, for a very long time. In fact, the way I look at it is possibly a few days to a week.
Hope so, not a week. I would go with few days, Amrish. But thanks a lot for joining in, giving us your take on a whole host of stocks. Well, time to wind down the markets. Today we had weekly expiry that played out, and the global situation itself was in a bit of a flux. And geopolitical risk weighed on our markets as well. So the Nifty goes home with a cut of around 300 points. The saving grace is that we defended the 24,500 mark on a closing basis. Stocks that got hit: InterGlobe Aviation, because travel is getting impacted, input costs have moved up, so that stock gets knocked back. L&T, it has exposure to the Middle East, so that stock is well pulled back. Adani Ports was under pressure, that was down 3.5%. Where was the place to hide then? Metals as well as defense. And from the Nifty itself, we had BEL and Hindalco. Both of them were the top gainers on the Nifty. Since crude oil prices spiked up, well, the inverse reaction is what you see on OMCs. Oil marketing companies, namely HPCL, BPCL, as well as IOC, all of them were down in today's trading session. But Rima, otherwise, plenty of action from the broader markets.
Indeed, the mid-cap index ends with a cut of about 1.5%, a similar fall coming through for the small cap index. The advanced decline ratio 1:5, 500 stocks in the green for 2,500 in the red. On the way up, all the silver ETFs were surging. Safe haven buying lifted the prices of gold and silver. HDFC Silver, Grow, Nippon India, Tata Silver ETF, all higher in trade. Even gold ETFs like Gold Bees, SBI, up and about. Tejas Networks was a big mover, so we should get that up for you on your screen. In a span of 4 days, stock has gained 4%. IFL Capital, Jindal Drilling, Idea Forge, defense names across the board. So it's Astra Micro, Nigel spoke about BEL, but Aparis Defense, all up and about. On the way down, the new listing, CleanMax, hasn't had a very good day one. Stock closes lower, 18% on day one. Travel-related stocks like Ease My Trip, Yatra Online under pressure. InterGlobe Aviation, of course, was another big drag today. You had pressure there. And then, stocks which get impacted on the back of the conflict. A SpiceJet, lower by 6.5%. Oil marketing companies, IOCL, BPCL, HPCL, MRPL, sold off nearly 3-4%. Reliance Industries, GAIL, also in the oil and gas pack, down 2.5%. We end the day sharply lower, 1.3% gone on the Nifty and the Sensex. Sensex cut more than 1,000 points, but we closed well off the session days. Tomorrow, Indian markets are shut on account of Holi. Don't go anywhere. We're wrapping up and closing bell, but on the other side is Markets Forward.
Markets remain under pressure amid escalating US-Iran tensions, with the Nifty slipping below 24,950 and the Sensex falling over 1,200 points. India VIX surged nearly 25%. The broader market saw sharp swings as well.
Crude oil prices rallied 13% as investors fear major supply disruption at the Strait of Hormuz. This is the fourth biggest single-day gain in 36 years. Oil marketing companies slump with input costs set to rise.
Flights disrupted across West Asia as several nations suspend use of their airspace indefinitely. Indian Airlines cancel flights to the Gulf till further notice. Hundreds of containers remain stuck at key Indian ports. 4 lakh tons of basmati rice exports stuck in transit.
Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to get up for the next trading day. I'm Sonal Bhutra. With me is my colleague Vivek Iyer. Vivek, good afternoon. What a day. A sharp cut on the benchmark and the broader markets as well. At a point in time, all the Nifty indices or major sectoral indices, they were in the red. But we did see recovery towards the end of the trading session. So yes, we did end below the 24,900 mark. But we recovered around 260 points from the lows of the day as well. And that was very important, considering the kind of day that we saw. The advance decline ratio at a point in time was at 1:7. For every one gaining stock, there were 7 declining stocks. That recovered too. So we ended with 1:5 as the advance decline ratio. So yes, it was the metals index, pharma index that recovered from the lows of the day. And look at those lines. It's been quite volatile from the word go. And that is something that we saw in the wicks today as well.
That's right. Good afternoon, Sonal. A very topsy-turvy day. Started off with deep cuts, a brief intraday recovery that got sold into, however, in the last hour of the trading session, like you mentioned, aided by most of the defensive names like FMCG, pharma, and the defense stocks. These stocks actually managed to buck the trend and move higher, leading to a brief recovery or a bit of a recovery as far as the markets were concerned. But here's the lineup of what we have in store for you today. We start with the top movers and shakers of the day with Hormuz. We decode the impact of the West Asia conflict on Indian markets, from commodities and crude to sector-specific action across the street. And now on to our first segment of the day. Hormuz joins us now from the Big Wall with the top movers and shakers of the day. Hormuz, over to you.
A glass half full or a glass half empty, the choice is yours to decide what kind of a day we had. But of course, predominantly red, then green. But can't also deny the fact that there was some green. But we'll start off with the red first up. And of course, the center of action being the Middle East, stocks with exposure to that had an impact. Indigo, of course, the top loser on the index, 6.5% lower, followed suit by L&T. Of course, L&T at one point was down 7%. So there was some recovery from the lows here. LT Foods, KEC, VA Tech, Vabag, all of them seeing an impact anywhere between 3% to 6% in today's trading session. A lot of other railway PSUs were sulking in today's trade. IRFC fell to a 2-year low in today's session, ending sub 100. Railtel was down, so was RVNL. So RVNL is now down more than 50% from its all-time high levels, close to 650 rupees. Now, stocks that were at 52-week lows in today's session, of course, there were plenty of them, but Electra Greentech dominated that list, was down 6%. Ola Electric continues to grind lower, as does Swiggy, and Suzlon, from highs of over 80-85, now is back down to 40 rupees, and Adani Total Gas too, ending with losses of around 4%. The one segment that bucked the trend in today's session were the defense names. Solar Industries doing well for itself, at 3.5% higher. Both Idea Forge and Paras Defense at one point were up 12-13%. They came off the highs of the day considering the volatility in the market, but still managed to hold on to gains of around 5 to 7%. And lastly, even in a market like this, there were stocks that were at 52-week highs, and most of them, the data cable related wire cable names as well. Sterlite Tech was up almost 9% in today's session in a market like this. KEI Industries continues to make new highs, and Precision Wires too, ending with gains of around 3.5% at 52-week highs today.
Okay, all right. Thank you so much for joining us with that stock check, Harmis. So those are some stocks moving around in the broader markets. Let's talk about the big story now. Iran's supreme leader, Ayatollah Ali Khamenei, has been killed in coordinated airstrikes carried out by the United States and Israel. Iran has declared a period of national mourning. A member of Iran's Guardian Council, Ayatollah Rafi, has been appointed interim supreme leader as the country prepares for a leadership transition. Tehran has vowed revenge. In retaliation, Iran launched ballistic missiles targeting Jerusalem, Bahrain, Doha and Kuwait, sharply escalating tensions across the region. The US and Israel have since carried out a fresh wave of strikes deep inside Tehran for a second consecutive day. Iran claims a school was hit in the bombardment, resulting in the deaths of nearly 165 children, a claim that has further intensified global outrage. With missiles flying across West Asia, large parts of the region's airspace have been shut. Thousands of flights have been cancelled worldwide, including around 850 cancellations impacting India. Meanwhile, maritime trade is also under strain. Tensions have flared in the Strait of Hormuz, a critical choke point that carries nearly 1/3 of the world's crude oil trade, raising fears of a major supply disruption. Iran's Foreign Minister Abbas Araghchi said Tehran has a proven record of openness to diplomacy, accusing the United States of maintaining a negative track record. But US President Donald Trump has made it clear that combat operations will continue in full force. The region remains on edge as the conflict shows signs of deepening further.
Well, oil prices continue to surge in trade, driven by escalating Iran-Israel tensions and rising supply concern. Let's go across to Manisha, who's tracking all of the action in the commodity space.
Well, thank you so much for that. Yes, when we started the day, we started 13% on the higher side. This was a knee-jerk reaction as the new week was opening, and we were reacting to the weekend therein. And since then, we have been holding around those levels, around $80 for the Brent prices there. Well, there are 4 or 5 things that the markets are looking at right now. Let me remind you that the situation is fluid. We are reacting to a lot of information that comes in on an hourly basis and is the reason you will see very, very volatile prices going forward. One is the retaliation that Iran is making in the neighboring countries. How much, at what scale, is something that the street is watching out for. The second most important is on how longer will this West Asia war last. US President has said 4 to 5 weeks. I mean, that's a long time. If it actually goes until then you are looking at much higher crude oil prices therein. The third point is about the Strait of Hormuz. Well, this is the place where 20% of crude passes by. Just let me remind you, when there was a problem at Red Sea, we saw shipping companies go via Cape of Good Hope. But when it is about Strait of Hormuz, there is no alternate sea route. So this is, when it is shut, that means it's shut. So there is no ships going through this. So even as Iran says that the Strait of Hormuz is open, but it is the insurance companies telling the shipping companies that if you want to go via that, you have to give a premium as high as 50 and 60%. And in various policies, we have seen the war as a clause being taken off. So the shipping companies are standing there. That area is quite clogged and nobody is passing through. Now, if this gets prolonged, if this is shut for a long time, then there is no way that you're looking at crude prices not gaining higher from here on. The other point is also about gas. It's not just about crude. Remember, a lot of gas passes through, natural gas passes through this Strait of Hormuz as well. Qatar is one of the major countries doing that as well. So this is another thing that the street will watch out for. The other, of course, is about hit on the energy infrastructure. Until now, in the last 2 days, we did not see that happen. But today, we've seen that with Saudi Aramco's refinery, with Saudi Aramco having to shut that refinery as a precautionary measure as well. So, see, these are some concerns that the streets is looking at. If this continues on, if this is more, and if there is energy infrastructure hit, then you definitely are looking at crude oil prices gaining much higher from here. We already are trading with a $10 to $15 of a premium in these current prices as well. The only reason that you haven't seen the prices go higher is, 1, because there is surplus. 2, OPEC is going to increase production. 3, this is not a peak demand period. And 4, the OECD countries and China are holding huge reserves that perhaps might come into the rest of West Asia as well. But barring all of that, this is very volatile and high crude price scenario that we are dealing with.
We are definitely looking at triple digits. It'll be almost impossible catch a falling knife to put a number in triple digits, because that'll again depend a whole lot on how long the worst case scenario, namely a complete blockade of oil flows, unfolds. In the event that we do see a return to diplomacy, as I said earlier, we would need to see a quick at least an interim or a framework deal for crude to meaningfully lose the risk premium it has.
Okay, all right. So that's about the crude oil prices. And of course, because of that, shares of oil marketing companies, HPCL, BPCL, IOCL, all of them were under pressure because it tends to impact their marketing margins. So that is something that we'll be watching out for very closely. Moving on now, we heard from a slew of market voices today on the impact of the ongoing conflict and what it could mean for Indian equities. To break down the key takeaways and investor sentiment, Sudarshan is joining us now with a comprehensive roundup. Sudarshan.
So on a day when volatility index has moved 20% higher, there was an all-round fall and we see a big downtake in Nifty and even all the other major indices. We need market voices who can calm the mood, and we had plenty of them through the day, but I have selected a few. First one is Chris Wood. He believes that it's hard for market to not account for geopolitical tensions and people need to diversify their portfolio using gold and energy stocks. Especially talking about gold, he believes that in the near term, gold can go to $6,600, and even in the longer term, it can go to as high as $10,000. And talking about the markets which might outperform going forward, so he believes that except US, majority of the markets might outperform. One big question that everyone has been asking, when will FPI come back to Indian market? As per Chris Wood, he believes that FIs can come back to India if semiconductor trade peaks and there's a sharp sell-off in markets like Taiwan and Korea. What about IT markets? Will we see counter-trend rally? He believes that counter-trend rally can be expected, but long-term growth will be a key monitorable. Next one is Samir Arora. He believes that might be a tricky phase in the near term due to geopolitical tensions, but as per him, this war is not going to last long. As per his preferred picks, it's defense sector, and the reason is the support the sector is getting from the government, and the preferred pick amongst all the defense names is Bharat Electronics. Last one is Manish Sonthalia. He believes that markets like India might see incremental flows in the near term, and amongst preferred picks, auto components, tire companies, financial stocks, including insurance, select commercial vehicles, power transmission, and defense names. He believes that these packs are looking very attractive after a sharp fall that we have seen in the last few months. We'll have to see how the next few days pan out, but the market move majorly will depend if there is an ease in geopolitical tensions.
Well, thank you so much.
US market, I've got a stronger view on the relative story in the absolute. So my view has been since the end of last 24 that the US has made an all-time peak as a percentage of world stock market capitalization. So to be precise, the US peaked at 67% of MSCI All-Country World Index.
Okay.
And I think that's an all-time peak, and that's consistent with my view that you're going to get a derating on the hyperscaler stocks, which dominate the US market. Sure. Because of the huge capex, which is making these companies generate less free cash flow. Sure. So I believe we've begun a period where markets ex-US will outperform.
Well, that was Chris Wood speaking to our colleague Nimesh. Well, to take the discussion forward, we are now joined by market expert Amrish Baliga and Richard Jain of Motilal Oswal Financial Services. Well, Richard, let me come across to you first. A very tough day, especially to analyze in terms of technicals. But are you enthused by the last hour rally and the last hour recovery that we saw in the markets? Where do you see Nifty headed from here on?
Yeah, very good afternoon. Well, one thing is certain that these global news flows are likely to dominate the short-term trend for the markets rather than any kind of technical levels. But today's recovery was encouraging mainly because of the previous swing low supports from where the recovery came. If you look at the recent history, then in the month of February, on 1st of Feb itself, markets formed a support around the 25,600. Even earlier in the September 2025, markets have formed a similar support base around 24,600. So last couple of occasions, we have seen 24,600 has acted as a support, and today also low was 24,600. So I think this is one of the crucial support level. If this remains intact, then hopefully a recovery could be seen going ahead if everything goes well in the global markets. But 24,600, I think, is one level which we are watching out for as a crucial support.
Take that point, Richard. Amrish, coming on this, I know things are uncertain right now. There's so much happening globally, and that's been the story for a while now. In that case, do you think fundamentally there are some stocks or sectors which are at reasonable valuations after the fall that we've been seeing in last couple of trading sessions, or something that you're watching out for to correct further?
No, I mean, surely it can be a buying opportunity, but the main question is how long this war will last. I mean, a few days or 4 weeks, as stated by President Trump, or it goes on longer, whether other countries get involved. So if you go with the hypothesis that it will last a few days, I think the impact will be negligible. So it could be a very good buying opportunity. Then if you're talking of the next 4 weeks, I think it would still be manageable. But anything beyond that, I mean, and especially if you have more countries getting sucked into this war, I think the effect could be backbreaking. But again, looking at it practically, that most of the top leaders in Iran have been eliminated. I'm not really sure as to how long this will go on, especially when there's a huge opposition within the country. And most of the stakeholders in the region may actually get Iran to stall the situation from getting worse. So I would bet on the fact that it could last a few days to possibly a week or so. And looking at that, I think it could be a good buying opportunity. Again, I would not say put all your liquidity at this point of time, but at least put a part of that at this point of time, because from here, once we see a bounce back, I think it'll be a very decent bounce back, and that can happen, especially if there's a truce.
Absolutely right. Amrish, well, I want to get a little more sector specific with you. One particular sector that bore the brunt of selling pressure today was actually the industrial space. Names like L&T, large exposure to West Asia, some of the other names like Thermax, KEC, Kalpataru. Do you feel that these dips that they saw today is a good opportunity to buy, or will you wait on the sidelines and wait for more clarity to emerge?
No, like I said, if I go by the hypothesis that it may not last too long, I think today's fall in L&T would be a very good buying opportunity. But we should remember that they have a decent exposure to West Asia, Middle East. So in case it carries on longer, yes, the effect would be much, much bigger. But keeping everything else aside, yes, at the current levels, it makes decent sense to at least put in part of your money into L&T.
Technically, Ruchit, what do you make of L&T?
What is 200 EMA can be seen. So firstly, we have seen a good volume-based selling happening today, and the 200 EMA support for stock would come around 3850 to 3700 range, so 3800 range. So I think if anyone has to do bottom wishing in this correction, then if we get the stock around there 3850, 3800, then the risk-reward ratio would become favorable.
Well, thank you so much, gentlemen. Request you to stay on. But moving on, escalating tensions has disrupted aviation routes with airspace closures and flight diversions, adding to operational uncertainty. To track how this is impacting flights to and from India, Madhya joins us. Madhya, over to you.
Well, since the conflict continues to escalate, larger parts of West Asia airspace remain impacted, particularly Tehran, Tel Aviv, then Beirut, Baghdad, Jeddah, Bahrain, Amman, Kuwait, Doha, and the UAE are the most restricted airspaces currently, and there is no flight movement seen in this region. Indian Airlines have suspended operations to the Gulf since the 28th of February, ever since this conflict started. Air India, Indigo, Air India Express, SpiceJet have cancelled flights to the Gulf destinations until the 2nd of March, which is today. Akasa Air has suspended its operations to Gulf till the 3rd of March. Now, Indigo, which is the largest Indian carrier, has suspended all flights to the Gulf and several Western destinations that it serves. And we don't know when it plans to resume these flights. Remember, Indigo has 15% of its network on international routes. Airlines are now looking at alternate routes to continue their long-haul operations. For example, Air India is using the Oman-Saudi Arabia corridor to operate flights to Europe, the US and Canada. Several Air India flights are currently airborne, including services from Delhi and Mumbai to London, Rome, Vienna and Paris. Foreign carriers like British Airways are using the Afghanistan-Pakistan airspace corridor to operate flights to India, Singapore and Australia. So all are avoiding the Middle Eastern airspace, but that rerouting comes at a cost. Flight times increase, fuel burn rises, operating costs go up, crew schedules get disrupted, and three major Middle Eastern carriers, which is Emirates, Etihad and Qatar Airways, that carry bulk of the transit traffic from Asia to West via the Middle East corridor, have suspended all flights until the 2nd of March. We don't know what happens tomorrow, but with thousands of passengers stranded at various Gulf airports, we will continue to track if there is any change in the situation and whether flights resume tomorrow.
Okay, all right. Big uncertainty. That's literally the story of the game right now. We spoke to a couple of analysts today as well, and they did indicate that Indigo, there are twin issues that they're facing. Rising crude oil prices, every 1% increase could impact their profitability by 5%, and of course, 12% of their total exposure to the Middle East area. Amrish, coming on this, Indigo was down 6.5% today. We saw disruptions in the month of December, and then this. What do you make of this particular stock, considering that it's the listed play? We do have SpiceJet, but it is usually the listed play in the aviation space.
They were just coming out of the issues which they had recently due to cancellations, and now you have this geopolitical issue which has come up, rising crude, again, a cancellation of number of flights. I think it's going to affect them decently well. And I think it'll be at least another possibly 2 to 3 quarters before they get back on their feet, like what we had seen about a year back. So as of now, I would possibly avoid the airline space and especially Indigo.
Well, thank you so much, Ambrish, as well as Ruchit, for joining us, giving us your view on a very volatile trading session, individual stocks as well as sectors. Thank you once again. Well, moving on, we'll now slip into a short break. We'll get to the top corporate voices on the other side.
Welcome back. You're still tuned into Markets Forward. Let's talk about some of the corporate voices of the day. The management of M&M Auto told CNBC TV 18 that the company plans to ramp up electric vehicle production capacity to 8,000 units by April, with sales expected to remain strong even in March. The management added monthly EV sales could touch 8,000 to 9,000 units by the end of FY27 or early FY28, signaling steady demand momentum.
The management of KEC International said that operations in Saudi Arabia and Oman are continuing as usual despite heightened tensions in the region. The management has clarified that about 25% of its overall order book comes from West Asia, and of that, nearly 50% is linked to Saudi Arabia.
Textile manufacturer Nitin Spinners is anticipating that remission of duties and taxes on exported products could be reversed starting next financial year, which could slightly impact its margins. Speaking to CNBC TV 18, company's management said the outlook for demand looks better, with activity in European markets picking up.
And with that, it's a wrap on this edition of Markets Forward. We will be back with more news and updates on the other side.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The big stories that we're tracking for you this evening. The war in West Asia widens as airstrikes intensify across the region. Israel bombs Lebanon after the Hezbollah launches missile attacks. Kuwait reports several U.S. warplanes have crashed. Iran's Red Crescent says at least 555 people have been killed across the country. Iran rules out negotiations with the U.S. as the conflict deepens. President Trump vows to avenge the death of 3 U.S. service members and continue the mission till all objectives are achieved. Crude oil prices post the biggest rally in 4 years as investors fear major supply disruption at the Strait of Hormuz as Saudi Aramco refinery shut after drone strikes. Stock markets decline across Asia and Europe. The Sensex down over 1,000 points. Nifty drops below 25,000. The rupee declines by nearly 50 paise against the dollar, but RBI's intervention restricts the drop to 0.5%. Flights disrupted across West Asia. Several major nations suspend the use of their airspace indefinitely. Indian Airlines cancel flights to the Gulf till further notice. Hundreds of containers remain stuck at key Indian ports. 4 lakh tons of basmati rice exports stuck in transit. Nearly 10 million Indians are currently in West Asia as the war rages on. Around 3,000 Indian students are stuck in Iran. Prime Minister Modi calls the situation a matter of grave concern for India, says all conflicts must be resolved through dialogue. India and Canada reset their bilateral relationship with the visit of Canadian Prime Minister Mark Carney. Canada agrees to supply uranium and work on building nuclear reactors in a landmark $2.6 billion deal. Both nations set a $50 billion target for bilateral trade by 2030. After completing a year in office, SEBI Chief Tuhin Kantapande signals the intent to boost liquidity in the cash market and allow participation of insurers in commodities. Also aims to cut registration time for foreign investors to 5 days. Assures no new action on derivatives till the impact of earlier steps are assessed. As geopolitics rocks the market, Chris Woods of Jefferies says gold and energy stocks can be used to diversify portfolios, predicts gold prices to hit $10,000 per ounce, even as he expects some near-term consolidation. That's an exclusive. India's automobile sector registers robust growth in February. Bajaj Auto, TVS, Tata Motors, Hero Motor all register double-digit growth on the back of sustained demand across passenger and two-wheeler segments. Well, the big story that we continue to track, the war in West Asia has widened as airstrikes intensify across the region. Israel launching strikes on Hezbollah positions in Lebanon earlier today, shattering a fragile truce that held for nearly a year. The Israeli military has said it was responding to attacks by Hezbollah. The Lebanese militant group has claimed responsibility and says it was avenging the death of Iran's Supreme Leader Ayatollah al-Khamenei, who was killed on Saturday in a joint U.S. operation in an Israeli missile strike. Lebanon's health ministry said at least 31 people have been killed in the strikes. Now, the Kuwaiti Defense Ministry has said that several U.S. warplanes have crashed on its territory, but confirmed that there were no casualties. The statement comes hours after Iran's state-run Islamic Republic news agency claimed a U.S. F-15 fighter jet had been shot down. Saudi Aramco's oil refinery in the city of Ras Tanura was temporarily shut down after a drone attack. Saudi authorities say the facility sustained minor damage from falling debris after 2 drones were intercepted near the site. Officials say supplies to local markets remain unaffected. President Trump has vowed to continue what he called a righteous mission against Iran until all objectives are achieved. He warned that more U.S. troop casualties are possible. However, in an interview to a news agency, Trump said, and I quote, "They want to talk and I have agreed to talk." Iran's security head, though, has said they will not negotiate with the United States in what has been the worst civilian casualty over the last 3 days. Iranian state media reporting that the death toll from a missile strike on a girls' school in southern Iran has now risen to 165. Iran's Red Crescent says more than 550 people have been killed, with strikes reported in over 130 cities across the country.
All over Iran, the voices of the Iranian people could be heard cheering and celebrating in the streets when his death was announced. The entire military command is gone as well, and many of them want to surrender into saving their lives. They want immunity They're calling by the thousands. Combat operations continue at this time in full force, and they will continue until all of our objectives are achieved. We have very strong objectives. They could have done something 2 weeks ago, but they just couldn't get there.
What we are doing is, in fact, an act of self-defense and retaliation to the American aggression against us. We are not attacking our brothers in the, in the Persian Gulf. We are not attacking our neighbors, but we are attacking American targets. And this is obvious. The Americans, the United States military is targeting us, is attacking us, and we have no way but to defend ourselves.
This war is both intensifying and widening. A new front has now opened up in Lebanon. There have been some strikes from Hezbollah and a very strong response from Israel. A number of people have been killed in Lebanon, and Israel has announced that it will intensify its campaign across Lebanon. Israel has said also that it is considering a ground invasion. 100,000 reservists have been called up, and that is a pretty certain sign that this is going to be now a war that is going to be taken into Lebanon, and this will be at the ground level. In the air, it's not quite as predictable as one might have thought. Iran is managing to hit back and hit back effectively. On day one, an Iranian missile got through and hit Tel Aviv. A woman was killed. The following day, we had an attack on Beit Shemesh, on a synagogue. 10 people were taking shelter. 9 of them were killed. And that, again, is a missile that got through Israeli air defenses. There is also, of course, a widening of this war across the Gulf region. A lot of Iranian missiles have been hitting targets in Dubai, in other places in the Gulf. That is clearly an attack on the economic lifeline of these countries, and they are being targeted because they are seen as hosting US bases.
Well, that's our colleague Sanjay Sori reporting there from Tel Aviv, widening and intensifying as Sanjay is reporting. Meanwhile, China and Russia condemning the killings of Iran's supreme leader and called for calm. The US allies have largely supported the strikes on Iran. British Prime Minister Keir Starmer has allowed the US to use UK military bases in the region. Prime Minister Modi has said the situation is a matter of grave concern for India and has called for a resolution through dialogue. Take a look.
पश्चिम एशिया की वर्तमान स्थिति हमारे लिए गहरी चिंता का विषय है। भारत डायलॉग और डिप्लोमेसी के माध्यम से सभी विवादों का समाधान का समर्थन करता है। इस क्षेत्र में मौजूद सभी भारतीय नागरिकों की सुरक्षा के लिए हम सभी देशों के साथ मिलकर काम करते रहेंगे।
The United States has requested permission to use British bases for that specific and limited defensive purpose. We have taken the decision to accept this request to prevent Iran firing missiles across the region, killing innocent civilians, putting British lives at risk, and hitting countries that have not been involved.
Well, that's the UK Prime Minister Keir Starmer. Now, crude oil prices posted the biggest rally that we've seen in 4 years as the war in West Asia sparked fears of supply disruptions. Natural gas prices have also surged as insurers have hiked premiums, cancelled policies, and shipping companies reroute their vessels from the Strait of Hormuz, which is not shut, but ships are not plying. Oil market watchers believe even if a ceasefire announcement happens, it may not necessarily result in a drop in prices immediately. Take a look.
I think the market will still remain extremely cautious in unwinding the risk premium because we have seen what route the diplomacy has taken and what results it has yielded, unfortunately, over the past few weeks. So no one is going to be betting or holding their breath for a very quick resolution, which means that we may again also see a start and stop of diplomacy and a military conflict. So I would expect perhaps a little bit of relief, a little bit of pullback in crude should there be a ceasefire and a return to the table, but not any meaningful drop in crude prices.
And stock markets across Europe and Asia declined on the back of tensions in West Asia. The Indian market also remained weak, with the Nifty ending below the 25,000 mark. Mid-cap index, though, swung nearly 2,100 points, while the Sensex fell over 1,000 points today. Barring defense, metal and the healthcare stocks, all sectoral indices closed in the red. Nigel is standing by to wrap up the market action for us. Nigel, very volatile, but off their intraday lows finally at close.
Well, the geopolitical conflict, that's the one that weighed on the Indian markets today. The concern is the crude supplies will get hurt, which in turn hurts India's import bill and shaves off a few basis points on growth numbers as well. The other concern is that the RBI will have limited headroom to cut rates. So today, the Nifty pulled back, crude oil prices did spike up, and the rupee weakened as well. But all of them were on expected lines. Well, the problem was that both the pillars of the market were under pressure. The Nifty Bank was down more than 2%. The Nifty IT index as well was down close to 100%. And the breadth of the market crumbled. Only one stock was advancing for every 6 stocks that were declining. The losers from the Nifty included L&T, as it has a decent amount of exposure to the Middle East. Interglobe, due to cancellations, and also ATF prices have spiked up. That's been input for them, so that's what will crunch margins. And Adani Ports as well was under some pressure. The winners were from the favoured defence as well as the metal sectors. Hindalco as well as BEL did well. And ONGC put on some weight as crude oil prices moved up. But that has a reverse impact in terms of OMCs, oil marketing companies. They got hit. Crude oil prices spiked up, and that's where you saw HPCL, BPCL, IOC, all of them were under pressure. Precious metal plays, though, did well. Gold Financer, Muthoot, that stock rallied. The only listed play from the silver space is Hindustan Zinc. That did well as well. And MCX, well, that outperformed BSE in today's session. Defense stocks, they're back in focus in light of the uncertainty on the geopolitical front. And that's why you had stocks like Solar as well as HUL, both of them rallied. While from the metals pack, Nalco as well as Vedanta, both of them were up in trade. So the Nifty's crucial support comes in at around 24,500. Investors have a day off on Tuesday due to Holi celebration. And by the time markets resume on Wednesday, investors will be hoping for de-escalation in the Middle East for the good of humanity and for their portfolios as well.
Nigel, many thanks. Another conflict in West Asia has also pushed gold and silver prices high as investors rush towards safe haven assets. Chris Wood of Jefferies says that gold prices will hit $10,000 per ounce, even as he does expect some consolidation in the short term. Here's Chris Woods.
In the medium term, I see big further upside in gold, but I wouldn't be surprised to have a period of extended consolidation. Gold can easily go to 10,000.
Oh, wow.
Because if you look at, I'm talking US dollar terms, so in US dollar terms, the growth of M2, you can easily get $10,000 on gold. Yeah. But my formal target based on is currently 6,600.
Well, a flight to safety there. Time for us to head into a break, but up next, nearly 10 million Indians are currently in West Asia as the war rages on. That and more when we return. Nearly 10 million Indians are currently in West Asia as the war rages on. The government has urged all Indian nationals in the region to shelter in place and avoid non-essential travel. Shivani joins us now with the details. Shivani, what does this mean for the Indian diaspora based in West Asia?
Well, yes, India has an estimated 9.6 million nationals living and working in West Asia, making it one of the largest overseas Indian concentrations globally. The UAE alone accounts for nearly 4 million Indians, while Saudi Arabia houses over 2.6 million. And even in Iran, currently at the center of the escalating tensions, around 10,000 Indians are estimated to reside. In Iran alone, around 3,000 Indian students, including nearly 2,000 only from the state of Jammu and Kashmir, remain in the country amid escalating violence, with roughly 1,100 to 1,200 of them in intense conflict areas, pleading for evacuation support from the government of India. Now, with multiple countries shutting down airspace and missile and drone attacks reported across parts of the Gulf, thousands of Indian travelers transiting through major hubs like Dubai, Doha and Abu Dhabi have faced cancellations and diversions. While there is no official consolidated figure, yet reports indicate that hundreds to potentially thousands of Indians are currently stranded due to flight suspensions. Transit travelers to global events like the World Mobile Congress or Umrah pilgrims in Makkah are facing disruptions, many unable to return home due to airspace closure and cancelled flight corridors. Now, the Cabinet Committee on Security has reviewed the difficulties faced by Indian travelers transiting through Gulf hubs. The committee also discussed concerns of Indian students scheduled to appear for examinations in affected countries, along with the broader economic and security implications of the conflict. The Ministry of External Affairs has issued advisories for Indians in Iran, Israel, Jordan, Qatar, UAE and Palestine, urging caution, avoidance of non-essential travel and vigilance. External Affairs Minister S. Jaishankar has spoken separately with his Iranian and Israeli counterparts, conveying India's deep concern and urging restraint. The MEA has reiterated that dialogue and diplomacy must be pursued and that sovereignty and territorial integrity of all states must be respected. Indian embassies in Tehran, Tel Aviv, Abu Dhabi and Damascus have activated helplines and remain in constant contact with Indian nationals. This is not just a travel disruption story. With nearly 10 million Indians in West Asia, any prolonged conflict impacts remittances, trade, aviation, energy flows and student mobility. New Delhi is closely monitoring developments as the region remains volatile. For a country with nearly 10 million citizens in West Asia, the stakes are enormous, and any escalation carries direct humanitarian, economic and diplomatic consequences. Back to you.
Shivani, many thanks. Yes, this is a serious challenge. Now, the Central Board of Secondary Education has postponed the board examinations for Class 10 and Class 12 for students in the Gulf. It was earlier scheduled for the 2nd of March. In a notice, the board has said the exams have been rescheduled to the 5th of March. Flight services across West Asia have also been disrupted as several nations suspend use of their airspace indefinitely. Indian Airlines have cancelled flights to the Gulf till further notice, leaving thousands stranded. It's not just aviation. Maritime transport has also been disrupted. Containers are starting to clog up all major ports in India. Santagura reports from the Jawaharlal Nehru Port Trust. The JNPT port in Navi Mumbai's exporters stare at financial losses.
The clearance for Indian containers meant for the Gulf region stopped on Saturday when the US-Israel-Iran conflict started. And since then, the containers at various ports in India, including JNPT and Mundra, are parked. And considering the nature, given the nature of the cargo, the exporters had no option but to park and plug in their containers. I'm being joined by a couple of drivers here. ये रहा प्लग पॉइंट और इस पे सब लोग आप ये जितने भी पॉइंट्स हैं इसके ऊपर आप अपने अपना कंटेनर लगाते हैं तो टेम्परेचर कंट्रोल के लिए सिस्टम स्टार्ट हो जाता है। जी जी। तो आप अपने कंटेनर में क्या कैरी कर रहे हैं? हम चपाती कर रहे हैं। कहाँ को जा रही थी? ये जेबे के लिए जा रही है। तो अभी आप क्या कर रहे हैं? इसका क्या करेंगे? आपने लगाया हुआ है कि निकाल दिया? नहीं, निकाल के अभी हम सब कंपनी जहाँ से लोडिंग करके आए थे वहाँ पे रिटर्न लेके जा रहे हैं। तो कितनी देर लगाया आपने ये? यहाँ 36 घंटा लगाए थे यहाँ पे। अच्छा जी। और आपका बिल कितने का दिखा रहा है अभी? 5,215 रुपये का। 5,000 से ऊपर का हो गया। जी जी। सर, आप जो हैं आपका कहाँ पे कंटेनर जा रहा था? आपने क्या कैरी किया था? ये मैडम चपाती है मेरे लिए, रोटी। आप भी चपाती कैरी कर रहे थे? आपने भी लगाया था ये प्लग इन पे? प्लग इन किया था 36 घंटे। अच्छा, और ये कितने प्लग इन पॉइंट है इस लाइन में? 40 पॉइंट है मैडम। अच्छा, और एक प्लग इन पॉइंट पे 5 कंटेनर लग जा रहे हैं?
हाँ 5 कंटेनर।
अच्छा, तो यहाँ पे और भी जगह पे ऐसे प्लकिंग पॉइंट्स वगैरह हैं?
साइड में है, बगल में है।
अच्छा, तो आप भी वापस ले जा रहे हैं अपनी गाड़ी?
हाँ वापस कंपनी में जाएगा।
Well, that's Santya at the JNPT, and this is a challenge now as maritime operations have also been disrupted. Exporters are staring at a period of uncertainty. Now, India and Canada have reset their bilateral relationship with the visit of Canadian Prime Minister Mark Carney. Canada has agreed to supply uranium and work on building nuclear reactors in a landmark $2.6 billion deal. Both nations have set a $50 billion target for bilateral trade by 2030.
हमारा लक्ष्य है कि 2030 तक हमारा व्यापार $50 बिलियन तक पहुंचे। आर्थिक सहयोग का पूरा पोटेंशियल अनलॉक करना ये हमारी प्राथमिकता है। इसलिए हमने कॉम्प्रिहेंसिव इकोनॉमिक पार्टनरशिप एग्रीमेंट को जल्द ही फाइनलाइज करने का निर्णय लिया है।
The agreements today, we're going to expand our collaboration between the Canadian Space Agency and the Indian Space Research Organization on Earth observation, on climate monitoring, on generating the data that powers agriculture, disaster response, climate resilience across the Indo-Pacific.
And speaking exclusively to me on CNBC TV 18, Prime Minister Mark Carney said nuclear partnership with India is an area of priority. He promised Canada will be a reliable partner and will not weaponize trade.
As India seeks access to critical minerals for its manufacturing, its clean tech, and its nuclear plans, Canada's resource base and world-leading companies position it as a strategic partner. As one example, the nuclear agreement, the uranium agreement signed today. As another, the fact that 40% of the world's mining companies are listed in Canada. Today, we are launching a strategic energy partnership with significant potential to expand bilateral energy trade.
Well, that's Prime Minister Mark Carney. Remember, this is a crucial visit to reset the ties which had deteriorated, in fact, ruptured between India and Canada. This is the first visit of a Canadian Prime Minister in 8 years. Mark Carney resetting the relationship with India. With that, it is time for us to wrap up this edition of Business 360. News will continue right here on CNBC TV 18. Stay tuned. We're back in a minute.
Hello and welcome to this special conversation. Well, markets for the last 1 year have been sideways. It's been a little tough. People have been complaining about money not being made, but the regulation of markets is another story altogether. It's been a hectic time. So many fundamental changes being made across the board on a variety of issues. And the man at the helm of all these changes, the fundamental and improving the structure for the market is, of course, the SEBI chairman. I'm sitting down with him. He completes 1 year in office at the helm of the market regulator. Mr. Tuhin Kantapande is the chairman of SEBI. Mr. Pandey, thank you very much for joining us, sir. It's a real pleasure. Congratulations.
Thank you.
How's it been, sir? I mean, just if you reflect back over the last 1 year, how would you rate it?
Well, it has been very hectic. One of the reasons is actually the geopolitical developments have been at an unprecedented levels.
Right.
And therefore, the markets have been going quite difficult. But I think in the whole scenario, we have come out resilient, I would say. And we're really focused on short-term and medium-term and long-term trajectory of our capital markets. I would say this has been a year of reform.
Let me dive straight into some of the hot button issues, if you will allow me, sir. And this necessarily did not flow from SEBI, but of course from Delhi. And you're well aware of policy making there, which is, of course, the recent, the SCT hike which happened on the F&O front in the union budget. A lot of hand-wringing about it. You'd be well aware. I mean, it's no secret. Just your thoughts on it, and how did you see it?
No, I would not like to comment. I think this question has been asked on this, and on fiscal policy matters, it's not appropriate for me to comment.
Right. The reason I asked that, it's not so much about the policy aspect of it. It kind of ties in with the basic, the direction of it, which is to try and curb speculative activity, right? And this is one more policy in addition with what you've done over the last 1 year as well. The aim is to protect retail investors, as you've outlined before as well. Would you see this as that and an important piece of that puzzle to try to fix that, protecting retail and curbing speculative activity?
So as I said that I'll not comment on the tax measures. However, if you were to ask me what has been our stance on F&O activity, and F&O, when we say, it's basically, I think we have to zero down on the problem area, which is short-term options. Because F&O is a very wide space, and using it just very casually is not appropriate.
So weekly options.
Futures are very important. Options are important. We would like a longer-term framework, longer-term derivative framework, the necessarily place where people can hedge and people can short. We have stock futures. So the market is quite big. And here, I think we are concerned more about short-term dated options, weekly options, where we said that, the activity was high, there was a hyperactivity, not necessarily serving a very great economic purpose. But there, in consultation with industry, in consultation with various others, our own thoughts, we put out a framework in terms of market regulation, bringing in different risk metrics, position limits, upfront payments, expiry day margins, and so on and so forth. And they rolled out in on different dates. The last of it was in December. We will continue to monitor this and have the data put it out before suggesting any measures. So therefore, I think we need also stability, policy stability, in the sense that there are certain things that we do, and then we also wait that, how that market is bearing out.
So you wait for that to take effect, show up in numbers, etc. The statistics, you will assess that and then put it out in terms of, so that is a process that is underway?
That's right. I mean, it will take some time, but that will indeed be the process.
And if required, after you put that out, after more discussion, I mean, as is appropriate, you will decide what to do. If there's anything more which needs to be done.
Yes, so therefore I think we have become more data-based, one, and secondly we are also looking at the measures that will help, because it's not really, I mean, we can actually be very reactive and try and put in some measures which may not be effective. So therefore we need to really actually deliberate what are the more effective measures, if at all, if the data suggests otherwise.
So as you said, the last of these measures was put in place December, right? How long will you wait before you start to, I mean, before you can take stock in a serious way?
I think this is your 1 year thing, should not be really concentrating on forward.
I have a long list of questions, sir, but I thought I will start with, it's something which is of great interest to you.
So you'll come to know when such a thing is there.
Okay. And you also said that the idea is to promote longer tenure derivatives, etc. So it is, one is curbing something and sort of, restricting the very short-term options, as you said. But the other is, of course, also encouraging the longer tenure. So the focus is also there. I mean, that is something which will be worked upon.
Of course. For example, if you look at, just to give you an example of electricity derivatives. Now you can start with derivatives. You can have monthly contracts, and going forward, you would like to more longer term contracts, because as future market, you will like to, get prices, future prices locked in for a much longer period, which may even eventually, if you have a sufficient long period contracts, may actually influence your investment decisions today, because the prices are very important indicators of whether or not you should be making investments. So I think these market developments are obvious. Similarly is the case of some of the newer derivatives we must bring in. For example, the corporate bond indices and the derivatives around it, where RBI and SEBI working to bring in. There was also a budget announcement around it. So I think we have to see the market development in the right way.
Yeah. So on the cash side, right, we're talking about equity derivatives. Will you also kind of look to increase market depth and those kind of things? I mean, making cash more attractive.
I think it's indeed our endeavor that the cash markets must further become more liquid. And whatever we need to do, we do have a working group looking into it to review the short selling and the SLBM framework under the cash market, which is there, but it's somehow there are some barriers where it's not really taken off. So therefore, the industry and the SEBI officials and other experts will look into it and suggest measures, and we will move forward.
One thing I've heard, and this is my last part, sorry, you will, forgive me for this, but STT on delivery, for example, I've heard it from every day when we speak with, and we don't talk about this every day, but whenever we have these discussions, it always comes up. Why can't the government, if the idea is to curb short-term options in the F&O space and encourage cash, do away with STT on delivery? Is that something you would, SEBI is the expert, and SEBI will, of course, advise and tell the government, and of course, it's for them to decide, but is something that is on the agenda?
No, I'm not going to discuss on TV what inputs we'll give to government and not give to the government.
But cash market development is very much, as you said,
yes.
There's a group which is...
I think whatever needs to be done, we should be doing this.
Just to complete this topic, can I say, and I'm paraphrasing here, the idea is to reduce the turnover in the futures and options segment, and there the specific thing, short-term options, relative to the cash market. I mean, the size is, as many have pointed out, is very disproportionate. Cash market size as compared to the options, the short-term options market. Would you say that the idea is to kind of sort of, not equalize, but reduce the disparity?
Well, I think, as I said, that the cash markets need to be more liquid, there should be more turnover. And so therefore, there could be several issues. We have to wait for the working group to come in. Tax is another issue, of course, you have rightly pointed out.
Fair enough. Now, just on the taxation front, sir, there was a lot of, expectation. Maybe also there was some element that markets have not done well, but markets go through cycles. We had a few years, a bumper move, and then, markets consolidate. But and I think there was that element as well, and many were pointing out that maybe in the budget we will see FII-related taxation perhaps being equalized to how they're taxed everywhere else in the world. I don't know if you have any thoughts at all, or was this...
I think you're again coming back to the fiscal measures. You should be asking these questions elsewhere.
But was that part of the consultations, pre-budget consultations?
No, I would say that, let's look at the kind of measures that we have at a regulator taken at for the FPIs.
Right.
For us, to do the market development is to see, the frictions are reduced. There is a greater speed with which they can operate. So there is a registration issue where we have completely now looking at a very different approach to, registration. We want it to be digitized. We want it to be fast. We want it to be not, days or months, but actually literally a week or 5 days. So can we reduce it to 5 days? So what it takes to reduce it to 5 days. So we're working with custodians, FPIs, other market participants. And then you have now India Market Access Portal for everyone, where all the FAQs, all the different measures. So if you want to enter India, you have one place as FPI, what you need to do, what documents you have.
And I must say, it does not get enough attention. It is not a hot enough topic, but it's a point which many serious foreign investors have raised over the last many years.
And these are the things that we have actually deeply engaged with them. And some of the new registrations have come with India digital signatures of submission of documents, which is an important part of delay. If you have, in this time and age, if you have always a document, physical documents, wet signatures, notarized, apostilled, be submitted on different things, because you have to keep on updating the control and other measures. So whenever there's a change, again, you have to send out the documents. Now, if it could be just instantaneous through digital signatures, it will really remove the friction. It's just something that we really do in our domestic market very, very effectively. We have such a digitized economy, digitized society. So this is one area where we are now pushing forward proactively to see that we move into completely digitized registration.
So from the time that FIIs, when a new foreign investor comes, registers, to the time that they're able to actually invest and start trading, etc., you want to bring that down to a matter of days, basically.
Exactly.
Right.
And we have achieved considerable progress in this.
Okay.
We have a portal-based approach. The new portal, the front end has changed, and we are engaging with them how the India digital it becomes the norm on the same sort of documents which they submit for registration. So with no extra burden.
So recently there was an RBI circular with regards to limiting bank exposure for things like proprietary position taking in the markets, etc. There have been some reports saying that, well, SEBI is essentially going to make a representation of the RBI. And just wanted your thoughts on this, I mean, in terms of what the circular says and what the implications could be.
So we received the representation from NME last Friday, and we had a look at it. Now, I think the points which are being made out are not really very convincing. You know, the RBI had itself put it out, these guidelines, and sought for comments. In all the 4 issues that were indicated to us, we found that, you know, there was some way the RBI was proposing to do, and then the representations were made. And indeed, the final result was fairly taken on board, taking those comments. So it is not that, you know, it has been done, you know,
so
just
no
like
further
that.
movement from your side on this.
And on prop trade also, initially the RBI had proposed that there would be no prop trade, like there's no funding for BGs for prop. And from there, they have moved to a position where they said we allow the BGs, provided there is a 100% coverage. So I think the regulator there has taken a considered call after doing that. And we had this because it was thought that perhaps, you know, initially it was indicated as if, you know, something which has come out they were not even aware of, something very surprisingly put in. But I don't think that was the case.
So they themselves consulted and then they've sort of put this up.
Yeah, and some of the asks actually we also don't support.
Okay.
We don't support, for example, that if you have the MTF and you have certain securities which are already there, I mean, you have funded them, and therefore there should not be any leverage over there. So we don't want that. I mean,
leverage over leverage in that sense.
Leverage over leverage.
Okay. So another representation matter, if I can put it that way, banks and insurance companies, I mean, the proposal or whatever for them to be allowed to trade in commodity derivatives. Again, here, indication is that the RBI has reservations. I mean, just wanted your feedback, sir, on this.
So it is like, you know, we allow these systems to you know, be discussed, debated, analyzed, rather than just, you know, sort of not trying anything. Like, obviously, we will further engage with the RBI on that matter. We haven't really finally heard from them what are the reservations are and what guardrails could be put. See, it's a question of how do you do that? So we would always say, for example, you can do such and such thing provided you have a concentration limit, you can't go beyond this. So therefore, any controlled operation and any carte blanche, these are 2 different things. You can simply banning. Okay, you don't ban it. This is one approach. The second one is no, you can do it, but provided you have a position limits, you have a margins of this kind, and so this is the way we have to move. Commodity derivative market hasn't been looked at in a proactive manner for a long time. Both on the agriculture and the non-agriculture side. But we do have the potential. We are a large consumer of commodities. So you also do produce commodities. So therefore, why should the market discover it here?
You've given me the next lead to my next question, segue into my next question. You brought up commodities, right? There's been this, again, this, if I can put it, ask to allow options on commodities, commodity trading. Is SEBI open to the idea?
So you will see it soon. In what way we are moving, because it will be based on a very deep work which has been done in the working group and the deliberations that will be made in the CDAC and then converting into a consultation paper. So I would not like to prejudge these matters, but whatever needs to be done in order to develop the market with due guardrails, we'll need to move forward.
But it is something which is being discussed, as you put it. That's the stage we are in, but it's not a no in that sense.
I'm not revealing anything at this stage, except to say that you have to wait for a while to do that.
Right. I'm only asking this because there was so much, you know, it was seen that the regulator wants to curb very short-term speculative activity in equity options, would they allow options on the commodity side? So people who are making that parallel, perhaps reading, but as you're saying, you're not revealing anything, but it is something which is which you will be talking and discussing.
But here also, we are not really saying that we have to just shut down things, because if we really go by that shutdown approach, then we also might as well wind up our shop here.
Yeah, absolutely. Mr. Pandey, I have 3-4 more points I want to address. Algo trading, sir, HFTs. The Jane Street case, of course, was the famous one, which is in SAT now. Just your view on what we are seeing, and is that issue in that sense settled, or are you watching and monitoring very closely what some of these global HFTs are doing?
So I don't think that, you know, this algos is algos are being used. There is an algo, there is a safe algo approach in SEBI, and we have, so we are not really bringing an issue as if we are relooking at algos or something. So let's not link it that way.
Absolutely.
The other action I would not like to comment, it is sub judice.
Sure. Yeah, so not a fundamental rethink or anything, but I mean, it's action based on wherever action is required. In that sense, I think the Jane issue was such. So the IPO market, you're comfortable with the way it is functioning? It's been a flurry of issues, right? I mean, 2025 was a big one. 26 was expected to be a big one. We'll see. Of course, it also depends on how secondary markets do. But broadly, you're okay? How that is functioning?
I think indeed primary market is a true reflection of what's happening in the India growth story. If you have a 7% growth in a large economy, if you have 2% inflation, you have fundamentals in place, you have all the 5 balance sheets are in right thing, then I think people are coming forward to create companies and also bring it.
One specific point,
and you have issue, people subscribing. So that's what the capital markets are for.
Absolutely. One specific issue was startups and new age companies, which perhaps would be loss making, and then they come to the market, and in many cases, investors don't have a good experience. Is there any thought process there in terms of additional disclosures, or would SEBI get into that field to try and?
No, we do have. You see, when it comes to disclosures, we really have ample disclosures.
Okay.
So we do have. If you have accounts, your accounts are revealed. If you have promoters, your promoters are. If you have a past deals. Those are, if you have done preferential issues earlier prior to IPO, those are revealed.
Sure.
We have a framework. Now we don't get into, and then we do have a system where if you have a certain kind, if you are not making profits, you going into the other bucket, where reservation category is reduced from 35 to 10, because it's deliberate that you don't want to push the retails into those areas. But then beyond that, I think people have to learn to, learn to do their own research, to go. Market is big, so much is there, media is there, people are commenting all the time, and when the information comes in, people are analyzing. We are wanting that information to be further streamlined. So therefore, we thought that since the things are bulky and we have number of IPOs are very large, so it's one after another which comes. And the people may find it difficult to digest and reading through very voluminous disclosures. So these voluminous disclosures are also important for the category of people like institutional investors who would like to go deep into this, and they would like much more information about the contingent liabilities, for example, or the litigation, or the other information that might be there. But there would be also small investors who may like to have key information in place. And so therefore we have now this draft abridged prospectus approach, where the draft stage, which is the stage when it is put it out and the people can see, there they have an abridged prospectus with a QR code where they can actually look at it. And this prospectus, we have said that this must contain XYZ
such
information. Which will again make it more handy for the people to analyze on the key points.
So 30-second response, AI is the new hot word, buzzword, for good or for bad. Is SEBI using AI for it? I mean, operations, surveillance, and management?
Since you have said 30-second, first of all, I'll say there should be a 30-second SEBI check by anyone who wants to come and invest in stock markets in order to prevent themselves from getting into frauds.
Okay.
So this is a tool that SEBI has, that any account where you're trying to put in for investments, or somebody lures you into put in investment, then you must do the 30-second SEBI check on our app to see that whether that account is appropriate account.
Like an intermediary account, whoever you are.
Is a regulated account or not. And now your 30-second response to your 30-second question. Yes, SEBI is using the AI. And especially in the areas of investor protection in a big way. Of finding the finfluencers who are transgressing the line of investment device, not being registered advisors and still giving advice.
Right. So it's basically implementing rules with regards to surveillance with the help of AI to make it more effective. That's where we're at. So I have a long list of questions, pending questions, but we'll have to save it for another time. You have a long day. I wish you all the best of luck. It's only year one, and we look forward to your stewardship over the next many years as well. Thank you very much, Mr. Pandey.
Thank you.
Thank you.
Hello and welcome to this special show on the Iran conflict. I'm Ashmit Kumar. Now, the escalating tensions between the US and Israel on one side and Iran on the other have pushed crude oil prices higher as investors fear major supply disruptions at the Strait of Hormuz. Prices post the biggest rally in 4 years. Natural gas prices also surged as insurance hiked premiums, cancelled policies, and shipping companies rerouted vessels from the Strait of Hormuz. Nearly 20% of the global oil flows through the strait. A Saudi Aramco refinery has also been shot after drone strikes, adding to the supply concerns. Moody's Analytics has warned that the conflict poses significant risks for import-dependent Asian economies like India. India, for example, imports over 80% of its crude oil needs. Now, close to 50% of India's crude oil imports pass through the Strait of Hormuz. Any disruption there could raise the import bill for us, adding to inflation and widening the current account deficit, putting pressure on the Indian rupee. So far, Iran has said that it doesn't plan to close the Strait of Hormuz. However, analyst Vandana Hari has told CNBC TV 18 that if the conflict spreads and is prolonged, crude oil prices could hit the $100 mark. For India, the impact is not limited to energy. It is also affecting the Indian diaspora. An estimated 9.6 million Indians live and work in West Asia, making it one of the largest overseas Indian concentrations globally. The UAE alone accounts for nearly 4 million Indians. Saudi Arabia houses over 2.6 million. Around 10,000 Indians are estimated to be living in Iran. Around 3,000 Indian students, including nearly 2,000 from Jammu and Kashmir, remain in Iran. Of these, roughly 1,100 to 1,200 are in intense conflict areas, pleading for evacuation and support from the Indian government, with multiple countries shutting airspace amidst missile and drone attacks across the parts of the Gulf. Thousands of Indian travelers have also been that were transiting through major hubs like Dubai, Doha, and Abu Dhabi have faced cancellations and diversions as well. They too are seeking support. Now, this is clearly an evolving story. Joining us now to help us break this down, to help us understand, are with us senior journalist Wail Awad and former diplomat Ambassador Anil Trigunayat. Gentlemen, thank you so much for joining us. Ambassador, let me come to you first. I'll just recall June of 2025, we saw Operation Midnight Hammer by the United States. They deployed their B-2 bombers, let go, deployed of heavy munitions against nuclear facilities in Iran, and that subsequently led to a corresponding attack on a US base in Qatar. It looked to be orchestrated. Did that skew expectations in the minds of military planners in the US that this will be a small, brief 12-hour operation where we'll decapitate the head of this regime and that'll be the end of it? Because clearly that's not how it's playing out. In just the last couple of hours, we're getting reports of hits in Cyprus, off the coast of Oman, of Jerusalem, Saudi Aramco refinery. It's not quite playing out as per their textbook. Ambassador.
Well, of course, what happened this time is also the playbook exactly that of June. There were negotiations were going on, and immediately suddenly out of the blue, they started escalating it. There was bombing done, but they tried to provide Iran the off-ramp, basically, after the 12-day war. But this time, as you rightly said, that there was a possibility in their design, but the main design was regime change agenda. And regime change agenda could only be fulfilled if either the supreme leader was deposed or killed. So they're working according to their own admission for quite some time. But then they have not properly analyzed that there is a system that has been working. And during this period, Khamenei had himself delegated the authorities to many of the people, and how the chain of commander departments, whether it's in IRGC or in the military or elsewhere. So he had worked out a very proper system, which has clearly worked even after 40 odd leaders have been killed. So I think that they probably will have to live with a little more retaliation from Iran. And the people of Iran will eventually find a way how to go about it. And this forcible removal of or killing of the supreme leader will not go down well in the region as well, as we are seeing that everywhere Iran is currently hitting every single organization or the base that the Americans have. So I think that this is a very major problem.
Dr. Awad, let me take that cue from Ambassador and bring that to you, Dr. Awad. The situation that we find ourselves in, a statement from Abbas Araghchi, the Iranian foreign minister, he clearly says that our military units are now, in fact, independent and somehow isolated. They're acting based on general instructions given to them in advance. What I want to ask is that this is clearly a decentralized textbook that the Iranian leadership is now currently working with. Does this, as opposed to Iran being put in a corner, put the US, put Donald Trump in a corner where he has to now grapple with the possibility of a weeks-long conflict stretching across the Middle East, stretching across multiple countries?
Well, I think he is preparing for that kind of scenario because the amount of American weapon and warships and nuclear warships have been sailed into the region and circling Iran from the sea, from the sky, from even Europe.
We have some difficulty there connecting with Dr. Awad. We'll get back to him. But Ambassador, while we have you, just the next question I want to ask is that India has multiple points of concern as far as this entire conflict is concerned. One of the chief among them being the nearly 10 million strong diaspora that we have in the Gulf region. As this conflict stretches across countries and weeks, is there a possibility of even the likes of UAE, Saudi being drawn into this conflict? And if that happens, what does that do to safety and security of a 10 million strong diaspora in these countries?
Well, Ashmit, the thing is, as you are aware and you yourself said, we have about 10 million Indian diaspora in the region whose safety and security is of primary concern, apart from the energy and economic engagement that is very much incumbent upon safety and security and stability of the region. All are going to be impacted very heavily for India. And that is precisely the reason the government is very concerned. And the Foreign Minister, Dr. Jaishankar, has been talking to all his counterparts. Prime Minister Modi has been speaking to the other leaders, world leaders there, especially the regional ones, and hoping that through somehow this war will be de-escalated and we'll have some kind of a possibility. But of course, I have been involved in many of the evacuations, and I know that this is an extremely cumbersome and complex process, especially as most of the airspace has been closed. So if the missiles start falling indiscriminately on the residential areas, there can be a possible danger. So I would suggest that all the Indians, if they are listening to you, must always remain in touch with our embassies, and Indian government will try its best to pass, to take them out of the harm's way. But situation is extremely difficult. The size of the problem is gigantic because 10 million is not easy to evacuate. But we hope that through international interventions and persuasions, the war will be stopped soon.
Right. Dr. Awad, we lost you there for a minute. Coming back to you, the question that we're discussing is, as these aerial bombardments continue from Iran, is there now a possibility that the likes of UAE, Saudi get drawn into this conflict? And if that happens, what does that do to the safety of Indian diaspora, which is north of nearly 10 million, living out of these countries?
Well, I think it is a very dangerous situation. Remind me of the evacuation of the Indian in Kuwait and then from Iraq, and how much it was a horrendous task to remove 200,000 Indians from those areas. But imagine 10 million, it's not possible for any country. We all knew the consequences of the war spreading into a regional war. And even the United States knows that this is going to be an all-out war because the Iranians have threatened Ashmit. They have already said to the countries hosting American bases, that if an American attack takes place in Iran, there will be legitimate attack on those targets. However, the fight now, or the attack by the Iranian, is limited to the military side of the American and their personals, nothing to do with the civilian attacking. And you could see from the attack on Kuwait and Abu Dhabi, Doha, all the attacks have been only in the military bases. Now, if this war is going to spread, yes, there's going to be a contingency plan, and it will be horrendous for any country to evacuate their people, leave aside the Indian part. I think India is the main stakeholder in the West Asian affairs in terms of the food security, oil security, and also the diaspora security. Now you are having the Strait of Hormuz is going to close. You have to fasten your belt for $100 a barrel. You have to fasten your belt for $6,000 and for the gold, 200 for the silver. So these are all the issues where the American anticipated, precipitated, and aggravated the situation to such a large extent that we all know that this was unnecessary, illegitimate war to go with Israel against Iran. The area was very stable despite the skirmish, despite the interfighting, but this kind of an all-out.
Have you on Apache line, Dr. Awad? We have you on Apache line. Let me just go across to Ambassador Trigunayat for a final comment. Dr. Awad there made a very valid point. Oil analysts saying that the prices could easily go up of Brent crude to $100 per barrel. What does that do to the economics of oil and, more importantly, to the geopolitics of oil? Do we find ourselves going back to Russia? Can we do that? Can we afford that with Donald Trump watching?
Actually, unfortunately, there's a Donald Trump who pushed us and he wanted us to increase imports from Saudi Arabia. That's what precisely we had started doing it. While India was buying oil from Russia, it was stabilizing the global markets as well. And I think that that is something that will continue to be. Now the Russian oil will also become quite premium for many of the countries if this is what happens here. But at the same time, India will have to. Right now, they have reserves for about 45 days. And I believe that we hope that before that the war will be really, sorted out. I hope so too, because President Trump himself said it will be about 3 to 4 weeks. Although they have destabilized the region, and this will have its own consequences, which will be long-term consequences, and the balance of power shift in the region will also take place.
Dr. Awad, since we still have you, just a quick question. The strikes that have been launched by Iran against the host of countries, UAE, Saudi being amongst them, does that then perhaps lead to a possibility of a greater understanding, some kind of Arab coalition? We've already seen security setups being arranged between the likes of Saudi and Pakistan. Do we see similar arrangements coming up in the Gulf?
Well, I think, Ashmit, what's happening currently that the GCC have met and had an emergency ministerial meeting and they condemned the attack. They're even threatening Iran of retaliation, retaliatory measures. But I believe there is no question of a coalition or cooperation because we all know that the Gulf countries under the American custody, they are the custodian of their safety and security, American and UK. That's why they immediately took part in this war. Even the French now coming forward, and all these military installations, including the UK military base in Cyprus, have been under attack by the Iranians because they are already taking part against Iran. So I think that is the situation currently now. What we need at this moment is an end of all cessation of all the hostilities, end of this mad war, and let people come back to the negotiating table. You have to see the objective that the United States is declaring. Here, Ashmit, the United States is fighting two wars. Let's put it bluntly. One war is the superpower war where they wanted to control all the corridors of the oil and the global trade in oil, which is coming from Strait of Hormuz, the Red Sea, the Mediterranean, all this area American government wanted to control. That will affect India, China, South Korea, Japan, all the Southeast Asian region, where 60% of the oil come from this part of the world. This is one. The second regional war they're fighting is on behalf of the Israelis, which is to continue Israeli hegemony and dominance politically, militarily, and economically.
Right, Dr. Awad. Right, Dr. Awad. So clearly, a cessation of hostilities being sought by multiple countries, including the Indian Prime Minister. What does the off-ramp look like? Well, that's a question that we still are awaiting answers to. I'd like to thank both of our panelists for joining us. We're slipping into a very short break, but we'll continue our focus on this conflict going forward on the other side of this short break. Welcome back. Now, hours after the Trump administration shunned Anthropic in talks with OpenAI and Elon Musk's XAI surfaced, the U.S. used Anthropic's Claude to strike Iran. As per a Wall Street Journal report, U.S. forces have been applying AI tools for their ongoing operations against Iran. This was for intelligence assessment, target identification, and simulating battle scenarios. During the peak of the clash between the Pentagon and Anthropic, U.S. President Donald Trump called for an immediate cease to technology usage. However, he acknowledged that it would take about 6 months to phase it out, in agencies especially like the ones in the Defense Department. Now, Anthropic and the Pentagon have had differences over implementation of AI models. This began after Anthropic refused to allow the Pentagon to deploy its tools in all lawful scenarios during contract negotiations. In its statement, Anthropic said that it supports AI for lawful foreign intelligence and counterintelligence missions, but added that deploying these systems for mass domestic surveillance is incompatible with its policies. Anthropic also rejected the idea of fully autonomous weapons, which were not a part of its contract with the Pentagon. The statement stressed that such weapons should not be mobilized without proper guardrails, which do not exist as of today. The U.S. military even deployed Claude during Venezuelan President Nicolas Maduro's capture. To help us understand this new dynamic going further, we have with us Pramit Pal Chaudhary, India Practice Head with Eurasia Group, as well as Nikhil Pava. He's joining us as well live. Mr. Chaudhary, let me come to you first. Is this the first instance of AI being used for kinetic operations at the scale that we are seeing right now play out in Iran?
Scale, possibly, because it's very hard to judge, but we know AI has been used in the Ukraine conflict, definitely used by Israel in the Gaza conflict, and as you mentioned, Venezuela a little before. But in this case, where you have probably the sheer number of kinetic action missile targets and multiple countries being involved, this is possibly the most complicated use of AI in contemporary military history.
Nikhil, just want to get your perspective in terms of breaking down the concerns that Anthropic has expressed when it says we don't want to use our products for mass surveillance or for totally autonomous weaponized systems. Why is that? What are the risks involved?
Thanks, Ashmit. So essentially, when they want to use it for mass surveillance, it means that they don't want to get it used for processing of data, of identification of targets, of identifying, trends, locations, because people are using AI and they are sharing some very sensitive data with AI chatbots. And let's not forget that when you chat with AI, that data is not encrypted. That data is not just between you and the model. It is also intercepted in the middle by automated tools that look for certain keywords. And we've seen this in the past where, for example, when personal health issues were being discussed and someone was actually, in one case, when someone was contemplating killing someone else, right? So that those conversations were flagged internally by OpenAI, but not informed to the police. So they are aware of the conversations that take place, and which means that any government personnel, military personnel that are using AI services, their data is actually seen by these services, and that can also be used for surveillance. You might remember about 6 or 7 years ago, there was a hue and cry in India because there was a Chinese firm that was scraping social media to create profiles of about 10,000 Indians. This is much more detailed than that because it'll have much more information, it'll have much more context, it'll have personal information, it'll have health information. So people are sharing a lot more information. What they think is private with AI is actually not private. And therefore, these services signing up with the US, with the government to share data for surveillance and for intelligence is extremely worrying. In terms of autonomous weapons, I think one of the things that we need to realize is that it's a combination of drones, AI, and space which changes the game, because there's a fog of war in warfare where there's incomplete information, and space completely changes that because it can give live information about locations, movements, etc. And that, when provided to drones through satellite communications, and with AI can actually cause drones to change decisions while they're in the air. So, so any kind of like powerful intelligence being provided to drones, along with the data that is captured from satellites, is actually very dangerous and much more effective than pointing towards a target and sending a missile towards it.
Sure. Mr. Chaudhary, let me come to you. When we talk of AI currently being used for intelligence assessments, for selection of targets, does it then make it an easier role for advanced militaries like the one in the US to go for these decapitation attempts that they're going for, where they aim for the leadership figures across geographies? Is that going to be the new dynamic going forward?
I mean, basically targeting it becomes much easier and much more competent. If you look at the bombing in World War II with all those giant bombers dropping lots of gravity-dropped bombs, assessments that came afterwards of those bombs found that basically about 1 out of every 200 or 300 actually hit their target. Most of them just missed their target altogether. A strategist like Clausewitz, in his book Vom Krieg on War, argued that it's about the weapons and the soldiers. It's 1/3 about the strategy, and 1/3 is, as he said in the famous expression, it's the fog of war. It's just chaos. So what you use intelligence for, and you use radar and so on over time, you've been trying to reduce that uncertainty factor, that lack of knowledge of what you're hitting, where your targets are, where are your own men, where are your own airplanes. You often don't know in the confusion and chaos that war is. AI basically takes that to a whole new level because it absorbs huge amounts of information, develops an ever-moving algorithm that keeps adjusting and evolving to find its targets. So the Israelis used, I think it was called the Hebros, an AI function when they were going after targets in Gaza, and it was able to identify 37,000 individual targets and so on. In a war in which drones, literally thousands of drones, are often fighting each other, the Ukraine war, we're looking at 2 to 3 million drones were used last year in combat, being able to target them, knock them down, as well as the other guy using his drones to find his right targets. You need something incredibly sophisticated in terms of the number crunching, and that's what exactly AI does. So Claude Gov, which is used by Anthropic, Palantir, a perfect example of a company that is 100% about security and surveillance. But even Google, all of them, all of them have their own government structures on that.
Right, Mr. Chaudhary, a new dynamic, a new generation of warfare unraveling before us, the spectacle that we are seeing in Iran. I'd like to thank both of our panelists for the time that they've shared with us, for the insights that they've shared, but that's unfortunately all the time that we have. It's a wrap on this edition of News Center. More news and updates will continue right here on CNBC TV 18.
Hello and welcome to this special interview with Christopher Woods, the global equity strategist with Jefferies. He's been writing Greed and Fear for the last 30 years, which is widely followed globally as well as in India. Chris, thank you very much for talking to CNBC TV 18.
It's a long time.
It's a long time.
So yeah, so it's become a habit, I suppose.
But how? I mean, briefly, if you want to tell us how it all started. 30 years back, started writing for liking a column called Greed and Fear. How it all started?
Well, actually, I started writing Greed and Fear with a different investment bank called Peregrine, which was famous back then, with Hong Kong based, but which went bust in the Asian crisis. And in those days, people used to refer to fear and greed. So I just decided to turn it around to Greed and Fear and make that the title.
Okay.
Because the common saying then was not greed and fear, it was fear and greed.
Okay.
People said markets were driven by fear and greed, so I turned it around.
Oh, okay. Interesting. Okay, let's start with the with your views on the global setup, on the global markets. I'll come to India as well, but first on the global markets. And the big buzzword of late has been AI. And I was reading your report as well. There is a lot of fear among the investors that whether AI is going to eat software. You've written a note as well on that in your latest Greed and Fear column. Tell us about what your views are on AI and how much it's going to impact the software industry.
Well, many years ago, a famous venture capitalist came out with this saying, software will eat the world. I think he said that about 2011, which actually turned out to be quite correct. So yeah, I think conceptually that's what we need to think about. Will AI eat software? I'm not 100% qualified to opine on that, but it makes a certain intuitive sense. But from a stock market standpoint, what my view this year was that I called my quarterly at the start of the year AI crunch point. So I think the way to look at it, we've been in a 3-year AI capex arms race, which kicked off the beginning of 2023 when we had the Microsoft investment to OpenAI, which basically made the market focus on this AI thematic. And I think the challenge represented by OpenAI and the chat box prompted this massive capex surge by the hyperscalers. This year, the 4 hyperscalers are projecting to spend, I think, around $620 billion US, which is an enormous amount of money. And my base case is that this will be the year where we start to see the market question whether they're ever going to get returns on this massive investment.
Sure.
And we actually started to see that questioning begin in the most recent quarterly earnings. And I think, the key point is just beginning. So there's lots of room for those concerns to grow. So that has now commenced. But then we have what we've also had in the last month is this sudden derating of the software stocks in the US. But the significant point there to me from a financial contagion effect is that software is the area where the US private equity, private credit industry has both invested in and lent to in the last several years. And in my view, it's self-evidently risky to do a leverage buyout on a software company. We're talking about leverage buyouts in America. I'm not talking about private equity in India. And so that can cause a lot of collateral damage if it's indeed true that these software companies are not going to retain the revenue growth the market was assuming.
But are you fearing there is a bubble in the private credit in the US because of the funding that they've been doing to the...
No, I've been of the view for at least 4 or 5 years that the bubble in this credit cycle in the US is private equity, private credit.
Sure.
See, people have been calling AI a bubble. I don't believe AI has been a bubble up till now because most of the capex by the hyperscalers has been in cash. They're beginning to borrow more money now, but the real bubble has been in private equity, private credit. And but the two have kind of converged in recent past because the private credits started to fund the AI.
Sure.
But basically, about 70% of private credit is thought to be financing private equity.
Chris, off late, the buzz in the market, in the financial world has been, something called HELO, heavy asset, low obsolescence. Are you of the camp that believes that it's time to now bet the physical assets?
In the last month, this is a very recent development, I would say, but in the last month, I first picked it up in London actually. In the past month, fund managers are starting to want to shift more of their portfolio away from digital into physical.
Physical, yeah.
So 15 years they've been investing in these digital businesses, these platform businesses, but now every digital business, there's a question mark whether it will be disrupted. So that process has literally only commenced, I would say, in the last month. When this AI first started, the view was that the AI technology would improve and enhance the platform companies. Sure. But now people are worrying whether it'll be completely disrupted, because if you take AI to its ultimate logic, you don't need apps. Yeah. Then it becomes an app-less economy. Sure. But on the other hand, people are used to using apps.
Yeah. But have you made any changes to your global long-only portfolios or any of your
No, since the start of the year, yeah, I've added more, like I've got more resource stocks.
Okay, okay.
But I think, yeah, so definitely I think it makes sense to reorientate the portfolio more to physical away from digital.
Yeah. You know, apart from AI, the other big talking point globally has been the geopolitical risk. We saw last night, there were some further tensions with regards to Iran. And we've been seeing the geopolitical risk for the last few years. What's your stance on the geopolitical risk and potential impact on global equities as well as in emerging market equities?
Now, the geopolitical risks have been there, as you rightly say, for at least 4 years. Yeah. So it's extremely hard for markets to discount geopolitical risk. In fact, they can't. So the only way you can discount it in a portfolio is via gold, and I would say this year via energy stocks. So there's probably a bit of a Iran risk premium in the oil price today.
Grace, you've been a big-time bull on gold, and it's proved right in the last at least 2 years. Gold has been the best-performing asset class, so to speak. With the kind of rally we've seen in the gold and the commodity stocks per se, what's your call now? Do you see further upside on gold from here, or it's a time to book profits into gold?
No, in the medium term, I see big further upside in gold, but I wouldn't be surprised to have a period of extended consolidation.
Okay.
Sideways consolidation to maybe sideways to down, but I'm talking tactically.
But you're not expecting.
If I had a leverage position in gold, I would have taken profits.
Okay, but what's a long-term goal? What's a long-term target on gold? Say maybe 2 years, 3 years down the line.
Formally, my long-term target is now 6,500, but I mean, gold can easily go to 10,000.
Oh wow!
Because if you look at I'm talking US dollar terms. So in US dollar terms, the growth of M2. You can easily get $10,000 on gold. But my formal target based on is currently 6,600.
Sure. Apart from gold, anything in the hard commodities that you like and you're looking to add into it, the silver, copper, aluminum?
No, I have copper stocks in my portfolio and oil energy stocks. But if I only own one, it would be gold.
Okay.
Silver is high beta gold.
Sure.
But it's not. If you're a purist, you will only own gold.
Okay. What about crude, Chris? Because again, that's something which it impacts India to a larger extent, and it's been pretty much range bound, right, for the last say 2-3 years, between 60 and 70. With the geopolitical tensions, again, you foresee a big up move in gold, or in
Well, no, if they really attack Iran, definitely. But my base case is he's not going to attack Iran, but I could be wrong. If Donald Trump attacks Iran, it's extremely risky from his standpoint. So I don't think he wants to attack Iran, but I don't. But the problem is, I don't know how much pressure he's under from Israel.
Okay.
So that's. But so.
So you believe oil is going to be in the range between 60 and 70?
Yeah, but if we attack Iran, and you see, I think the thing about this Iran thing right now, my understanding, last time we had this encounter between Israel and Iran, it was like an agreed, it was almost choreographed.
Sure.
But this time, what I'm hearing is if they attack Iran, Iran said it's all-out war. So then you do have a potential scenario of Straits of Hormuz being closed, and then you have the oil spike. But if I had to guess on it, I would say there's not going to be an attack on Iran.
Okay.
But it makes sense to own oil stocks in a portfolio to hedge it.
Okay. What is the best case as far as the U.S. equities are concerned for this year? How much?
My view on U.S. market, I've got a stronger view on the relative story in the absolute. So my view has been since the end of last 24 that the U.S. has made an all-time peak as a percentage of world stock market capitalization. So to be precise, the U.S. peaked at 67% of MSCI All-Country World Index.
Okay.
And I think that's an all-time peak, and that's consistent with my view that you're going to get a derating on the hyperscaler stocks,
Okay.
which dominate the U.S. market
Sure.
because of the huge capex, which is making these companies generate less free cash flow.
Sure.
So I believe we've begun a period where markets ex-US will outperform. That happened last year, and I expect that to continue.
Let's take a short break and come back again and ask Chris more about the India portfolio as well as his view on India. Welcome back. I'm in conversation with Chris Wood of Jefferies. I'm going to ask him about his view on India and specifically about his India long-only portfolio as well. Now coming to India, Chris, because you travel to India so much and there's a lot of fan following in India as well to read to what Chris believes on India. I saw a tweet, you recently met Piyush Goyal as well, the Commerce Minister. You think from a trade point of view with the US or with Europe or with the other countries, it's largely been settled now? There is no downside risk in terms of tariffs?
Well, I think it's good news that obviously the European-India trade deal has finally happened. And it looks like Donald Trump was a spur for that to happen. So that's a sort of indirect positive. On the tariff thing, I personally think there's a chance that Donald Trump backs off the whole tariff agenda, although he's not going to admit it in public.
Okay.
The reason I say that is the polls show, we've got the midterm elections this year, and the polls show that the tariffs are not popular amongst ordinary Americans because despite the inflation data in the US, which looks relatively benign, it's quite clear from the opinion polls that ordinary Americans feel the cost of living. And I just don't think the tariffs are popular.
Okay.
So I think there's a good chance he sort of quietly backs off the whole agenda without admitting it.
Okay. Well, that will be a great news, right, for countries like India.
Yeah.
But even if he doesn't back off...
Because it's not popular. Right now, he's losing the midterm elections.
Sure. Even though if he doesn't back off, still at the current rates what we are with the US and with the European nations, you think it's pretty okay for India to do well from here?
But I don't... Hopefully, the experience with the US prompted the Indian exporters to look for other markets. I think one unfortunate consequence of the tariffs, though, is that I think the central bank allowed the currency to weaken more last year to support the export industry. But personally, I think that was a mistake because the rupee going through the 90 level is a key psychological level. And I think a lot of Indian corporates were not positioned for that because I've met many Indian corporates in the last few years who basically have been of the view that depreciation is going to be less going forward. So I think that's been a negative. It's also negative from the point of view of foreign investors.
Yes.
Because it made the rupee India underperformance worse last year. And again, it wasn't expected.
Sure. From a flow perspective, Chris, because you spoke about rupee being a bit negative for the FIs, we've seen first signs of FI money coming back into the Indian markets. This month, we saw nearly $2.5 billion of inflows from the FIs. The FI holding in India is the lowest in the last, say, 10 to 15 years. You talk to a lot of global investors as well, look at India. What's the sense you get? Is it that you're going to see a lot of FIs coming back to India now?
No, you're only, for real flows into India to happen, one or two things have to happen. One, the Indian market has to fall a lot so it becomes very cheap.
Okay.
So that, in my view, will only happen if we suddenly see these SIP flows stop.
Breaking off. Okay.
Which is not my base case.
Sure.
My base case, the flows keep coming. So in that case, the only way we're going to get big foreign money into India is if this whole semiconductor trade peaks.
Okay.
And we get a sharp sell-off in the semiconductor stocks in markets like Taiwan and Korea.
Yeah.
And you know that the more the market questions the capex, the more the chances of that grows. So if I had to guess on it, it's more likely to be the second than the first.
Okay. Okay. One from a sector point of view, the one sector which everybody's been talking about of late is a sharp sell-off in the Indian IT names. Sitting out of India, looking at all global markets in terms of tech stocks, what's your view on Indian stocks now? I know your analyst has downgraded recently all the Indian names. But
the IT services.
Yeah, IT services. But what's your thought on the IT services?
No, I haven't got the IT services in my portfolio, but frankly, I never have. Never had that because I've always had a Indian green and furniture portfolio more focused on the domestic side. But at some point, there's going to be a counter-trend rally in these software stocks because it's not like these businesses are disappearing tomorrow. So I think the role of Indian IT services will be to help corporates migrate to small business models, the small language models designed for their own purposes. So there's a role for the IT services, but you know their long-term growth, revenue growth, is going to be less than people were hoping for probably, and they're going to be, I think, importantly for the economy, the risk is they're employing fewer people. So while there can be a counter-trend move, I don't think they're a structural hold. No.
Sure. But do you foresee or do you see a risk of a second-level impact on, say, consumption and the real estate stocks in India on the back of sharp sell-off in the IT names?
That risk exists, definitely, but I think that risk in the first instance is greatest in the developed world.
Sure.
So these predictions of all these white-collar job losses, which are potentially very bearish, if that's going to happen, it's going to happen first, in my view, in the developed world.
Okay. Okay. But
and then it's going to happen first in America.
Sure.
And then you will have a risk on the consumer lending portfolios.
No, the reason I asked you is because, in your India model portfolio, you have exposure to a lot of the real estate names.
Well, not a lot, but
some of those real estate names you have an exposure to.
Yeah, I'm quite comfortable. Now, the foreigners tended to own those stocks, not the domestics. So I think they've been hit by foreign outflows.
Sure.
But the way I see some of the prominent Indian real estate companies is that they've taken market share. Yeah, these stocks are not expensive, so I'm comfortable. Yeah, I'd rather own them than the IT services.
Sure. Chris, the other big sector in India has been the financials, and I believe you have a lot of exposure to the private bank names, even for that matter, SBI.
No, less than historically.
Huh? You've been
less than historically.
Less than historically. What's your view on the financials now? Because things seems to be improving. Credit cycle is on a verge of improving.
No, the loan
quality is low.
Yeah, the loan growth is picking up, and the monetary easing is probably nearly over. So I think I think it's improving. But I don't think the private sector banks will ever be as great a story as they were in the first 20 years of this century.
Okay, but
but I think they're fine. But I just don't. They were very, they were the single best story for many years.
Sure. So while 20 years back, financial was the best story. For the next 10 to 15 years, 20 years, to your mind, what is going to be the best story in India?
Well, I just think you need. I mean, I think you can still own the banks like in any market, but I think got to look at things more infrastructure related too.
Okay. All the infrastructure names in India?
Well, just I mean, one very simple way is to invest in airport related infrastructure.
Okay. Okay.
Because that's all capturing the consumption.
Right.
So right now, today, you see, you could own a travel platform, which is geared to the travel.
Yeah.
But the risk is the travel platform could be disrupted. But if you own a stock geared to an airport and consumption at the airport, there's just much less risk of disruption. Right. So that's a good example of moving from digital to physical.
Sure.
Now maybe the travel platform won't be disrupted.
Yeah.
But I personally don't know.
Okay.
And will people just still use the travel platform because they're used to using it, or they? And my guess, the older the person, the more they'll just stick with what they're used to, whereas the younger the person, the more likely to go direct.
Right. Chris, the other risk or the other fear in the market is with the fall in the IT names and the kind of AI disruption we are seeing globally, the risk has been perceived in a lot of the platform businesses in India as well. You have exposure to some of those names. Given the global experiences, what's your thought?
Well, I've reduced them. So to me,
is that a risk to your mind that they can be a risk with the AI?
No, clearly it's a risk.
Oh.
But I would say that if there's a physical aspect to the platform company, it's less risky than if there's no physical aspect.
Okay.
So there's a delivery function that's a physical aspect.
Sure. A very curious question which somebody has thrown to me. A very I'll say young investor. He was very curious to understand what made you bullish or add Indigo into your long only portfolio.
Well, I used to have it. I took it out, but I put it back in because it's very unusual to have such a dominant airline in a market.
Yeah, and profitable one.
Yeah, but you got the example in Europe of a very successful example of Ryanair.
Okay.
See that. By the way, that reminds me of one point about AI. I've been saying because the internet economy created these winner-takes-all platforms.
Sure.
But the risk is that the AI economy turns out to be more like the airline industry, very capex intensive.
Sure. A word on some of the big corporates in India. You met a lot of them. You track some of those big corporates as well. The likes of JSW Group, the likes of Adani Group. Anything that stands out for you in terms of big corporate which can emerge as a real big winner in the next few years from you?
Well, no, I just think that there's been a lack of private sector capex in the economy as a whole.
Yeah.
But there's certain groups which have been doing a lot of capex.
Yeah.
So I suppose the issue is, does that capex broaden out?
Sure.
Hopefully it does.
Okay. You expect a lot of the private capex to pick up from here now?
Well, I'm hoping it picks up, but I mean we can't assume that because that's in the last 10 years the biggest driver of capex, as you know, was the government.
Okay.
But the government can't do it forever.
Yeah, exactly. So you expect that to change from government capex to private capex?
That's what should happen.
Sure.
So we have to monitor.
Sure. Chris, the other big theme in the last 1.5 years is the government shift from capex to consumption. We saw it in the last budget, in this budget as well. From a portfolio perspective, you think there is a time to now shift from capex to consumption names?
No, I think that was a year ago.
Yeah, but that trend seems to be continuing, right? They've done the GST cuts as well. There is a massive rate cut which is behind now for us.
Yeah.
In that sense, you think consumption as a sector should do well from here?
Yeah, but I think the real timing of that was a year ago.
Okay.
That was the inflection point.
Okay.
So the question right now is, do you go back into some capex names?
Okay. That's going to be a big theme for Chris Wood in the next 1 year?
Well, at the margin, yeah, but I don't want to bang. It's much more important what happens in AI. But basically, we've gone from, I think the inflection point from capex to consumption really happened a year ago.
Okay. Okay. Just before I let you go, Chris, one big assumption for India and your one big bet as far as India is concerned, with a slightly longer view, like say 3 to 5 year view, what would be that?
Well, I think from a stock market standpoint, it's very important these flows continue.
Okay.
SIP flows.
Okay.
So in that sense, what we've avoided in India, which you have a lot in America, you have in America big passive investment. Sure. Everybody investing in the same index products, like linked to the S&P. So that actually creates a risk on the downside because everybody owns the same stocks and there's a market panic.
Correct.
You can have a big overshoot on the downside, which is a risk now facing the US market. So in India, it's been very healthy that we don't have this indexing. We have, we have active fund managers.
Sure.
And the flows. So I think that's a very important for the Indian stock market that keeps going.
You know, Chris, your India strategist believes that earnings are on an upcycle now. The large part of the downgrades are done.
No,
with,
we're
and
hoping the
probably
earnings.
going to see an upcycle.
Yeah, we're hoping the earnings pick up this year, and we're hoping we get about 10% nominal growth.
Okay, but will it mean that the focus can shift back to the broader market names, the mid and small cap names, which
it should mean that.
Yeah. Is that something you'll be looking for?
I think in the long run, the interesting stories in India are in the small mid-cap space. There's lots of interesting smaller companies. It's just you have very high valuations.
Chris, thank you very much for talking to us in CNBC TV 18. It was an enriching discussion from global to local to as well as geopolitical risks.
the CNBC TV 18 special. I'm Shireen Bhan, and we're coming to you live from India's financial capital on a very windy evening in Mumbai. And that's because Canada's Prime Minister Mark Carney is here in India. This is an important visit. It's a significant visit because it is after a gap of 8 years that a Prime Minister from Canada is on a bilateral visit to India. The plan is to try and reset the economic engagement, reset and repair the relationship between both countries. Joining me now to talk about what we can expect in terms of economic re-engagement and an economic reset is Canada's Finance Minister. Thank you very, very much, Mr. Champagne, for joining us here on CNBC TV 18. It's great to have you. Winds of change quite literally blowing.
Exactly. You know, this is an historic visit. You said it in the proper sense. Not only it's been a long time, but the world has changed so much that I see a strategic alignment when it comes to our economic interests between Canada and India. I can tell you today we've been meeting a number of business leaders. We've been talking about the fintech industry. We've been talking about critical minerals. We talked about energy. We talked about natural resources. And, you know, I think that what's clear today is that people make the connection between food security, energy security, and national security. And I think in that sense, the world wants what Canada has to offer. A very stable, predictable partner, a G7 country. And I think it's a win-win. Honestly, I'm glad. I came here, you know, more than 10 years ago with your Minister of Finance. At that time, she was Minister of Trade. I was Minister of Trade. Right. She became Minister of Defense. I had a different portfolio. Now, as Minister of Finance, we're going to team back together again to really bring that relationship to the next level.
You know, your Prime Minister made it very clear when he spoke in Davos that the world order has changed. There's no going back, and this is a rupture. It's not a transition. Is this re-engagement or realignment also critical given the times that we live in?
Well, I would say for us, it's being strong at home and strategic abroad. And this is a relationship that we have maintained. I can tell you, even your foreign minister, Jaishankar, I've known him also for almost a decade. We always knew that that relationship needed to be reset in a way. And now, because of the state of the world, I think that the business leaders see it, the political leaders see it, the community leaders see it as well, that we need to re-engage with each other. And honestly, it's when you spend time together. If you think that, you know, India is the 4th largest economy, the fastest growing economy in the G20, we've seen a number of the G7 leaders being here. And I would say Prime Minister Carney inspired the world. I was in Davos when he made that famous speech. What I think
and got a standing ovation.
Will be historic. Trust me, I've been to Davos. You don't get standing ovation very often. But what he did is that I think he not only inspired the world, but he put that in an historical context, you know, where we are today. And I've been in that for quite some years. And you realize that the world has changed in just a few months. And what we have experienced in the past is not going to be the same in the future. You know, Canada chaired the G7 last year, so we had a number of meetings. The G7 plus, India was invited.
The Prime Minister was there?
Yes, exactly. So I think that there's never been a better time. We talk about, for example, the fintech, all the innovation you've done. We were looking at AI, quantum, and cyber. How can we do better? On the energy side, obviously, India is looking for a partner like Canada. Critical minerals is essential for the future of the economy of the 21st century. So, you know, having that dialogue, I think we have been wanting to talk to each other for a long time, and now the Prime Minister has brought a big delegation to really show the significance of the visit, and that's why I'm very happy to engage with Minister Sitharaman, with Jaishankar as well. You know, it's going to be a great it's a great reunion, put it this way.
Well, you speak about this being a great reunion, and I'll double down on the ambition for both sides as part of this partnership. But let me address a crucial issue that the world is grappling with, and that is the escalation of hostilities now. Iran, Israel and the U.S., a joint operation with Israel and the U.S. on Iran at this point in time, airspace closures. As Finance Minister, how concerned are you about this development?
Well, we're following the situation very closely, obviously, as the world is. And the Prime Minister will be issuing a statement momentarily to state the position of Canada with respect to that. So I'll probably leave it to the Prime Minister to comment further. I think there'll be opportunities, but it's a fast-evolving situation. A different aspect in the regions are impacted by what's going on. So I'll leave it to the Prime Minister to comment further on that, but we're monitoring that very closely.
No, fair enough, and this is a developing story. It's a fast-moving story, and I would imagine that we are going to see world leaders comment on it. But let me build on the reset that you spoke of, and what can we now expect in terms of the ambition or the renewed ambition of giving more weight to this partnership? The CEPA, where do things stand on that front, and what is the ambition on getting the CEPA done?
Very ambitious. You know, I started that with actually Minister Sitharaman at the time, so a decade ago. Yeah. But now India has moved in a different direction as well. We've signed the trade agreement with the European Union, with the United Kingdom, and that's why I'm very, very hopeful, you know, that we'll go on a fast track. Because that's what we need now.
How fast is the fast track likely to be?
Listen,
you talked about the decade, but how fast is it likely to be?
But I'm ambitious. The world has changed. We have changed. I think our Indian friends have changed as well in terms of how we approach these agreements. What is this is all about providing more stability, predictability to investors. I was with the pension fund. You know that the Canadian pension fund, what we call the Maple 8 for your viewers, are the largest investor, if you take them collectively, in India. We're the number one.
$50+ billion, if my memory serves me correct.
It's even closer to 100 now. I even have good news for you. Now it's closer to 100. Okay. But what we're doing now is that with the work we're going to be doing, we want to charter a course to have even more. And that's why we came here with, you know, the Maple 8. They're very interested. I read about the monetization report that you've done. That was my, I could read it across, I would say, the ocean to make sure that we were very clear when we meet with Prime Minister Modi. Very interesting what you have been doing on the roads, on the ports, on the railways. And I think Canada is seen. I mean, we've already been, in many ways, you know what some of the Indian partners said, we were part of the journey with India as you develop that program, because the Maple 8, the pension fund of Canada, have been the first basically to join India in doing that. Now we want to do more, and we need some conditions so to make sure that they are regarded.
What conditions would you like for Canada's pension funds to invest more in India?
Well, there's a number of things that we'll be discussing with the finance minister when it comes.
Tax-related or outside
Well,
of
there's tax-related. There's investment protection, which is something that always come in the discussion. But I think we have a joint vision. You start with the vision, and when the vision is there, everything else becomes possible. And I think it's a great moment for India. You know, you're the fastest-growing economy in the G20. The monetization portfolio you have, the Vision 2047. I mean, there are so many things that when we look, you know, the same thing for Canada. I presented a budget which is probably the most ambitious when it comes to investment in housing, infrastructure, productivity, and defense.
From dependence to resilience.
You liked it. Yeah, you remember it.
I think that's what everyone's attempting to do at this point in time.
Well, I mean, if you talk to the head of the IMF, she really said, you know, there's really two countries in the G7 who have the wherewithal to use their fiscal capacity. Canada is a AAA credit-rated country. We have the lowest net debt to GDP. So we have that fiscal capacity. We said countries like Canada and Germany will have that. If they invest in growth enhancing areas, they will generate the growth that the people want to see. So when I see the journey of India and our journey, infrastructure, housing, the things that are going to make our economy more resilient in a fast-changing world, because you and I would know that the trading relationship has changed. But Canada, you know, has a lot to offer. We're a big magnet for talent. We build ships, we build planes, we build cars, we have critical minerals, we have energy. And we're the only G7 country with a free trade with all the other G7 nations. So we're kind of that hub. And you know what? A lot of Indian people have Canada in their heart, I would say. We have 1.8 million Canadians, which are Indian origin. So there's a strong base and a big willingness to do more together, and this is the moment.
Well, speaking of doing more together, and you said that this is the moment, defense, and that is an area of cooperation between both sides. That was a big part of your budget. That's one of your 4 pillars that you focused on as far as your spending is concerned, also to meet that 2% commitment for your NATO spending. But how do you see India and Canada working towards in that area, in the defense area specifically?
Well, it's a very good question, because what you find in the G7 countries when we had our discussion is that the money that will flow into defense and security and sovereignty outpace, I would say, the production capabilities. Interestingly, India as production capabilities, you know, because I would say in a number of countries in the West of NATO, there's been an underinvestment in production capabilities. And now you have an inflow of capital, but obviously I would say today money doesn't buy much because there's, you know, there's lag in production. So interestingly, India has kept a production capability. So obviously, my colleagues have been discussing with a number of Indian firms to see what we can do, and vice versa. You know, Canada is one of the few countries which produce plane, so there might be there's a win-win in looking at that. But this is the kind of work we needed to do. We need to roll up our sleeves, look at what are the elements of interest. That's what we did today with you know, I met with business leaders. And honestly, after each meeting, I wish you would have been with me in the meetings, but you would have seen.
I would have liked to.
Yeah, there was a lot of interest. We came out with it. You know, sometimes you have meeting and it's hard to find common ground.
Right.
This time it was really easy. We found common ground, next steps, and you know, Minister Sitharaman is planning to visit Canada as well. I look forward to welcome her, and I think it's going to be cementing the great work that you know, Prime Minister Modi, Prime Minister Carney are going to be doing.
You know, energy, and that's the other area of opportunity. And we had your energy minister here in January on the sidelines of the India Energy Week. They renewed their commitment on the energy partnership with India. Now, the U.S. is trying to get India to buy more of LNG and oil and gas from the U.S. and from Venezuela. How do you believe this is likely to play itself out? When we talk about diversification, how interested is Canada in getting India on board to buy more?
Well, I would say what I hear from Indian industry is that they very much look forward to Canada in a way as a stable, predictable partner because, you know, the energy landscape is changing, the trade relationships are changing. But one thing that has never changed is Canada is a trusted partner. And therefore, when you're looking at energy security, there's the key word when you're talking to pretty much every trade ministers today or finance minister is diversification. It's true when you have a portfolio of investment. It's also true when you're looking at a country like Canada, which historically has been looking south. You know, we've been blessed by geography. We're going to continue to do trade with our American partners. But at the same time, I feel that, you know, the world really sees what Canada has to offer and really want what Canada has to offer. And therefore, in that sense, I see a lot of interest to look not only for many years, I would say, people have looked at North America and primarily the United States. But now people are understanding that transatlantic relationship, there's really two foundations, Canada and the United States. And when you look at what the world's going to need in the 21st century, critical minerals, liquefied natural gas, natural resources when it comes to mining, and oil, obviously Canada becomes very attractive in that context where you have a lot of stability and predictability. So that's why, you know, this was a much-needed reset. It's a strategic reset. It's not just a reset, it's a strategic reset. And I'm glad to be supporting the Prime Minister in that. And honestly, I have been engaging with my Indian counterpart. Like most of them I've known for almost a decade. So it's good now to seize the moment, be ambitious, and really bring our relationship to its full potential.
You know, you talked about the U.S., and I wonder whether you now believe that even after the U.S. Supreme Court ruling, tariffs are here to stay, at least a baseline tariff of 10%. We don't know when the executive order for 15 is going to come in, but a baseline tariff is here to stay. That is the price that we're going to have to pay to do business with the U.S.
Well, it seems that this is the U.S. approach now, that you know, it's likely that the countries of the world, as you said, will have to pay a fee to enter the U.S. market. That seems to have been very clearly the policy put forward by the White House. So obviously there's going to be negotiation. Canada is in a good position with that because obviously we always say to our American partners that we make their economy more competitive when we work together because, you know, we're connected by the same geography. But I think it's pretty well understood that it's likely that every country will have to pay some kind of fee in order to enter the U.S. market.
So what do you see as the next steps of the strategic reset and the strategic partnership that you just spoke of?
Action. Because people are...
What does the action agenda look like?
It's you know, because what I like about the discussions we had, like I said, it was not just talk. Those were really very focusing on, I give you an example, nuclear energy. What can we do more? We talk about critical minerals. There's a number of Indian companies who said we need these critical minerals. We have strategic partnership with Japan, for example, with the European Union. And I said, why don't we do one with India? Then we look, for example, on the fintech side, you know, whether it's AI, quantum, and cyber. Canada has played a big role in responsible AI. You have done enormously well on the fintech side. We just put in the budget open banking, so there's natural connectivity. And also on the food security side, you know, Canada can really help to stabilize the needs of India when it comes to food security. So I am very hopeful because these were not just general talks. You know, we're coming out of every meeting with action items that Minister Sitharaman and I and my colleagues can bring forward in our next meeting.
Are there dates set in terms of what you want to achieve in terms of milestones?
I'm very ambitious. So if you ask me, I wish we would have done it yesterday. But it's good that we talk. It's good that we have a meeting with business leaders as well because, you know, government to government, I think we understand where we need to go. But I must say I am pleasantly surprised to see the level of interest. Many of them were saying this is the meeting they have been hoping for. And now that it's happening, looking at critical minerals, looking at nuclear energy, looking at oil export, looking at mining opportunities, I see the real potential. Because sometimes, you know, you have this discussion, they say, we are very complementary when it comes to that. So it's going to be for us to bring that forward. But this is a moment, I would say, that will be remembered in the Canadian-Indian relationship.
What is the ambition on the nuclear side? Because our links on the nuclear side go back a long way. Cameco has a long-standing association with India. What do you now envisage as far as nuclear cooperation between India and Canada is concerned, especially in light of the fact that India has now passed its nuclear legislation in Parliament?
Well, it's you know, it's great that you mentioned that because not only you have Cameco, but the nuclear base in India is based on the Canadian technology, which we call CANDU. And now we have done the newer version of that technology. So clearly we're going to be exploring that because there's already an installed base of knowledge here in India, which is based on the Canadian technology, which has proven itself to be very reliable. Therefore, that's a big opportunity because, like I said, if you can be part of the energy security of India, whether it's on the oil side, whether it's on the gas side, or on the nuclear power side, this is very powerful because this is where country and I would say leaders understand the nexus now between energy security and I would say national security. And in that, you want a trusted, reliable partner. And that's why I would say the world is wanting to engage with Canada. India is providing a very interesting opportunity because here, what you've done in this country is remarkable. It's always at speed and scale. And that's what I like when I speak to people here because in many ways, you've achieved things at a speed and at a scale that has not been seen. That's why you see the growth number and the young population. And oftentimes we say demography is destiny. So if I look at the destiny of India, things are looking very good.
Well, you talked about the government-to-government engagement, but what about the engagement of the private sector? You've been meeting with private business leaders here in India from the private sector. Are we likely to see joint ventures, agreements being inked as part of this visit that you're on here?
There is, if I say everything now, you want to re-invite me next time. But what I can say...
We most certainly will, because as you pointed out, there's a lot more to do and a lot more to talk about.
This is like the first step, like you mentioned. There's going to be a number of things that we can cement together. But I think what we have succeeded in doing, and I just landed like hours ago, but what I can say is that it has cemented the desire to do more together, but also to establish priorities, to identify area of focus, and also come with a clear roadmap. So I think it's both. Yes, there's going to be things now, but I can say even in a matter of hours, you'd be surprised, but in a matter of hours, the number of things that you just said in terms of what we can do together is beyond what I was expecting even coming over, in terms of the desire of the Indian business leaders that I've met to engage not only constructively, but engaging at the speed that I've not seen in the recent past that I've been in India.
Our Commerce Minister Piyush Goyal, speaking at a public event where I was present, said that he hopes that there will be the launch of talks for the FTA, the India-Canada FTA, on this visit. How do you respond to that?
Well, listen, we need to move on. We need to move on. We need to go at a different speed. This is a different world. And when you're facing a different challenge, you have to act differently. I'd say it's also a world of opportunities. And the countries that are going to succeed are those that are going to seize these opportunities. And like I said, just spending few hours, and it's literally few hours, I see very clearly the immediate opportunities that we can do. The largest business conglomerate in India have said, yes, we understand, yes, we want to do more. We already have a relationship. I was with the pension fund. They already engage. We know each other. We like each other. So therefore, it's just to facilitate that. And I think a trade agreement will cement that. So India has been doing remarkably well with the European Union and the United Kingdom. So I see no reason why we cannot, be ambitious at the speed at which we can achieve that.
How confident do you feel as Finance Minister of being able to amp up growth in Canada? You've presented a budget, as you pointed out, which focuses on several pillars to try and drive investment. You've also got an aspect of cost savings involved there, which is also going to be crucial as part of your budget planning. But how confident do you feel about driving growth in Canada?
Very confident. By the way, I want to applaud you for having read the budget in so much details. That's great. I would say I'm very confident because Canada is what the world wants now and need. And having these structural pillars, we're on the right track. When you invest in infrastructure, when you invest in housing, when you invest in productivity, in our case, defense and sovereignty, those are key pillars in order to achieve growth. The Prime Minister has said we're going to be attracting, our investment plus what we're going to be attracting. You're talking about $1 trillion to the Canadian economy. We're going to attract $500 billion of investment. And when I talk to business leaders, they are attracted by a market like Canada. There's very few countries which have a AAA credit rating, which have the rule of law as one of their key pillars, which are big on energy, the type of energy that is needed to power the future. So, and the geography as well. People, despite everything that's going on in the world, people are very keen to have a footprint in North America. And therefore, I think Canada provides that great alternative. Being in a country which you can, provide a lot of stability and predictability, at the same time having a footprint in North America. And I see it at the G7, I see it at the G20. And the fact that Prime Minister Carney invited Prime Minister Modi at the G7 when we had the presidency, I think this was a clear signal.
Was that the start of the reset, you think?
Well, I think it was certainly a signal that will be remembered as the spark in that new strategic relationship, and that's why the Prime Minister brought a big delegation here to show our Indian partner how much we care.
Let me end by asking you, Finance Minister, what is the one thing that worries you most as Finance Minister today?
The level of uncertainty in the world. If you look at the uncertainty index of the International Monetary Fund, you look at the uncertainty today, which is higher than during the financial crisis of 2008. So our role is to provide that kind of stability, predictability, and consumer confidence, business confidence. So we live, I would say, the speed, scope, and scale of change is quite unprecedented. Some would go back to 1945, some would go back to the fall of the Berlin Wall in 1989. And it's not just trade, it's not just geopolitics, conflicts that we see, but it's also technology. The speed of AI and quantum at the same time. I would just say for people watching, it's a lot for people to absorb at the same time. So for me, it's that kind of speed, scope, and scale of change, which I think is quite unprecedented. And we've not seen that in generation. Now, that provides some challenges, but I think it provides also opportunities for countries like Canada and India to chart a new course together.
Well, hopefully there will be a lot of celebratory action at the end of this visit between both sides and a reset, as you pointed out, a strategic reset underway. But thank you very much for your time. Thanks very much for joining us.
And I hope to see you in Canada.
I look forward to being there, but thank you very much for joining us here in India. And we look forward to seeing you more here in India as well.
Definitely. Thank you very much for having me.
Thank you very much.
Everyone.
Thank you. With that, it is time for us to take a quick break. Don't go anywhere. We'll be back with more conversations. That was the Finance Minister of Canada live here on CNBC TV 18. We'll join you with more right after this.
حضرت آیت الله العظما سید علی حسینی خامنه‌ای.
Canada supports the United States acting to prevent Iran from obtaining a nuclear weapon and to prevent its regime from further threatening international peace and security.
Hello and welcome to this special broadcast on the war in West Asia. I'm Manisha Gupta, and over the next 30 minutes we decode what this war could mean for the commodity markets, for the oil prices especially. Remember, we already have been looking at a premium in case of oil. This is since the military buildup started in and around Iran. We also have seen the closure of the Strait of Hormuz that has led to disruptions in exports at various ports across the country. We also are looking at markets anticipating a run-up in the crude oil prices. It already is a 7-month highs that we are looking at in sense of crude. Prices have gained up by 20% in sense of crude prices there. And remember, Iran exports nearly 3% of overall global crude. So that is where the markets are taking cues from. Strait of Hormuz is an important area. This is where 20% of all global crude flows from. And a prolonged blockade of this perhaps could take the prices to 100 and beyond as well, is what the markets are looking at mathematics right now. Interestingly, today was the OPEC Plus meeting as well, and they have announced a voluntary production hike as well. 200,000 barrels per day is what they have talked about. How much would we look at in the overnight markets? How will Monday morning open is something that the street is watching out for. In the meanwhile, it also is about concerns on shipping routes, disrupted supply chains, rise in freight rates, and risk of wider inflation that the markets are dealing with. I also want to take you through what India looks at it in sense of concerns from this one. It is about energy security from India because 80% of the crude that India utilizes is imported. 50% of the crude that India imports also comes via Strait of Hormuz. So that is a concern that India is looking at right now. While, of course, India has a buffer stock as well, and India does have commercial stocks right now, but it does put a fiscal strain in sense of crude prices, and the pressure on the Indian rupee is something that the street perhaps would watch out for as well. But the closure of Strait of Hormuz has led to disruptions in exports of various ports across the country. Santhia Gora is here now to take us through what's happening on ground and what kind of impact it can have on our exporters.
We are picking up significant disruption to exports amid the US-Israel-Iran conflict, with containers now stuck at key Indian ports. Sources are telling CNBC TV 18 that at JNPT, over 300 containers of frozen food and perishable items are currently stuck. Clearance for these containers was stopped yesterday at noon. These consignments were meant for Iran, Dubai, Kuwait, Sharjah, Doha, and other regions in the Gulf. The cargo includes rice, grapes, onions, fruits and vegetables, along with frozen food items. The impact is far more severe at Mundra port. Sources say around 2,000 containers are stuck, mostly carrying rice cargo. One vessel had already been delayed and was expected to arrive on 26th of February. Because of that delay, multiple containers were already on hold. The vessel's revised arrival date was 28th of February, and by then, which was yesterday, the Iran conflict had begun. The combination of the vessel delay and the Iran conflict has resulted in nearly 2,000 containers being stuck at Mundra. We also spoke to Satish Goyal, president of the All India Rice Export Association. He said, and I quote, "Our containers are stuck, but at present we don't have the exact number. We are monitoring the situation. The situation will be clear soon," unquote. Remember, India exports both basmati and non-basmati rice to Saudi Arabia, Iran, Iraq, Yemen, Jordan, Qatar, and Oman. Around 80% of India's basmati rice is exported to the Gulf region, and 35% of India's basmati rice exports go to Iran. Ajay Sahai, DG CEO of FIEO, told CNBC TV 18 that there is disruption and distress at present, but it may not necessarily lead to long-term trade loss. However, he cautioned that prolonged disruption at the Strait of Hormuz and the Red Sea would force rerouting via the Cape of Good Hope or other routes. That would increase sailing time by additional 12 to 20 days, pushing up freight rates, insurance charges, and overall operational costs. He also pointed out that during last year's Iran conflict, freight rates surged 200 to 300%. Exporters are also telling us that liners are suspending services. At this point, many containers are stuck at ports and many are in transit, and the full extent of volume and losses is expected to be clearer soon.
Thank you so much for that, Santhia. Well, of course, there are concerns and at various commodities, various routes as well. And let's take this discussion forward. I am now joined by Gurmeet Chadha. He's managing partner at CIO at Complete Circle. I also have Iman Nasseri, who's MD Middle East Research at FGE Nexad. And we also have with us Mukesh Sahadev. He's founder and CEO at X Analyst. Gentlemen, hi, thank you so much for joining in. Mukesh, let me come to you first. And we've been talking about this for some time now, the military buildup and etc. And we've worked through various scenarios as well. If Iran retaliates, if Strait of Hormuz gets shut, and if it gets shut for a prolonged period, what kind of crude prices can we look at that now? From where we stand at this point in time, with most of those possibilities playing in front of us, what's your sense on how will the markets open and what is the worst case scenario that we are working with right now?
Isha, good to be on the show and also see my fellow friend Iman as well there. I think there are so many scenarios, but let's stick to some of the numbers. Just a few days ago, even Iran pumped almost 2 million barrels of oil from that same Strait of Hormuz we are talking about. So number one point, a lot of oil has been evacuated. US gave the time that was needed for a lot of oil to be evacuated, not just Iran, but many other players. That's point number one. I think you mentioned about prolonged. I think at this point of time, I believe this may not prolong. And only one reason which I have in mind is that the announcement of the death of the supreme leader in Iran has come, in my view, too soon, too fast, which might change the trajectory. So it may not last much longer, is my assessment. And that's the way I would say the oil markets may yet again avoid what we call the heart attack of oil market, which is the closure of Hormuz. This is a practical precautionary suspension. And already since huge float had gone out in the last few days, another few days, it won't wreak havoc. So I'm not looking at the hundreds numbers, which a lot of people may talk about and may want to talk about. I'm looking at below 100 numbers. And also, let's remember, we are in February. If this would have happened somewhere in the summer of 2026, in the Northern Hemisphere summer, yes, things could have gone a little bit more crazy, but we are in February. We are not in July and August.
Iman, this is also a time that you have seen OPEC Plus react to this on a very opportune way. They've talked about increasing production in the meeting today. Do you think that is going to be yet another reason that, as Mukesh says, we perhaps wouldn't open with $100 a barrel there? All right, we'll try and get Iman back. We've kind of lost him right now. But Mukesh, would you say that with OPEC Plus coming in and increasing production there and hiking production immediately, would that also lead to prices not surging higher?
I'll keep my answer very short and let Iman probably, when he comes back, react. Number one point, I think OPEC, in my view, as I watch, they want to stabilize the market. So they, in my view, will also not like the oil prices to go very high, because very high oil prices threaten the unity of the members, leads to non-compliance, leakages, and all kind of behavior. So I believe what OPEC has done is a right thing. As a contingency, there was a talk of 400. They have been measured about 200, because yes, we are in February, and China, which is the biggest buyer of the oil market, is well stocked up. So I guess OPEC has done a right thing to provide some support to the market, so that when the market opens up, it doesn't go into a bit of a reactionary mode. It stays stable around the numbers we have seen. So this 200 is probably in the right ballpark. In the grand scheme of things, it may not be a large number for the point, but I think for now, I would say that this caps things.
So as we get Iman back, Mukesh, what is your sense on the crude prices range then? I'm assuming we will open gap up on Monday morning, but how are you looking at a worst case scenario perhaps? Is it 90? Is it 95? What are you looking at?
I'm not looking at worst case scenario, because there is, in my view, for now, based on what I see, I don't think there is a worst case scenario. It should have happened if that was the case by now. Like I said in my previous engagement, Manisha, US would not have taken this action without making the Hormuz Iran proof. And I think so far I would call that this is not a closure, this is a suspension. Now, yes, worst case scenarios also, I would say that a lot of this is priced in. We had already seen a rally in the oil price in run-up. This is not a sudden attack. This was a planned attack. We already knew that the bigger goal for this attack is to tackle China. This was not just about Iranian nuclear. So everybody probably had that, despite the talks, which were probably buying the time, the attack is imminent, and US with the naval presence will definitely ensure that we don't have the heart attack of the oil markets, because that also goes against the US aims. So a lot of it's priced in, but yes, we will open up with some panic kind of a situation, but definitely not anywhere near hundreds.
All right. It would be interesting to see on how the markets open up and react to all of this. But Gurmeet is with us as well. Gurmeet, it's going to be about crude oil, majorly a big reaction on that, and that might have a ripple effect on various other commodities as well, starting right from agriculture to rupee, fiscal markets, etc. What is your sense on that? And also coming on gold and silver as well, because the offshore market, which doesn't get reported, there have been bids much higher than what we saw on Friday close. What are you anticipating on these?
So Manisha, hi, good evening. I think you will have some bit of positive impact on upstreamers, E&P, also maybe standalone refiners like Chennai Petroleum, etc. OMCs obviously be impacted, and if GRMs do go up, might be worth looking. Even Reliance also, as far as immediate impact is concerned, plus the oil derivatives will be negatively impacted, which is paints, chemical, etc. And mind you, any spike in oil is different than early days when it used to be in 3-digit, because the world is much more indebted. The debt levels are very high, and things are quite fragile. So any higher oil shock, even if it's $10, $15, will create some problems. Coming to gold and silver, obviously there will be a positive reaction. I think gold is, it's been, one part we have done probably been lucky is that over the last 12 months we've been actively recommending a multi-asset strategy, and I think there will be some reaction in precious metals as well. I think gold already is showing in different markets a spike of about 3 to 4%. I'll also watch out for silver, considering the kind of a short squeeze which has been built up over a period of time. So interesting times, but I agree with what Mukesh said. This doesn't look sustainable, because, once the uncertainty is up to the event. Once the event plays out, although things are fluid, things start getting priced in post-event, which is, eventually control coming on Iran oil. You have Venezuelan oil. Look, might as well also have some interesting development on the Russian oil.
Oh, well, yes, most of this has played out on the weekend, so Monday morning perhaps things would get better, but we don't know. As said, it's quite fluid even at this point in time. Gurmeet, we'll let you go. Thank you so much for joining in, and thank you for staying back with your sense on commodities as well. As we head into the break, let's listen to Chris Wood, Global Head of Commodities at Jefferies, who expects big upside on gold. He adds he wouldn't be surprised to have a period of extended consolidation. Let's listen in.
In the medium term, I see big further upside in gold, but I wouldn't be surprised to have a period of extended consolidation.
Okay.
Sideways consolidation to maybe sideways to down, but I'm talking tactically.
But you're not expecting...
if I had a leverage position in gold, I would have taken profits. My long-term target is now 6,500, but I mean, gold can easily go to 10,000.
Welcome back. Let's talk about India right now. And while India isn't importing a lot from Israel or Iran, for that matter, in sense of petroleum products, a lot of other commodities may get impacted. But sticking to crude right now, and Mukesh, a country which imports 80% or 85% of its requirement, and 50% of that comes in via Strait of Hormuz. What is India looking at right now in sense of prices, in sense of energy security?
Thanks, Manisha. No, I think India is in a very unique position just because of the recent deals done with Europe and with the US. And I guess the recent visit by Prime Minister also to Israel just before this happened may not be just a simple coincidence. So I guess India stands probably in some ways to benefit. Chances are once the Iranian oil is under, let's call it the same Venezuela style US sort of control, higher chances for India to get Iranian and more Venezuelan barrels. And there has been pressure on India to reduce the Russian barrels to zero. I think that's a possibility now. I'm not saying that would happen, but that's a good possibility now because India needed the alternate barrels, a million barrels whole, and combined Iranian and combined Venezuelan, assuming they don't go to China, which I think will not go to China. So India stands to get a good quality of crude, and some of the Indian refineries on the West Coast are fully designed to process these kind of crude. So I see in some ways kind of an interesting positive turn for India. My only caution is that there is still US president visit to China, and what may happen on that deal? Will this positive note will last longer beyond the end of April, beyond the end of March and April? I don't know. But for now, I think this sounds kind of a positive situation for India. India's biggest fear was the LPG kind of market, which is a very sensitive product for India. A big exposure is there in the Hormuz. So far, I guess that's prevented.
Also, when you look at the overall markets, and crude is just one part of it, Mukesh, how are you also looking at the gas part of it?
Excellent question. I guess 20% of the LNG flows, we keep on using these numbers, but I think here's where 95% of the Qatari LNG is where it gets impacted. And again, LNG's exposure to China. So Manisha, like in my previous, I maintain that this is to gain a strong leverage on China. What probably in the gas or oil is not priced in is not the closure of Strait of Hormuz, is the selective control of the flow of Strait of Hormuz how US and the allies will drive the flows, which direction will it go? Will it go to China? And then higher pressure on the Russian flows as well. So this is, to me, just the beginning of the start of how US will deal with Russia and China, putting them into a corner while India is kind of in the same camp. So yes, LNG, again, a China exposure, crude, big exposure for China, other products, big exposure. So in some ways, this to me, the train is moving towards China. And if I may ask, call Manisha, if I look at the words Venezuela, Iran, Russia, and US, I would call this is the virus of the oil markets. And US tried to deal with tariffs, with sanctions, didn't work. The system sort of mutated, adapted. That's why this big action was probably needed. So I think US has worked hard to deal with the virus of the oil markets. Will it get probably fully solved? I guess still China and US find a common resolution. I think the oil market will continue to stay in a high state of alert owing to this virus.
Oh, well, it absolutely does feel like that. So one more final question. And markets are not, as you said, and as seems to be a consensus now, that this is not going to be very, very prolonged because you have a new Fed chief coming. You also have US midterm elections coming. So I'm assuming that in some sense, US, for one, would want this not getting elongated or prolonged for that matter.
I guess we have not seen, Manisha, the US technology. I think we have seen probably in the last war, things have changed. I think US gave a clear demonstration of in Venezuela. I think there should not be any doubt. US has probably taken care of this. So I personally believe that this will not last much longer. And the quickly US will now turn into the post sort of situation and how to deal with China and prepare for cornering China rather than anything else.
All right, we finally have Iman Nasseri with us. Iman, hi, we've been trying to speak to you for some time now. What is your reaction to what really has been ongoing over this weekend? How are you reading it? And one, what is the worst case scenario that you're working with in sense of what can happen and on the prices as well?
Yeah, apologies for the technical issue I had to deal with, which kept me offline for some time. Yeah, the situation, actually sitting in Dubai and hearing the missiles and interception of many of them since yesterday afternoon has been quite of an experience and quite stressful. The situation is far from resolved, as everyone knows, and we have to yet see what comes next after the killing of Supreme Leader Khamenei. So what is the worst case scenario, if I want to answer your question directly, is perhaps spilling over the conflict from what has been exchanging missiles and attacking bases into more infrastructure, energy infrastructure. The Strait of Hormuz closure has been basically in effect through originally risk of war and the missiles exchanged between Iran and the Gulf states, but later IRGC basically threatening this. However, it could become a physical ban and basically mining to all sorts of sinking ships and whatnot. So right now, obviously the conflict has been really, really elevated, but it has not gone into major disruption of supply. I'm talking about oil, but as your other guests rightly mentioned, there are a lot of commodities that go through the Strait of Hormuz in and out in terms of trade, which are now currently disrupted. We also know that the airspace has been closed. Two of the major hubs, airports, Dubai Airport and Doha Airport, has been closed, and many people have been stranded. That's also trade. And what I see from now on is that there is a high chance of this situation to prolong at least in weeks, if not months. So I think we have seen a lot of developments over the past day or so, but a lot more can come depending on further retaliation of Iran, as they threatened to do after the killing of the supreme leader, and again, it's spilling over into the physical supply and oil production and exports will be the next big jump in terms of escalation.
Man, I have a last quick question. As you said, this could perhaps be prolonged for next weeks, if not months. Do you actually see supply disruption on oil infrastructure there, one? Do you see other countries as well trying to retaliate onto this? And then what is the crude prices that you're looking at then from here on? Are you looking at 100 or you think that's slightly far-fetched?
No, at the moment, those are all chances that do exist, but we have not incorporated those into our base case. Our base case remains the scenario that will keep these basically contained. And what we see is that the markets will open probably at around $80, which is another $10 premium on top of the previously priced in $10 VAR premium. And then from there, if we do not go to the next stage of supply disruption, the current amount of supply disruption is the passage of loadings through Strait of Hormuz, which is going to be most likely compensated by release of some inventories and stocks from the OECD countries as well as China. We know that combined, these two entities have over 3.9 billion barrels and releasing about 60 to 100 million barrels every month would displace basically the cargoes, export of cargoes out of the region. So right now our forecast remains around $75 to $80 for most of March. But again, we can see it going into 90s and 100 and above, depending on how serious the physical infrastructure of oil supply gets targeted.
All right, so the situation is fluid, and as said, there are various scenarios that can play out in the next 1 week as well, and depending on that is where we will be looking at the crude oil prices, 80s or 90s or 100s, take your pick, but that we would know, of course, in the next week itself. Iman, Mukesh, as always, thank you so much for joining in and trying to make sense of what really is happening in the Western world, rather the Asian markets there, and how we would look at the crude prices reacting to that. But with that, it's a wrap on this special broadcast. Stay tuned for more news and updates on the other side.
Hello and welcome to this special broadcast. I'm Nigel D'Souza. Well, Iran's Supreme Leader Ayatollah Khamenei has been killed in airstrikes by the United States and Israel. Iran has promised revenge and launched a fresh wave of strikes. A member of Iran's Guardian Council, Ayatollah Arafi, has been appointed as the interim leader. The US and Israel have also launched fresh wave of strikes at the heart of Tehran for the second day. Iran claims a school was bombed, leading to the death of nearly 100 children. Explosions have been reported in cities like Doha, Dubai, Abu Dhabi, Kuwait, Riyadh, and Manama, as Iran fired ballistic missiles and drones at the US military bases in the region. With missiles flying around the region, the airspace has been closed and thousands of flights cancelled. Maritime route has also been disrupted after Iran shut the Straits of Hormuz. The small stretch carries a third of the world's crude oil trade. The tensions have spilled out of the region with large protests seen in Pakistan. Protesters attempted to storm the US consulate in Karachi, leaving nearly a dozen people dead and several wounded. With West Asia plunging into chaos and war, the markets are staring at a period of dangerous uncertainty. How should you navigate it? Well, over the next 60 minutes, we will analyze and also put the spotlight on the commodity markets with Manisha Gupta. Joining me on the show right now is Mangalam Malu. Hey, Mangalam, Sunday, special broadcast. Well, the markets will be, looking forward to tomorrow's opening. It's going to be a bit of a tricky one.
It will be a tricky one, Nigel, and with all the geopolitical tensions that are underway and moment-by-moment footage that we're getting and news and updates that we're getting, it'll be very important to track the impact of that, particularly on crude prices, and as a result of which, what happens in our equity markets and how this happens. Obviously, there would be very near-term panic, but as during the course of the show, we will obviously display that, during moments of panic, while war and all these situations are a humanitarian crisis and a crisis of, life, there is a lot of uncertainty. If staying the course and discipline is maintained during the markets and investment periods, then perhaps this could give good opportunities in terms of investment bets as well. But all that and more during the course of the show. Let's listen into what Israel Prime Minister Benjamin Netanyahu had to say after striking Iran.
This morning, a powerful strike was launched and destroyed in the heart of Tehran, the compound of the tyrant Khamenei. For 3.5 decades, this tyrant dispatched terrorism across the world, made his own people miserable, and worked constantly and tirelessly on a program to annihilate the state of Israel. That plan is there no longer, and there are many signs that this tyrant is also no longer.
All right, let's welcome our first guest on the show. Joining us now is Meera Shankar, former Indian ambassador to the United States, who joins us on the show. Hi, good evening, and thanks a lot for joining in on this special show, ma'am. Appreciate you joining in. Well, a quick question first. Going by all the developments that we have heard and all the sound bites that we've got, are we looking at just a limited strike cycle? Or do you think we're getting into the early stages of a prolonged regional war?
Well, both possibilities are currently open. We don't know how it's going to unfold, and a lot is going to depend on whether the US is looking at a limited strike to exert pressure on Iran to be more compliant in negotiations, or whether it is really looking at regime change, because, that's what Israel has been talking about. And while the Supreme Leader, Khamenei, has been killed in the attack, the Iranian system is not a banana republic. It is a country of nearly 100 million people, and they have a framework. So Khamenei's son has taken over with the consent of the Guardians Council. And we don't know how this is now going to unfold, because Iran has launched retaliatory attacks against Israel, and reportedly also hit Israeli military headquarters, but also against other countries in the Gulf which host US bases and facilities, including UAE, Abu Dhabi, Qatar, Bahrain, Oman. Cities in these countries have been hit, and all the airports here are closed in the region. So we really don't know if now, in response to the Iranian attacks, you're going to see another round of strikes by the US and Israel, because they had initially announced that these are limited strikes over a 4-day period. But, sometimes a situation can develop a momentum of its own. Now, the intriguing thing is that the attacks took place because, you've seen a lot of leaders talk about how Iran can never have a nuclear weapon. Let's not forget that there was a nuclear deal with the US, Europe, US, Russia, and China during President Obama's time, under which Iran had agreed to open up its nuclear program to inspections, including surprise and challenge inspections by the IAEA, had also accepted limits on the thresholds to which it could enrich uranium, and so on. So it had accepted restraints and curbs on its nuclear program, and it was America which walked out of it. Today, as the talks were going on, the foreign minister of Oman, who has been the intermediary between the two countries, said that there was very positive news because Iran had agreed to surrender the stockpiles of enriched uranium it had built up after Trump walked out of the accord in the first term, and B, that it would forswear a nuclear weapons program now and into the future. I think the main sticking point was Iran's insistence that it should have the right, in principle, to enrich uranium. Two thresholds which are permitted by the Nuclear Non-Proliferation Treaty for non-nuclear weapon states. Now, that was something the US was not prepared to accept, but it was a point on which further discussions could surely have taken place. And at a point where actual progress is being made, you have the attacks.
But to take this discussion forward, we do have Arun Kumar Singh, who's the former ambassador of India to the United States, joining in as well. Mr. Singh, thank you for joining us. You've heard what Ms. Shankar had to say. You've obviously, seen the developments in the globe right now, all the comments that have come in from global leaders, etc. What do you make of the situation right now, and what is your best guess of what happens immediately?
So Ambassador Meera Shankar, as you mentioned, has been a senior colleague of mine, and I value very much what she has said, agree with large part of what she has said. But let me bring your attention to the kind of global reactions that we are seeing to the developments. And what has struck me is that very few countries have come out with very strong support for Iran. Of course, in the Gulf, because Iran has reacted to the US attack and attacked the US presence in the countries, they have come out with criticism of Iran. Russia has certainly come out with a strong criticism of US and Israel and has condemned them, called also for a meeting of the UN Security Council. But I suspect Russia may not go beyond that point for really any kind of material support to Iran, because Russia's focus is more on its objectives in Ukraine. And there it would like US support for getting some kind of a peace agreement, accommodating Russia's security concerns and pushing the Europeans in that direction. So they would not like to lose their access to discussions and negotiators from the US with that objective in mind. Similarly, as far as China is concerned, they have not even condemned US and Israeli action. They've only said they are shocked by what has happened. And I think that's because Donald Trump is going to China in April. He has invited President Xi to come to the US in October. And the Chinese are more focused on technology and trade relations with the US and trying to prevent the US from supplying major arms to Taiwan. So that's their objective. And as a result of that, despite their strong relationship with Iran in terms of energy purchases, supply of defense equipment, I doubt if they will come out with any kind of substantive or material support to Iran. So that's the challenge that the Iranian leadership is certainly facing at the moment. And but again, we have to see how far they are able to hold out, what is their own capacity, what kind of support they are able to sustain within the country. Because while there are segments of the population that are alienated from the government, there are also strong segments of the population that are very committed to the government that is there. And so how this dynamic plays out. And again, one of the declared objectives of the US is regime change here. And because they feel that the current regime in Iran has been hostile to the US since 1979. The regime in Iran has not accepted Israel's right to exist. So that Israelis see as a challenge to themselves. But we have seen over the past several decades that efforts at regime change prompted from outside have not really been successful. We saw what happened in 2003 in Iraq. And after Saddam Hussein was removed, there was high level of violence for a decade or more. We saw effort at regime change in Libya done by the US and the Europeans. And Libya has still not become stable. And then we see the effort at regime change, we saw it in Afghanistan, where it is said that it took the US 20 years to replace the Taliban with the Taliban. So an effort to do regime change by outside forces, contrary to whatever may be developing in a society organically, does not necessarily lead to stabilization of the situation or easy success. So given that, we'll have to watch how the situation evolves. And I'd hope that the escalatory phase of the conflict is brought down, at least through the effort of all countries. And you'd have seen that India's External Affairs Minister has also spoken to the Foreign Minister of Israel, Foreign Minister of Iran.
Right, Mr. Singh. That's right, Mr. Singh. We all hope that there is de-escalation for the good of humanity and for the good of the globe as well. Hopefully, we can get some kind of an agreement and this entire thing does de-escalate. We appreciate you joining in, sir. We look forward to keeping in touch in the coming days as well, and we'll hear from you more often. But I'll tell you what, in terms of the financial markets, every time there has been geopolitical tensions, it's actually been an entry opportunity. We'll decode what this war in West Asia means for the Dalal Strait. On the other side, we'll have a couple of our experts who will be joining in. Stay tuned. Welcome back. You're watching us here on our special broadcast on the West Asia war. Obviously, we've seen the impact of war on the markets in the very near term. Every time there has been a war that has broken out, there has been a fair amount of uncertainty in the period. But if you just look at data, wars actually, while they are a humanitarian crisis and a big problem for humanity, they actually end up being investment opportunities as well. All you need is discipline and focused approach. So if you look at the history, Gulf War I between August 1990 and Feb 1991, during that period, the Sensex was actually up by 15%. Look more locally, Kargil War as well. Between May and July 1999, the Sensex was actually up 37% that period. Remember, there was the IT boom which was underway in the world as well. The US-Afghan War, between September and December 2001, the Sensex was up 18.5%, whereas the US-Iraq War, between March, April 2003, there was a decline of about 7% out there. If you look at the Arab Spring as well, between 2011 and 2013, it was up 11%. More recently, if you look at some data that has come by, Russia-Ukraine war, Feb 2022, which is currently still underway, the Sensex between Feb 2022 and now has been up 39%. Operation Sindoor, yes, there were a couple of days of uncertainty where the Sensex was down 1.5%, but immediately as the ceasefire was announced, the Sensex on one day itself was up 4%. And the 12-day war between 13th and 24th June between Iran and Israel in 2025, that period as well, the Nifty and Sensex, despite the volatility, were up 1.5%. So the short point, wars terrible for humanity, very bad for the economy, but if the market is looked at just data points, it does give you entry opportunities. Well, that's right. Mangalam, average drawdown has been around 10%, maximum drawdown has been around 22%. And, Rajesh Kothari of Alf Accurate, they've just put out a note. They say that maximum it's been taken around 49 days to recover all those losses. Easier said than done, but let's get in our experts. We have Gurmeet Chadha, Managing Partner and CIO of Complete Circle, who joins us, and Devina Mehra, Founder, Chairperson and MD of First Global, who joins in. Hi, Gurmeet, as well as Devina. Thanks a lot for joining in. Devina, coming across to you first. Where are you right now? I mean, are you based out of Dubai?
No, I'm in Mumbai right now.
It's good to hear. Good to hear, Devina. Well, let's get to the point then. Mangalam just put out some data. It's easier said than done, that wars present this buying opportunity. Tomorrow we're going to be under pressure to kickstart trade. I think what's going to help a little bit is on Friday, the second half, only in the last hour of trade, you saw a sharp decline. And you have short positions that got added as well. So there was some sense that something could give over the weekend. What's your view? How would you advise investors to approach this dip tomorrow? Is it going to get very, very ugly? There'll be some leverage positions that obviously will sell off in the first couple of hours. So your take, Devina.
Okay, so before I come to this part, which I'm sure your viewers are interested in, as Sahil Johnny said, कौन रोता है किसी और की खाते रहे दोस्त सबको अपनी किसी बात पे रोना आया. So our focus is the markets, but just first look at the broader perspective. One is that what's happening in West Asia, and I had said to your sister channel in January that if Iran is hit, they're going to strike back. It's not a small country. In terms of size, its area is more than half India's area, and it is very well protected on the land. There are deserts and mountain ranges all around, so you can't really have a land war in that country. And I think they are, in their military strategy, they are playing a very tactical economic game. So if you look at their aim is not through their bombs and drones, a shock and awe game. They are hitting at Middle Eastern neighbors and increasing the risk premium. So it is like if you shut the Straits of Hormuz, maybe you can have military escort, but will anybody be willing to ensure oil passing through those straits? Or for that matter, all the safe haven countries around them, while it is very difficult to watch it because you have family and friends there, but as far as the tactical move is concerned, they are really making it a high-cost war, which means that they are hoping that all those countries will maybe pressurize U.S. And U.S. President Trump has said, I want regime change, but how do you have regime change just with air power and asking people to rise up, because those same people were killed by the tens of thousands not very long ago, and those armed guards are still around. Coming to the markets, I mean, you've given this data. I actually had given this data right at the time of the Russia-Ukraine war, on the day when everybody thought the world was coming to an end. I was the lone voice saying that markets forget this sooner than you know. If your narrow focus is not, as you said, humanitarian, but only the markets, that's been the nature of markets. And we looked for 50 years at every geopolitical turmoil.
That's right. So, Devina, yeah. So, Devina, I recall that call you made, the last time we had this kind of geopolitical issue.
That is 6 months later, 1 year later, the countries which are not in the conflict, their markets forget about it.
So you believe? So tomorrow you will be deploying when we see that a bit of a gap down that we see.
Deployed, but if you are not deployed to the extent of your equity allocation and you get an opportunity, if you were waiting for a correction to deploy, please go ahead and deploy.
Got it.
Because the other question is crude. And crude in any case was due for a rally. In fact, in our last global rebalance about a month ago, we went further underweight US equities and we put that money in commodities, so crude mainly, and also a bit of metals. So that was anyway something that was kind of on the cards. But crude also, let me remind you, if you look at all past conflicts, while there is every time something happens in West Asia, there is crude spikes up. Right. But barring very short-term supply disruptions, the fact is everybody wants the oil fields to work. Nobody wants crude to shut down. The new ruler, the old ruler, the invader, everybody is there for the crude. That's the last thing they want to shut down, whether you are Saddam Hussein or ISIS.
Take that point indeed, Devina, and thank you for setting that up for us. And before we go to Gurmeet and ask him specific sectors, actually, one of them which may be in focus tomorrow is the defense index. It's soared about 10% in the last 30 days, but it's still considerably off its 52-week highs. And we also have Nimesh joining us here on our special program. Nimesh, decode that for us, because when all these things happen, the one thing that rises are the defense stocks.
It does. Normally we've seen this, that as and when there is a war situation, the defense stocks gets into focus. This time it's even more important because now forget West Asia. Now entire Middle East is under focus, and they haven't spent much in the last many years on defense. We saw a big defense spend by the European countries now. Now there could be a potential, big spends by the Middle East countries as well. So maybe that's the reason why, maybe the defense stocks will be in focus. As you rightly pointed out, just in the last 30 days, the defense index is up 10%. Having said that, it's still down 12% from the 52-week highs. So that's something to take a note of. It's not been like a big sector outperformer in the last couple of months and last 6 odd months or so. In terms of individual gainers in the last 30 days, MTAR Technologies is the big gainer, up 50%. Data Patterns, Bharat Fuji is up 35%. It's an FNO stock, and that's rallied 35%, largely on the back of the fact that it's a defense play now, and Dynamics Technologies as well. There are some losers as well. HAL, of course, has been a big loser in that pack, down 10%. BDL is down 13%, and SAN DLM was also down 10% in the last 30 odd days. But while we all talk about a lot of sectors will be in focus, defense, of course, simply for the fact that now the entire Middle East is in focus now, and they haven't spent much in the last many years. So maybe the defense spends will go up from those countries as well.
All right, and that's probably the question that we'll ask Gurmeet as well. Gurmeet, thank you so much for joining us on this special program. Are you, one, exposed to the defense theme already? If not, then does this give you an opportunity, and the recent correction that we've seen from the top, despite the bounce in recent times that Nimesh pointed out, are there any opportunities here for you to deploy?
Hi, Manglam. No, so we are overweight defense, as we've been discussing in different platforms. Solar Industries is our top holding, where it benefits from both, Pinaka rockets, where apparently, despite this conflict, even French government is interested as part of the overall Rafale deal. We recently saw Armenia buying Solar multi-barrel guided rockets, and they're expanding the range from 70 is going up to 120, and broadly. So that's one product which has huge export potential. Also, Solar is a very underappreciated domestic explosive business where they have 26% market share, and their export business, they're in about 10 countries present. That also seems to be doing well. Plus, it's exposed to mining and broader uptake in the capex cycle, with Coal India being the direct client. We have Bharat Electronics continue to gain. I mean, last 3 weeks, I think it's got 4 orders. The order book is about 85-90,000 crores. With 27% EBIT margin, that gives you a fair good visibility of both order and free cash flow, as their gestation periods are shorter. And then we have Zen Technologies, also, which is into simulators and anti-drone systems. So all three are positioned. We will look at more opportunities there. Also, some opportunities may come in upstream names or standalone refiners with the volatility in crude. So that's also something one should watch out for.
All right, we'll come back to you, Gurmeet. Just before we thank Devina. Devina, parting thoughts on what sectors should one deploy? You said that if one isn't, invested in the equity market to the extent that one should be, it's a good time to deploy in the near-term uncertainty. Any sectors, if you could give us top 3?
Well, I mean, we are overweight auto components, autos, pharma, healthcare, and those we continue to be positive on. More selectively, also we have names in capital goods, FMCG, and chemicals. So we are of course in the middle of a rebalance, so we might make some changes, but broadly this appears okay. Also remember that Q3 earnings have been pretty good, which is what I had been saying on your channel also, that I expect Q3 earnings to accelerate, and that has happened. And the numbers don't even fully capture that, because while for manufacturing it kind of captures it, but services, the reported numbers were a little subdued because of the impact of the new labor code. So if you kind of adjust for that, the earnings have been pretty good. The valuations, if you look at sector-wise, were not at extremes to start with. So we are overall in a reasonable position in the markets. And as I said, I would deploy, if you are keeping your powder dry, this might be the opportunity to deploy. And I expect in probability terms that 2026 will be a better year for Indian markets than 2025.
All right, take that point. Devina, thank you so much for stopping by and guiding our viewers through this period of uncertainty. Nimesh has something to say.
Ask Gurmeet to stay back.
All right, yeah. Gurmeet stays back, actually. Gurmeet, beyond equities, we speak about commodities, etc. as well. So thank you, Devina, and all the guests. Everyone, thank you so much for tuning in. We've spoken about the equity markets, but the most important part of this would be the commodity prices. What does this, tension in West Asia mean for the commodity prices? Stay tuned. On the other side of this short break, we have Manisha joining in with a lot of experts. Gurmeet obviously stays back.
حضرت آیت الله العظما سید علی حسینی خامنه‌ای.
Canada supports the United States acting to prevent Iran from obtaining a nuclear weapon and to prevent its regime from further threatening international peace and security.
Hello and welcome to this special broadcast on the war in West Asia. I'm Manisha Gupta, and over the next 30 minutes, we decode what this war could mean for the commodity markets, for the oil prices especially. Remember, we already have been looking at a premium in case of oil. This is since the military buildup started in and around Iran. We also have seen the closure of the Strait of Hormuz that has led to disruptions in exports at various ports across the country. We also are looking at markets anticipating a run-up in the crude oil prices. It already is a 7-month highs that we are looking at in sense of crude. Prices have gained up by 20% in sense of crude prices there. And remember, Iran exports nearly 3% of overall global crude. So that is where the markets are taking cues from. Strait of Hormuz is an important area. This is where 20% of all global crude flows from. And a prolonged blockade of this perhaps could take the prices to 100 and beyond as well, is what the markets are looking at mathematics right now. Interestingly, today was the OPEC Plus meeting as well, and they have announced a voluntary production hike as well. 200,000 barrels per day is what they have talked about. How much would we look at in the overnight markets? How will Monday morning open is something that the street is watching out for. In the meanwhile, it also is about
Makani, it's wonderful to be able to speak with you again. And for those of you who are not in Davos, he got a rousing reception. There are very few people who actually get a standing ovation in Davos, and he was one of them. So it's wonderful to have you here in India. I want to start by addressing what you started your speech with, and that is the hostilities that we're currently seeing between US, Israel, and Iran. Iran saying that there are no red lines that it will now adhere to. How concerned are you about the escalation that we're seeing today?
Well, I mean, to state the obvious, it is a serious escalation. It comes at the end of, candidly, years, one could portray it as decades, of diplomatic efforts to resolve the situation, to end the nuclear enrichment, to end the state-sponsored terrorism of Iran. Those efforts have made episodic progress, but not comprehensive progress. Those efforts intensified in recent weeks without resolution. It's led us to this. It is a serious conflict. In a serious conflict, you have to make choices. We have a consistent position. Prevention of Iran obtaining nuclear weapons, prevention of the state-sponsored terrorism that has plagued the Middle East in multiple forms, and support for the Iranian people. And you know, the consequence of that will be determined by whether Iran de-escalates. We call on all parties to protect civilian lives as best as possible in what is a very serious situation.
If Iran chooses not to de-escalate at this point in time and we continue to see a protracted escalation, when you say that you support the US and you support Israel, what could that support entail? Do you see Canada getting involved as well?
Well, look, we have not been party to the military build-up to this or the military planning of this, so it is not envisioned that we would be part of it moving forward. But certainly we have both the Minister of Finance, myself with the President, the Minister of Finance with their counterpart, Minister of Foreign Affairs, I should say, and myself with the President. We've had a series of discussions over recent weeks about the possibility of this happening if the diplomatic efforts were not successful. It's been very clear the threat of what has now been realized in terms of military action. It should have been clear to an Iranian regime which has refused to dismantle fully its nuclear program and continues to pose a serious threat to the region.
As a former central banker, what could this mean now potentially for the commodities markets, and what sort of a challenge does it pose for central banks as well as for fiscal policy around the world?
In the very short term, you get a risk premium in situations like this. You'll get a risk premium, particularly obviously in energy markets, oil markets. There is military activity around the Straits of Hormuz, which is an obvious choke point. It comes at a time. First and foremost, this is about human lives. It's about establishing stability in the region, the will of the Iranian people being respected. That, first and foremost, that. When you go back to commodity markets and inflation, it comes at a time when commodity price inflation has been lower. I mean, oil markets have been soft as a whole, so there'll be some firmness and some spike on that, but I don't view it as, I view the issue as a fundamental issue of geopolitics, of ending state-sponsored terrorism, ending nuclear proliferation in Iran, and of course protecting civilian lives as much as possible, as opposed to majoring on the economic side, which I don't view as being, in the fullness of time, that material.
Let me now talk to you about India and your visit here to India. As you pointed out, this is the first bilateral visit by a Canadian Prime Minister in the last 8 years. And before we talk about the reset, we need to talk about the repair. And where do you believe you find yourself in that process of repair? Do you believe that the invitation to the Prime Minister to be at the G7 was really the most meaningful start of the repair process?
Well, I think yes, I think it was the start of the repair process. Or at least formally the trigger for the repair. The only way to repair a relationship is to re-engage, and then the question is there something substantive underneath? And I think what we saw very quickly is two things. One is an engagement on both sides with good faith and energy on the security side to work more closely together on the security side, and that has been followed up consistently with the Ministers of Foreign Affairs, but also our national security advisors, our various security departments. So that pillar is there. And then probably what is of direct interest to this room is that in parallel to that, a quick realization of the scale of the economic partnership opportunities that have only been reinforced in recent months by the more apparent rupture in the nature of the global economy. In other words, where integration being weaponized and the value of having a broader range of connections, particularly in strategic sectors, that gives autonomy back to countries. And that's where our complementarities really come into play.
So the middle powers resistance that you spoke of in Davos, so the strategic reset of India and Canada should be seen from that lens?
Well, I'm a couple of things there, just not to be too picky about the rhetoric, but I wouldn't call India a middle power. I mean, India is... I'm happy for Canada to be called a middle power, but I don't view, in all seriousness, in terms of the trajectory and the ambition. The second thing is that it's not a resistance. What I view this as is we understand the way the world is. We understand that if you have a single dependency in something strategic, it could be food, it could be oil, it could be energy, it could be semiconductors, it could be elements of the intelligence stack, it could be in space. That's a risky position to be in if that is with one of the hegemons. That's revealed behavior. So there's the no regret strategy is to have more diversified partners. And it's a positive agenda. We're here with a positive agenda. It's not defensive. We have huge opportunities to build all the way across from food, energy, through to AI, up into space, literally up into space. And that will be good for both countries. It actually will, at the same time, make us less exposed to volatility in the world.
You know, you're speaking about volatility in the world, and you talked about the new world order. Despite the U.S. Supreme Court ruling, President Trump is now talking about a 15% tariff. 10% is in place at this point in time. An executive order for 15 hasn't come. Are you prepared, or should we be prepared for a world where a baseline tariff is just going to have to be the way to do business with the U.S.? That is going to have to be the price to access the U.S. market. Is that now a realization and an acknowledgement?
Well, President Trump has been clear for months that being part of access to the U.S. market, you should pay, quote, unquote, for access to the U.S. market. Sometimes that's in tariffs, sometimes that's in changing regulation, sometimes that's in investment commitments into the United States. We've seen all of those. I think this will likely settle down into tariffs, but the ability of the U.S. administration to do that over the longer term will be more likely determined by more conventional methods in trade agreements or not. Than what are temporary measures. Even so-called 232 measures are temporary in the sense that they're addressing a specific perceived dislocation. And obviously the Section 122 ones that are used now have a time limit of 150 days.
you talked about value-based realism and a pragmatic approach that we need to take as far as trade is concerned. How do you see your engagement with China from the construct of the value-based realism that you just spoke of?
Well, it's a great question, and I think if I compare China and India, that helps define it. So we would see our cooperation with India extending into defense, a wide range of areas of defense, a wide range of areas, for example, in AI, quantum, and others. That was not part of our discussions with the Chinese. I don't see defense cooperation with China. When I say defense cooperation, I mean in the production of weapon systems and defensive systems. And why is that the case? Well, because we have the overlap between our values. Canada and India there is not a comparison vis-a-vis China. So the opportunity set with China, which is large in absolute terms, is much narrower than it is with India.
Let's talk about the India opportunities then. You said that you believe that there is a lot of ambition in making this partnership and taking this partnership to newer heights. What can we expect then in terms of the CEPA? The Commerce Minister said that they hope that at least the launch of the talks, the fresh round of talks for the CEPA will happen during this visit of yours. What can we expect on that front?
Well, I think yes, I share the view of the Commerce, or the hope. Actually, I would upgrade his hope to an expectation, if not a certainty, that we would launch these talks. The second thing, the Prime Minister and myself agreed in Johannesburg, as I said in my remarks, that our intention is to sign a CEPA by the end of this year, ideally by the G20 summit, the upcoming G20 summit. In America, I guess. So that's the first. The second is there's a series of other agreements, for example, around critical minerals, which we would logically develop. Whether that's part of the CEPA or not is, for facts on the ground, it doesn't make a difference. I mean, we have the agreement between the two nations. So I see a series of other agreements. Critical minerals would be one. Maybe digital trade may be in or out, but I would expect that we need agreement in around that. So the ambition is much broader than even the comprehensive economic partnership.
You spoke about the Buyers Club for critical minerals. Do you see India as being part of it?
I think it's very important that India is part of it, first point. Second, it was one of the quieter things but more important things that came out of the Kananaskis G7. Again, Prime Minister Modi was there. He signaled interest in the Buyers Club at that point. And just to be clear, what we're talking about for those who are affected by this is using collective buying power, including, to put a fine point on it, in Canada we have set aside just under $2 billion as a support fund for certain critical metals and minerals so that investment can be made with knowledge that there will be at least a floor price over the medium term. That helps get around short-term volatility and predatory, to be frank, predatory behavior in some of those markets, and that's going to drive the investment. So, and it's also part of what we're working with the Australians and the European Union. So India being part, very logical given the investments here, the expertise here, but also it helps create that critical mass for it.
You know, you talked about defense and that being an area of opportunity for both Canada and India to work together. Nuclear, and there are historical ties between India and Canada going back to Cameco transferring technology to Indian companies here. Do you build on that in light of the fact that India has just passed this legislation? Is this going to be an area of priority for you?
It's absolutely an area of priority. I think maybe I'll just, one thing that's probably can-do technology. But Cameco is very much implicated. As Premier Mo is here from Saskatchewan, where there's more than enough uranium, I think. Is that fair to say, in your great province? For the scale of nuclear ambitions globally, but very much here. And I think this is a crucial point. When you get to areas like anything on the energy side, but let's stick with nuclear, anything on the food security side and others, Canada will be a reliable partner. We will not weaponize, be tempted to play with this. This is a crucial, and that's part of what. Again, I don't want to group India in as a middle power, but the non-hegemons. That's where when we come together, that's part of the advantage, and particularly with those countries where you share share a core set of values.
The non-hegemon grouping that you just spoke of on the energy side, that's another area of cooperation. We had your energy minister here in January, and there was a renewed commitment to build on the energy partnership between India and Canada. In light of the US's attempt to get India to diversify its energy mix more and stop buying from Russia, do you see this as an opportunity for countries like Canada?
Well, I think there's a wide range of energy opportunities. We just touched on nuclear. I mentioned LNG. That is a huge opportunity there. We expect that there will be additional oil capacity, oil export capacity that could be complementary here. I would just stress alongside that that unlike the U.S., at least for the moment, we will be a major buyer of clean technology. I'll give one example of 60 gigawatts clean technology, and including storage required offshore, in Atlantic Canada. So it's a two-way partnership. I think it's natural, irrespective of the issue with Russia.
We're almost at the end of our time. So let me ask you. You spoke in Davos about the fact that if you're not at the table, you're on the menu. At this point in time, given everything that's happening in the world, and as you pointed out, it's a rupture. It's not transient. There's no going back to the way the things were. What concerns you about what we're seeing today the most, in light of the many developments that have taken place, even since you made that speech in Davos?
I think I'm more optimistic, but where the
than you were in Davos?
Well, I'm more optimistic because of the reaction to that speech, and there's a sort of public reaction, but then the quality of the discussions with a wide range of countries who are all thinking the same thing, who all realize that there's many areas to partner together, and to be frank, who all want a positive agenda. They want to build. They want to move forward. They're confident. I mean, this to me, it describes India. It also describes Canada. And as opposed to being in a defensive world where you're waiting for the next tweet, and you're worried about your core economic relationships. No, build a relationship you can rely on for the long term. That lowers my worry level because there's just so much to do. And as an example, the scale of what's being discussed between Canada and India is a perfect illustration of that.
Did you believe or anticipate that you'd emerge from that speech as the great unifier?
Boy, we're in trouble if I'm the great unifier. But I think the main thing I took from that speech, I hate to say, the analogy was right. The analogy of taking the sign out of the window, the analogy is there because in a totalitarian regime, everyone is thinking the same thing, but you don't necessarily know that everyone's thinking the same thing. The reaction to that speech was everyone's thinking the same thing and wants to get on.
So you've got a room full of Indian business leaders here. What is the message that you leave this room with?
That I leave this room with?
Yes.
Let's go. Yes. No, the message is, I've been here for 30 hours probably, tremendous discussions already, a lot of energy, focus. It's infectious, the enthusiasm, the ambition, and the scale and scope of what's going on in India. I think it's very positive for Canada. And the partnerships are going to flow.
Mark Carney, many, many thanks. Ladies and gentlemen, a big round of applause for Mark Carney, the Prime Minister of Canada. Good evening. Thanks for joining us on India Business Hour. I'm Shireen Bhan. The big stories that we're tracking for you this evening. The war in West Asia widens as airstrikes intensify across the region. Iran targets energy infrastructure, including a Saudi Aramco refinery. Qatar Energy halts the natural gas production. Kuwait mistakenly, allegedly shoots down 3 U.S. fighter jets. Iran's Red Crescent says at least 555 people have been killed across the country. Iran rules out negotiations with the United States as the conflict deepens and widens. U.S. Secretary of War Pete Hegseth says this is not an endless war like Iraq and there will be no democracy-building exercise. Also confirms the death of 4 U.S. servicemen. Crude oil prices post the biggest rally in 4 years. Investors fear major supply disruptions at the Strait of Hormuz. Traffic at the Strait effectively comes to a halt as shipping companies take precautionary measures. Stock markets decline across the world. Wall Street opens with sharp cuts. The Sensex loses over 1,000 points. Nifty drops below 25,000. The rupee declines by nearly 50 paise against the dollar, but RBI's intervention restricts the drop to 0.5%. Flights disrupted across West Asia. Indian Airlines cancelled flights to the Gulf till further notice. Several Etihad flights take off from Abu Dhabi headed towards London, Paris, Mumbai, Delhi, Bengaluru, among other cities. Hundreds of containers remain stuck at key Indian ports. 4 lakh tons of basmati rice exports stuck in transit. Nearly 10 million Indians are currently in West Asia as the war rages on. Around 3,000 Indian students are stuck in Iran. Prime Minister Modi calls the situation a matter of grave concern for India, says all conflicts must be resolved through dialogue and diplomacy. India and Canada reset the bilateral relationship with the visit of Canadian Prime Minister Mark Carney. Canada agrees to supply uranium and work on rebuilding nuclear reactors in a landmark $2.6 billion deal. Both nations set a $50 billion target for bilateral trade by 2030. After completing a year in office, SEBI Chief Tuhin Kantapande signals its intent to boost liquidity in the cash market and allow participation of insurers in commodities. Also aims to cut registration time for foreign investors to 5 days. Assures no new action on derivatives till the impact of earlier steps are assessed. As geopolitics rocks the market, Chris Wood at Jefferies says gold and energy stocks can be used to diversify portfolios, predicts gold prices hitting $10,000 an ounce as he expects some near-term consolidation. That's an exclusive. Also on the show, artificial intelligence is shaking up the battlefield and is now embedded in modern warfare. A special report coming up. Well, that is the big story tonight. The United States and Israel's war with Iran has spiraled into a West Asia conflict with multiple missile attacks being reported across the region. Tehran, however, claims it is targeting only American bases in Gulf nations. America and Israel's joint air campaign, Operation Epic Fury, was unleashed on Iran in the early hours of Saturday. The Islamic Nation's supreme leader, Ayatollah Ali Khamenei, and several of its top leadership have now been killed. The death toll in Iran has crossed 550 as per the Red Crescent Society. 4 U.S. service members have been killed. This has now been confirmed by the U.S. President Trump has warned that more casualties are likely. Israel has bombed key Hezbollah positions in Lebanon earlier today, claiming this is a response to an attack from Iranian-backed militant group. Lebanon's Health Ministry, meanwhile, says it has reported 31 deaths. Meanwhile, Kuwait Defense Forces allegedly accidentally shot down 3 U.S. fighter jets. However, no casualties were reported. The United States has labeled this as a friendly fire incident. Iran has targeted energy infrastructure across the Gulf nations. Saudi Aramco's oil refinery in the city of Ras Tanura has been shut down after a drone attack. Qatar's state-run energy firm has halted LNG production at its refinery near the country's eastern region. In what has been the worst civilian casualty over the last 3 days, Iranian state media reports that the death toll from a missile strike on a girls' school in southern Iran has now risen to 165. U.S. Secretary of War Pete Hegseth, during a briefing at the Pentagon, has said this is not an endless war like Iraq and there will be no democracy-building exercise.
We set the terms of this war, from start to finish. Our ambitions are not utopian. They are realistic, scoped to our interests and the defense of our people and our allies. To the media outlets and political left screaming endless wars, stop. This is not Iraq. This is not endless.
This is not a single overnight operation. The military objectives that CENTCOM and the Joint Force have been tasked with will take some time to achieve, and in some cases will be difficult and gritty work. We expect to take additional losses, and as always, we will work to minimize U.S. losses. But as the Secretary said, this is major combat operations.
We are not attacking our brothers in the, in the Persian Gulf. We are not attacking our neighbors, but we are attacking American targets. And this is obvious. The Americans, the United States military is targeting us, is attacking us, and we have no way but to defend ourselves.
Now, China and Russia have condemned the killing of Iran's supreme leader and have called for calm. U.S. allies have largely supported the strikes on Iran. British Prime Minister Keir Starmer has allowed the U.S. to use the UK military bases in the region, but President Trump has said the UK took too long to give the green light. Back home, Prime Minister Modi has said the situation is a matter of grave concern for India and has called for a resolution through dialogue and diplomacy.
पश्चिम एशिया की वर्तमान स्थिति हमारे लिए गहरी चिंता का विषय है। भारत डायलॉग और डिप्लोमेसी के माध्यम से सभी विवादों का समाधान का समर्थन करता है। इस क्षेत्र में मौजूद सभी भारतीय नागरिकों की सुरक्षा के लिए हम सभी देशों के साथ मिलकर काम करते रहेंगे।
The United States has requested permission to use British bases for that specific and limited defensive purpose. We have taken the decision to accept this request to prevent Iran firing missiles across the region, killing innocent civilians, putting British lives at risk, and hitting countries that have not been involved.
And this is the impact of what is going on in West Asia. Crude oil prices posting the biggest jump that we've seen in the last 4 years as the war in West Asia has sparked fears of supply disruption. Natural gas prices have also surged as insurers hike premiums, cancel policies, and shipping companies reroute vessels from the Strait of Hormuz. Now, here's what's important. Qatar Energy has already halted the production of natural gas after Iranian drone strikes on 2 of their facilities. Manisha standing by now with more. Manisha, energy infrastructure, part of the installations that the Iranians are targeting. What does this now mean for commodity prices?
Well, thank you so much for that. Yes, when we started the day, we started 13% on the higher side. This was a knee-jerk reaction as the new week was opening, and we were reacting to the weekend therein. And since then, we have been holding around those levels, around $80 for the Brent prices there. Well, there are 4 or 5 things that the markets are looking at right now. Let me remind you that the situation is fluid. We are reacting to a lot of information that comes in on an hourly basis and is the reason you will see very, very volatile prices going forward. One is the retaliation that Iran is making in the neighboring countries. How much, at what scale, is something that the street is watching out for. The second most important is on how longer will this West Asia war last. U.S. President has said 4 to 5 weeks. I mean, that's a long time. If it actually goes until then you are looking at much higher crude oil prices therein. The third point is about the Strait of Hormuz. Well, this is the place where 20% of crude passes by. Let me remind you, when there was a problem at Red Sea, we saw shipping companies go via Cape of Good Hope. But when it is about Strait of Hormuz, there is no alternate sea route. So this is, when it is shut, that means it's shut. So there is no ships going through this. So even as Iran says that the Strait of Hormuz is open, but it is the insurance companies telling the shipping companies that if you want to go via that, you have to give a premium as high as 50 and 60%. And in various policies, we have seen the war as a clause being taken off. So the shipping companies are standing there. That area is quite clogged and nobody is passing through. Now, if this gets prolonged, if this is shut for a long time, then there is no way that you're looking at crude prices not gaining higher from here on.
I think the market will still remain extremely cautious in unwinding the risk premium because we have seen what route the diplomacy has taken and what results it has yielded, unfortunately, over the past few weeks. So no one is going to be betting or holding their breath for a very quick resolution, which means that we may again also see a start and stop of diplomacy and a military conflict. So I would expect perhaps a little bit of relief, a little bit of pullback in crude, should there be a ceasefire and a return to the table, but not any meaningful drop in crude prices.
Well, oil markets, commodity markets clearly in a state of volatility at this point in time, reacting to the developments as well as supply disruptions that are expected and already started to come in. And stock markets across Europe and Asia also reacting to those developments. In fact, they declined on the back of tensions in West Asia, as did the Indian markets, also remained weak through the course of the day. But coming off their intraday lows a tad, the Sensex closing 1,000 points lower, the Nifty down 300 points. The Nifty Bank saw a cut of almost 700 points and 900 there on the Nifty mid-cap. So we did see our markets deep in the red there. Besides metal, healthcare and defense stocks, that was really the only pocket where we saw some gains. All sectoral indices closing in the red. Now, the conflict has also pushed gold and silver prices high as investors rush towards safe haven assets. Chris Wood of Jefferies predicts that gold prices will hit $10,000 an ounce, even as he expects some consolidation in the short term. Here's Chris Wood.
In the medium term, I see big further upside in gold, but I wouldn't be surprised to have a period of extended consolidation. Gold can easily go to 10,000.
Oh, wow.
Because if you look at, I'm talking US dollar terms, so in US dollar terms, the growth of M2, you can easily get $10,000 on gold. Yeah. But my formal target based on is currently 6,600.
Well, that's Chris Wood on gold. Now, flight services across West Asia have also been disrupted as several nations suspend the use of their airspace indefinitely. Indian Airlines have cancelled flights to the Gulf till further notice, leaving thousands stranded. Madiha standing by with more details. Madiha, no respite largely for airlines and passengers, but some movement we have seen. For instance, flights are operating selectively from Abu Dhabi today. Some Etihad flights took off.
Since the conflict continues to escalate, large parts of West Asia airspace continue to remain impacted. So if you can see, Tehran, Tel Aviv, Beirut, Baghdad, Jeddah, Bahrain, Amman, Kuwait, Doha and the UAE are the most restricted airspaces currently. However, we've seen some flight movements now at the Abu Dhabi airport. So Lufthansa flew a flight to Munich. Etihad Airways flew some flights to Mumbai, Delhi, Bengaluru, London, Islamabad, Karachi, Amsterdam, Moscow, Paris, Jeddah and Riyadh. For westward flights, Etihad is taking the Saudi airspace instead of the Iraq and Syria airspace that it was taking earlier. We are not sure if these are regular commercial flights or flights to evacuate stranded passengers at the Abu Dhabi International Airport. Now, Indian Airlines have suspended operations to Gulf since the 28th of February. So Air India, Indigo, Air India Express, SpiceJet have cancelled flights to Gulf destinations until the 2nd of March. Akasa Air has suspended its operations to Gulf till the 3rd of March. Indigo, which is the largest Indian carrier, has suspended all flights to the Gulf and several western destinations. Remember, Indigo has 15% of its network on international routes. Now, airlines are looking at alternate routes to continue long-haul operations. For instance, Air India is using the Oman-Saudi Arabia corridor to operate flights to Europe, the US and Canada. Then several Air India flights are currently airborne. They took off in the morning, including services from Delhi and Mumbai to London, Rome, Vienna and Paris. Foreign carriers like British Airways are using the Afghanistan-Pakistan airspace corridor to operate flights to India, Singapore and Australia. So all are avoiding the Middle Eastern airspace currently, but that rerouting comes at a cost. Flight times increase, fuel burn rises, operating costs go up, crew schedules get disrupted. There is no activity seen at Dubai and Doha, major aviation hubs where thousands of passengers are currently stranded, but we'll continue to track if there is any change in the situation and whether normal flights will resume tomorrow, like how they have at the Abu Dhabi International Airport.
Madhya, many thanks. And it's not just aviation, as Madhya was pointing out. Maritime transportation has also been disrupted. Containers are starting to clog up across major ports. Santhya joins us now from the Jawaharlal Nehru Port Trust in Navi Mumbai, where she was reporting as exporters stare at financial losses. There was a meeting that took place today in Delhi, the Commerce Ministry meeting with exporters to try and understand how best to try and mitigate the risk. But this is the story and the situation across our ports. Take a look.
The clearance for Indian containers meant for the Gulf region stopped on Saturday when the US-Israel-Iran conflict started. And since then, the containers at various ports in India, including JNPT and Mundra, are parked. And considering the nature, given the nature of the cargo, the exporters had no option but to park and plug in their containers. I'm being joined by a couple of drivers here. ये रहा प्लग पॉइंट और इस पे सब लोग आप ये जितने भी पॉइंट्स हैं इसके ऊपर आप अपने अपना कंटेनर लगाते हैं तो टेम्परेचर कंट्रोल के लिए सिस्टम स्टार्ट हो जाता है। जी जी। तो आप अपने कंटेनर में क्या कैरी कर रहे हैं? हम चपाती कर रहे हैं। कहाँ को जा रही थी? ये जेबीएल के लिए जा रही। तो अभी आप क्या कर रहे हैं? इसका क्या करेंगे? आपने लगाया हुआ है कि निकाल दिया? नहीं, निकाल के अभी हम सब कंपनी जहाँ से लोडिंग करके आए थे वहाँ पे रिटर्न लेके जा रहे हैं। तो कितनी देर लगाया आपने ये? यहाँ 36 घंटा लगाए थे यहाँ पे। अच्छा जी। और आपका बिल कितने का दिखा रहा है अभी? 5215 रुपये का। 5000 से ऊपर का हो गया। जी जी। सर आप जो हैं आपका कहाँ पे कंटेनर जा रहा था? आपने क्या कैरी किया था? ये मैडम चपाती है मेरे लिए, रोटी। आप भी चपाती कैरी कर रहे थे? आपने भी लगाया था ये प्लग इन पे? हाँ, प्लग इन किया था 36 घंटे। अच्छा, और ये कितने प्लग इन पॉइंट है इस लाइन में? 40 पॉइंट है मैडम। अच्छा, और एक प्लग इन पॉइंट पे 5 कंटेनर लग जा रहे हैं? हाँ, 5 कंटेनर। अच्छा, तो यहाँ पे और भी जगह पे ऐसे प्लगिंग पॉइंट्स वगैरह हैं? साइड में है, बगल में है। अच्छा, तो आप भी वापस ले जा रहे हैं अपनी गाड़ी? हाँ, वापस कंपनी में जाएगी।
Well, that is the action there at the JNPT. Nearly 10 million Indians, by the way, are currently in West Asia as the war rages on. The government has urged all Indian nationals in the region to shelter in place and avoid non-essential travel. Shivani reports on the challenge that the Indian government will face if this becomes a long-drawn, protracted war.
Well, yes, India has an estimated 9.6 million nationals living and working in West Asia, making it one of the largest overseas Indian concentrations globally. The UAE alone accounts for nearly 4 million Indians, while Saudi Arabia houses over 2.6 million. And even in Iran, currently at the center of the escalating tensions, around 10,000 Indians are estimated to reside. In Iran alone, around 3,000 Indian students, including nearly 2,000 only from the state of Jammu and Kashmir, remain in the country amid escalating violence, with roughly 1,100 to 1,200 of them in intense conflict areas, pleading for evacuation support from the government of India. Now, with multiple countries shutting down airspace and missile and drone attacks reported across parts of the Gulf, thousands of Indian travelers transiting through major hubs like Dubai, Doha and Abu Dhabi have faced cancellations and diversions. While there is no official consolidated figure, yet reports indicate that hundreds to potentially thousands of Indians are currently stranded due to flight suspensions. Transit travelers to global events like the World Mobile Congress or Umrah pilgrims in Makkah are facing disruptions, many unable to return home due to airspace closure and cancelled flight corridors. Now, the Cabinet Committee on Security has reviewed the difficulties faced by Indian travelers transiting through Gulf hubs. The committee also discussed concerns of Indian students scheduled to appear for examinations in affected countries, along with the broader economic and security implications of the conflict. The Ministry of External Affairs has issued advisories for Indians in Iran, Israel, Jordan, Qatar, UAE and Palestine, urging caution, avoidance of essential travel and vigilance. External Affairs Minister S. Jaishankar has spoken separately with his Iranian and Israeli counterparts, conveying India's deep concern and urging restraint. The MEA has reiterated that dialogue and diplomacy must be pursued and that sovereignty and territorial integrity of all states must be respected. Indian embassies in Tehran, Tel Aviv, Abu Dhabi and Damascus have activated helplines and remain in constant contact with Indian nationals. This is not just a travel disruption story. With nearly 10 million Indians in West Asia, any prolonged conflict impacts remittances, trade, aviation, energy flows and student mobility. New Delhi is closely monitoring developments as the region remains volatile. For a country with nearly 10 million citizens in West Asia, the stakes are enormous, and any escalation carries direct humanitarian, economic and diplomatic consequences. Back to you.
Yes, it certainly does, and this will be a challenge. Shivani, many thanks for joining us. Up next on India Business Hour, artificial intelligence is shaking up the battlefield and how. Embedded in modern warfare, that and more when we return. You can catch all of CNBC TV 18's news and updates on YouTube, Facebook, Instagram, X and Geo Hotstar. Subscribe to CNBC TV 18 Access for our exclusive stories. Well, the other big story this evening, India and Canada have reset the bilateral relationship with the visit of Canadian Prime Minister Mark Carney. Canada has now agreed to supply uranium and work on building nuclear reactors in a landmark $2.6 billion deal. Both nations have set a $50 billion target for bilateral trade by 2030. Remember, this visit is significant because it is the first bilateral visit of a Canadian Prime Minister in 8 years. There was a rupture in the relationship between India and Canada, and this is now the start of the process of repair and reset.
हमारा लक्ष्य है कि 2030 तक हमारा व्यापार $50 बिलियन तक पहुंचे। आर्थिक सहयोग का पूरा पोटेंशियल अनलॉक करना ये हमारी प्राथमिकता है। इसलिए हमने कॉम्प्रिहेंसिव इकोनॉमिक पार्टनरशिप एग्रीमेंट को जल्द ही फाइनलाइज करने का निर्णय लिया है.
And our partnerships will be reinforced by the strong foundations we are building in trade and defense. We're advancing towards a Canada-India comprehensive economic partnership agreement with the aim to conclude by the end of this year.
And staying with that, speaking exclusively to me, Prime Minister Mark Carney said nuclear partnership with India is an area of priority. Carney promised Canada as a reliable partner and said it will not weaponize trade. Take a look.
You talked about defense and that being an area of opportunity for both Canada and India to work together. Nuclear, and there are historical ties between India and Canada going back to Cameco transferring technology to Indian companies here. Do you build on that in light of the fact that India has just passed this legislation? Is this going to be an area of priority for you?
It's absolutely an area of priority. I think maybe I'll just, one thing that's probably can-do technology. But Cameco is very much implicated. As Premier Mo is here from Saskatchewan, where there's more than enough uranium, I think, is that fair to say, in your great province, for the scale of nuclear ambitions globally, but very much here. And I think this is a crucial point. When you get to areas like anything on the energy side, but let's stick with nuclear, anything on the food security side and others, Canada will be a reliable partner. We will not weaponize, be tempted to play with this. This is a crucial.
Canada will be a reliable partner. That's Mark Carney to me. After completing a year in office, SEBI Chief Tuhin Kantapande has signaled his intent to boost liquidity in the cash market and allow participation of insurers in commodities. Speaking to CNBC TV 18, the SEBI chief said that he aims to cut registration time for foreign investors to 5 days. He also assured no new action on derivatives till the impact of the earlier steps are assessed. Take a look.
We will continue to monitor this and have the data put it out before suggesting any measures. So therefore, I think we need also stability, policy stability, in the sense that there are certain things that we do, and then we also wait that, how that market is panning out. Let's look at the kind of measures that we have at a regulator taken for the FPIs.
Right.
For us, to do the market development is to see, the frictions are reduced. There is a greater speed with which they can operate. So there is a registration issue where we have completely now looking at a very different approach to, registration. We want it to be digitized. We want it to be fast. We want it to be not, days or months, but actually literally a week or 5 days.
Well, that is Tuhin Kantapande. Now, the conflict in West Asia has put the spotlight on the role of artificial intelligence in modern warfare. Rachna joins us to explain what has changed and take us through the key implications of the growing use of AI in warfare. Rachna.
Well, the Iran-Israel escalation is more than a conventional military exchange. It's a real-time demonstration of how AI is now embedded deep inside modern warfare, from analyzing satellite imagery to prioritizing targets and compressing strike timelines. Algorithms are shaping how quickly and precisely militaries can act. This shift is clearest in what experts are now calling the AI-powered kill chain. Surveillance from drones, satellites, and signals intelligence feeds into machine learning systems that detect patterns and recommend targets. A human still signs off on all of it, but the process that once took hours now happen in under minutes. This increases the tempo of operations. Israel's documented toolkit from 2021 during the Gaza conflict shows the scale of this change. Gospel, an AI tool, is used to scan vast surveillance feeds and generate strike recommendations. Then there is Lavender, that flags suspected militants. Another one is Fire Factory, that is used to compress strike planning and logistics. And then there is West Daddy, that tracks when targets are most vulnerable. Together, these tools point to scale targeting driven by data. Iran's response highlights the new logic of saturation warfare, where large waves of missiles and drones are launched to overwhelm air defense systems. Even with interception rates above 90%, a small percentage getting through can still cause disruption and psychological impact. An interception would not eliminate risk after all, because when drones are destroyed mid-air, debris can still fall into civilian areas. US has been using Claude as we know it. US Central Command used it for intelligence analysis and simulations. But hours before the Iran strikes, Washington had ordered a halt. But the system reportedly continued running because it was already deeply embedded in military workflows. The Pentagon has since moved to sever the contract with Anthropic, but this conflict is also unfolding in cyberspace. Iran's internet connectivity plunged sharply. State platforms and major apps were disrupted. Communications infrastructure came under pressure, yet cyber operations continued on both sides, showing modern conflict now spans physical, digital and information domains all at the same time. There are also concerns about infrastructure vulnerability. After an AWS data center in the UAE was hit by what authorities call sharp objects, it is clear that AI is not replacing militaries, but it is definitely radically accelerating them all. And while development is taking place at a speed that's unimaginable, the rules that govern these developments are still being written. Back to you.
Rachna, many thanks for joining us. And with that, it is time for us to wrap up this edition of India Business Hour. Thanks very much for watching, but do stay tuned. There is plenty that is developing with the war in West Asia as it deepens and widens. The CNBC Global Edge, as we cover this from country to country, and of course bring you all the action from Wall Street live right here. Stay tuned. We'll be right back in a moment.
Markets remain under pressure amid escalating US-Iran tensions, with the Nifty slipping below 24,950 and the Sensex falling over 1,200 points. India VIX surged nearly 25%. The broader market saw sharp swings as well.
Crude oil prices rallied 13% as investors fear major supply disruption at the Strait of Hormuz. This is the fourth biggest single-day gain in 36 years. Oil marketing companies slump with input costs set to rise.
Flights disrupted across West Asia as several nations suspend use of their airspace indefinitely. Indian Airlines cancelled flights to the Gulf till further notice. Hundreds of containers remain stuck at key Indian ports. 4 lakh tons of basmati rice exports stuck in transit.
Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to get up for the next trading day. I'm Sonal Bhutra. With me is my colleague Vivek Iyer. Vivek, good afternoon. What a day. A sharp cut on the benchmark and the broader markets as well. At a point in time, all the Nifty indices or major sectoral indices, they were in the red. But we did see recovery towards the end of the trading session. So yes, we did end below the 24,900 mark. But we recovered around 260 points from the lows of the day as well. And that was very important considering the kind of day that we saw. The advance decline ratio at a point in time was at 1:7. For every one gaining stock, there were 7 declining stocks. That recovered too. So we ended with 1:5 as the advance decline ratio. So yes, it was the metals index, pharma index that recovered from the lows of the day. And look at those lines. It's been quite volatile from the word go. And that is something that we saw in the wicks today as well.
That's right. Good afternoon, Sonal. A very topsy-turvy day. Started off with deep cuts, a brief intraday recovery that got sold into, however, in the last hour of the trading session, like you mentioned, aided by most of the defensive names like FMCG, pharma, and the defense stocks. These stocks actually managed to buck the trend and move higher, leading to a brief recovery or a bit of a recovery as far as the markets were concerned. But here's the lineup of what we have in store for you today. We start with the top movers and shakers of the day with Hormuz. We decode the impact of the West Asia conflict on Indian markets, from commodities and crude to sector-specific action across the street. And now on to our first segment of the day. Hormuz joins us now from Big Wall with the top movers and shakers of the day. Hormuz, over to you.
A glass half full or a glass half empty, the choice is yours to decide what kind of a day we had. But of course, predominantly red, then green. But can't also deny the fact that there was some green. But we'll start off with the red first up. And of course, the center of action being the Middle East, stocks with exposure to that had an impact. Indigo, of course, the top loser on the index, 6.5% lower, followed suit by L&T. Of course, L&T at one point was down 7%. So there was some recovery from the lows here. LT Foods, KEC, VA Tech, Wabag, all of them seeing an impact anywhere between 3% to 6% in today's trading session. A lot of other railway PSUs were sulking in today's trade. IRFC fell to a 2-year low in today's session, ending sub 100. Railtel was down, so was RVNL. So RVNL is now down more than 50% from its all-time high levels, close to 650 rupees. Now, stocks that were at 52-week lows in today's session, of course, there were plenty of them, but Electra Green Tech dominated that list, was down 6%. Ola Electric continues to grind lower, as does Swiggy, and Suzlon, from highs of over 80-85, now is back down to 40 rupees, and Adani Total Gas too, ending with losses of around 4%. The one segment that bucked the trend in today's session were the defense names. Solar Industries doing well for itself, at 3.5% higher. Both Idea Forge and Paras Defense at one point were up 12-13%. They came off the highs of the day considering the volatility in the market, but still managed to hold on to gains of around 5 to 7%. And lastly, even in a market like this, there were stocks that were at 52-week highs, and most of them, the data cable related wire cable names as well. Sterlite Tech was up almost 9% in today's session in a market like this. KEI Industries continues to make new highs, and Precision Wires too, ending with gains of around 3.5% at 52-week highs today.
Okay, all right. Thank you so much for joining us with that stock check, Harmis. So those are some stocks moving around in the broader markets. Let's talk about the big story now. Iran's supreme leader, Ayatollah Ali Khamenei, has been killed in coordinated airstrikes carried out by the United States and Israel. Iran has declared a period of national mourning. A member of Iran's Guardian Council, Ayatollah Rafi, has been appointed interim supreme leader as the country prepares for a leadership transition. Tehran has vowed revenge. In retaliation, Iran launched ballistic missiles targeting Jerusalem, Bahrain, Doha and Kuwait, sharply escalating tensions across the region. The US and Israel have since carried out a fresh wave of strikes deep inside Tehran for a second consecutive day. Iran claims a school was hit in the bombardment, resulting in the deaths of nearly 165 children, a claim that has further intensified global outrage. With missiles flying across West Asia, large parts of the region's airspace have been shut. Thousands of flights have been cancelled worldwide, including around 850 cancellations impacting India. Meanwhile, maritime trade is also under strain. Tensions have flared in the Strait of Hormuz, a critical choke point that carries nearly 1/3 of the world's crude oil trade, raising fears of a major supply disruption. Iran's Foreign Minister Abbas Araghchi said Tehran has a proven record of openness to diplomacy, accusing the United States of maintaining a negative track record. But US President Donald Trump has made it clear that combat operations will continue in full force. The region remains on edge as the conflict shows signs of deepening further.
Well, oil prices continue to surge in trade, driven by escalating Iran-Israel tensions and rising supply concern. Let's go across to Manisha, who's tracking all the action in the commodity space.
Well, thank you so much for that. Yes, when we started the day, we started 13% on the higher side. This was a knee-jerk reaction as the new week was opening, and we were reacting to the weekend therein. And since then, we have been holding around those levels, around $80 for the Brent prices there. Well, there are 4 or 5 things that the markets are looking at right now. Let me remind you that the situation is fluid. We are reacting to a lot of information that comes in on an hourly basis and is the reason you will see very, very volatile prices going forward. One is the retaliation that Iran is making in the neighboring countries. How much, at what scale, is something that the street is watching out for. The second most important is on how longer will this West Asia war last. US President has said 4 to 5 weeks. I mean, that's a long time. If it actually goes until then you are looking at much higher crude oil prices therein. The third point is about the Strait of Hormuz. Well, this is the place where 20% of crude passes by. Let me remind you, when there was a problem at Red Sea, we saw shipping companies go via Cape of Good Hope. But when it is about Strait of Hormuz, there is no alternate sea route. So this is, when it is shut, that means it's shut. So there's no ships going through this. So even as Iran says that the Strait of Hormuz is open, but it is the insurance companies telling the shipping companies that if you want to go via that, you have to give a premium as high as 50 and 60%. And in various policies, we have seen the war as a clause being taken off. So the shipping companies are standing there. That area is quite clogged and nobody is passing through. Now, if this gets prolonged, if this is shut for a long time, then there is no way that you're looking at crude prices not gaining higher from here on. The other point is also about gas. It's not just about crude. Remember, a lot of gas passes through, natural gas passes through this Strait of Hormuz as well. Qatar is one of the major countries doing that as well. So this is another thing that the street will watch out for. The other, of course, is about hit on the energy infrastructure. Until now, in the last 2 days, we did not see that happen. But today, we've seen that with Saudi Aramco's refinery, with Saudi Aramco having to shut that refinery as a precautionary measure as well. So, see, these are some concerns that the streets is looking at. If this continues on, if this is more, and if there is energy infrastructure hit, then you definitely are looking at crude oil prices gaining much higher from here. We already are trading with a $10 to $15 of a premium in these current prices as well. The only reason that you haven't seen the prices go higher is, 1, because there is surplus. 2, OPEC is going to increase production. 3, this is not a peak demand period. And 4, the OECD countries and China are holding huge reserves that perhaps might come into the rest of West Asia as well. But barring all of that, this is very volatile and high crude price scenario that we are dealing with.
We are definitely looking at triple digits. It'll be almost impossible catch a falling knife to put a number in triple digits, because that'll again depend a whole lot on how long the worst case scenario, namely a complete blockade of oil flows, unfolds. In the event that we do see a return to diplomacy, as I said earlier, we would need to see a quick at least an interim or a framework deal for crude to meaningfully lose the risk premium it has.
Okay, all right. So that's about the crude oil prices. And of course, because of that, shares of oil marketing companies, HPCL, BPCL, IOCL, all of them were under pressure because it tends to impact their marketing margins. So that is something that we'll be watching out for very closely. Moving on now, we heard from a slew of market voices today on the impact of the ongoing conflict and what it could mean for Indian equities. To break down the key takeaways and investor sentiment, Sudarshan is joining us now with a comprehensive roundup. Sudarshan.
So on a day when volatility index has moved 20% higher, there was an all-round fall, and we see a big downtick in Nifty and even all the other major indices. We need market voices who can calm the mood, and we had plenty of them through the day, but I have selected a few. First one is Chris Wood. He believes that it's hard for market to not account for geopolitical tensions, and people need to diversify their portfolio using gold and energy stocks. Especially talking about gold, he believes that in the near term, gold can go to $6,600, and even in the longer term, it can go to as high as $10,000. And talking about the markets which might outperform going forward, so he believes that except US, majority of the markets might outperform. One big question that everyone has been asking, when will FPI come back to Indian market? As per Chris Wood, he believes that FIs can come back to India if semiconductor trade peaks and there's a sharp sell-off in markets like Taiwan and Korea. What about IT markets? Will we see counter-trend rally? He believes that counter-trend rally can be expected, but long-term growth will be a key monitorable. Next one is Samir Arora. He believes that might be a tricky phase in the near term due to geopolitical tensions, but as per him, this war is not going to last long. As per his preferred picks, its defense sector, and the reason is the support the sector is getting from the government, and the preferred pick amongst all the defense names is Bharat Electronics. Last one is Manish Sonthalia. He believes that markets like India might see incremental flows in the near term, and amongst preferred picks, auto components, tire companies, financial stocks, including insurance, select commercial vehicles, power transmission, and defense names. He believes that these packs are looking very attractive after a sharp fall that we have seen in the last few months. We'll have to see how the next few days pan out, but the market move majorly will depend if there is an ease in geopolitical tensions.
Well, thank you so much.
U.S. market, I've got a stronger view on the relative story in the absolute. So my view has been since the end of last 24 that the US has made an all-time peak as a percentage of world stock market capitalization. So to be precise, the US peaked at 67% of MSCI All-Country World Index.
Okay.
And I think that's an all-time peak, and that's consistent with my view that you're going to get a derating on the hyperscaler stocks, which dominate the US market. Because of the huge capex, which is making these companies generate less free cash flow. So I believe we've begun a period where markets ex-US will outperform.
Well, that was Chris Wood speaking to our colleague Nimesh. Well, to take the discussion forward, we are now joined by market expert Amrish Baliga and Richard Jain of Motilal Oswal Financial Services. Well, Richard, let me come across to you first. A very tough day, especially to analyze in terms of technicals, but are you enthused by the last hour rally and the last hour recovery that we saw in the markets? Where do you see Nifty headed from here on?
Yeah, very good afternoon. Well, one thing is certain that these global news flows are likely to dominate the short-term trend for the markets rather than any kind of technical levels. But today's recovery was encouraging mainly because of the previous swing low supports from where the recovery came. If you look at the recent history, then in the month of February, on 1st of Feb itself, markets formed a support around the 25,600. Even earlier in the September 2025, markets have formed a similar support base around 24,600. So last couple of occasions we have seen 24,600 has acted as a support, and today also low was 24,600. So I think this is one of the crucial support level. If this remains intact, then hopefully a recovery could be seen going ahead if everything goes well in the global markets. But 24,600 I think is one level which we are watching out for as a crucial support.
Take that point, Richard. Amrish, comment on this. I know things are uncertain right now. There's so much happening globally, and that's been the story for a while now. In that case, do you think fundamentally there are some stocks or sectors which are at reasonable valuations after the fall that we've been seeing in last couple of trading sessions, or something that you're watching out for to correct further?
No, I mean, surely it can be a buying opportunity, but the main question is how long this war will last. I mean, a few days or 4 weeks, as stated by President Trump, or it goes on longer, whether other countries get involved. So if you go with the hypothesis that it will last a few days, I think the impact will be negligible. So it could be a very good buying opportunity. Then if you're talking about the next 4 weeks, I think it would still be manageable. But anything beyond that, I mean, and especially if you have more countries getting sucked into this war, I think the effect could be backbreaking. But again, looking at it practically, that most of the top leaders in Iran have been eliminated. I'm not really sure as to how long this can go on, especially when there's a huge opposition within the country. And most of the stakeholders in the region may actually get Iran to stall the situation from getting worse. So I would bet on the fact that it could last a few days to possibly a week or so. And looking at that, I think it could be a good buying opportunity. Again, I would not say put all your liquidity at this point of time, but at least put a part of that at this point of time, because I mean, from here, once we see a bounce back, I think it'll be a very decent bounce back, and that can happen, especially if there's a truce.
Absolutely right. Ambrish, well, I want to get a little more sector specific with you. One particular sector that bore the brunt of selling pressure today was actually the industrial space. Names like L&T, large exposure to West Asia, some of the other names like Thermax, KEC, Kalpataru. Do you feel that these dips that they saw today is a good opportunity to buy, or will you wait on the sidelines and wait for more clarity to emerge?
No, like I said, I mean, if I go by the hypothesis that it may not last too long, I think today's fall in L&T would be a very good buying opportunity. But we should remember that they have a decent exposure to West Asia, Middle East. So in case it carries on longer, yes, the effect would be much, much bigger. But I mean, keeping everything else aside, yes, at the current levels, it makes decent sense to at least put in part of your money into L&T.
Technically, Ruchit, what do you make of L&T?
What is 200 EMA can be seen. So firstly, we have seen a good volume-based selling happening today, and the 200 EMA support for stock would come around 3850 to 3700 range, so 3800 range. So I think if anyone has to do bottom wishing in this correction, then if we get the stock around there 3850, 3800, then the risk-reward ratio could become favorable.
Well, thank you so much, gentlemen. Request you to stay on. But moving on, escalating tensions has disrupted aviation routes with airspace closures and flight diversions, adding to operational uncertainty. To track how this is impacting flights to and from India, Madhya joins us. Madhya, over to you.
Well, since the conflict continues to escalate, larger parts of West Asia airspace remain impacted, particularly Tehran, Tel Aviv, then Beirut, Baghdad, Jeddah, Bahrain, Amman, Kuwait, Doha, and the UAE are the most restricted airspaces currently, and there is no flight movement seen in this region. Indian Airlines have suspended operations to the Gulf since the 28th of February, ever since this conflict started. Air India, Indigo, Air India Express, SpiceJet have cancelled flights to the Gulf destinations until the 2nd of March, which is today. Akasa Air has suspended its operations to Gulf till the 3rd of March. Now, Indigo, which is the largest Indian carrier, has suspended all flights to the Gulf and several Western destinations that it serves, and we don't know when it plans to resume these flights. Remember, Indigo has 15% of its network on international routes. Airlines are now looking at alternate routes to continue their long-haul operations. For example, Air India is using the Oman-Saudi Arabia corridor to operate flights to Europe, the US and Canada. Several Air India flights are currently airborne, including services from Delhi and Mumbai to London, Rome, Vienna and Paris. Foreign carriers like British Airways are using the Afghanistan-Pakistan airspace corridor to operate flights to India, Singapore and Australia. So all are avoiding the Middle Eastern airspace, but that rerouting comes at a cost. Flight times increase, fuel burn rises, operating costs go up, crew schedules get disrupted, and three major Middle Eastern carriers, which is Emirates, Etihad and Qatar Airways, that carry bulk of the transit traffic from Asia to West via the Middle East corridor, have suspended all flights until the 2nd of March. We don't know what happens tomorrow, but with thousands of passengers stranded at various Gulf airports, we will continue to track if there is any change in the situation and whether flights resume tomorrow.
Okay, all right. Big uncertainty. That's literally the story of the game right now. We spoke to a couple of analysts today as well, and they did indicate that Indigo, there are twin issues that they're facing. Rising crude oil prices, every 1% increase could impact their profitability by 5%, and of course, 12% of their total exposure to the Middle East area. Amrish, coming on this, Indigo was down 6.5% today. We saw disruptions in the month of December, and then this. What do you make of this particular stock, considering that it's the listed play? We do have SpiceJet, but it is usually the listed play in the aviation space.
I mean, they were just coming out of the issues which they had recently due to cancellations, and now you have this geopolitical issue which has come up, rising crude, again, a cancellation of number of flights. I think it's going to affect them decently well. And I think it'll be at least possibly 2 to 3 quarters before they get back on their feet, like what we had seen about a year back. So as of now, I would possibly avoid the airline space and especially Indigo.
Well, thank you so much, Ambrish, as well as Ruchit, for joining us, giving us your view on a very volatile trading session, individual stocks as well as sectors. Thank you once again. Well, moving on, we'll now slip into a short break. We'll get you the top corporate voices on the other side.